March. This is the forward-looking commentary. Big manufacturers index seen rising by 13 points. That is somewhat underwhelming. Reuters poll was looking for 19. Onto the services sector. December non-manufacturers index up by 9. Reuters poll looking for 6. So, better than expected. Hints at a services sector recovery. Just how durable is it? Let's look to the March numbers for some guidance. March, big non-manufacturers index seen at 8. Reuters poll was looking for 10. So not bad, but it looks as though it could lose a wee bit of momentum into the new year. Right, we had dollar yen trading at 113.46. It's a wee bit higher just after the numbers, but the market's still digesting them. Let's bring in Martin Schulz now, Chief Policy Economist at Fujitsu, for some analysis on the BOJ Tankan. Joins us live from Tokyo, of course. Martin, great to see you. What do these numbers tell you about how corporate Japan is positioning for the recovery, especially on the services side?
Well, these were actually exactly the results we were looking for. We had a major jump in terms of sentiment among the manufacturers. They became a bit disrupted again with the supply chains and prices going up. Now the service economy, they are catching up. This is a big jump in terms of service sentiment. The state of emergency is over. People are back in restaurants. They are spending again. This is exactly what helps the economy domestically. So this is really good news.
Where does it leave the policy response? Any implications at all for the Bank of Japan? But more pertinently, does it imply more fiscal support, or is the economy ticking along quite nicely?
We are getting these huge fiscal packages coming in. It is a 10% GDP fiscal package prepared for next year, promised by the PM, by the Prime Minister during his election campaign. This is almost 5% of GDP fresh money coming in. That will be provided by the Bank of Japan. I don't think that the Bank of Japan will do much on Thursday. They are tapering in a way, but they are keeping risks out of the economy by guaranteeing for SME financing. So it will be rather quiet on that side, I guess.
Is the economic support package, though, absolutely needed, considering that previous packages haven't yet necessarily all been used?
Well, there is the talk about the US being overstimulated. That is not the case in Japan. The restart here was much slower, which has some positives on the side because, well, we don't have prices surging already and people are not really concerned that we are running into a major difficulty with supply chains being overwhelmed. So this is going rather smoothly, but there have been so many restarts and so many disappointments. Now the government is coming in massively. I think this is pretty good news from the corporate side, that next year looks way safer than last year and all the attempts of getting things going by now.
You know, obviously there are things that the BOJ can do. There are things that the government can do, you know, whether it's throwing money at the economy with, you know, fiscal packages, etc. But at the end of the day, there are a number of challenges on the global front, whether they be supply chain or inflationary based or something else, that are completely out of the authorities' hands. What do you see as being out of the authorities' hands when it comes to the outlook for the manufacturing sector in Japan?
Well, the manufacturers are struggling with, of course, the COVID cases popping up at places where you wouldn't have expected it. In Japan, we have almost no cases right now. So the focus on the domestic economy, getting the domestic supply chains going, that is working. From the cost side, we have wholesale prices up by 8%. That is squeezing profits. This is something that the companies will have to manage. The government is coming in with this big package. Well, this is fine. What we need now is productivity. So the domestic economy needs to be the focus next year. This is productivity. This is digitalization. This is really getting investment going as well. And we could use actually a bit more support here in terms of deregulation and getting things a bit smarter than they are right now.
Martin, so we got a major fiscal package in the offing, and I don't want to be a wet blanket, but in terms of downside risks, how would you rate them? As of now, a big manufacturer's sentiment index, highest level since December 2018. Small non-manufacturer's sentiment index, highest level since March 2020. Omicron does not seem to have its fingerprints on the data, on these leading indicators yet?
Absolutely. Japan is now in a situation while everywhere cases are popping up again, we have almost none. Omicron is just gradually getting in, but companies have got used to it in a way, and seems to be on the way now towards a frustrating flu that comes in cycles. So it is really about the domestic economy and opening it up. The government has closed down the economy again. Companies now need the exchange. We need to get in and out to get the economy really going sustainably. This is not on the radar screen right now. We have to be quite optimistic to get things going in March, April, in terms of opening Japan again. We cannot do everything domestically right now.
The dollar-yen rate, Martin, started at 103 at the beginning of the year, and it's currently sitting around the 113s. In other words, the yen has just been getting weaker and weaker and weaker. How much does this actually help the BOJ in its tasks?
So far, tremendously at 113. That helps really companies. Of course, energy prices are going up. Of course, we have a difficulty with import prices, but overall, it stimulates the economy. Exports are really good, except that production has difficulties to keep the pace. That helps the Bank of Japan. Now it remains a big topic. Well, inflation in the US, and remains the Federal Reserve calm. If interest rates are going up too fast, that would be a big problem for Asia and for Japan as well.
Most certainly, most certainly. Thank you very much for joining us for Crunching the Tankan, Martin Schulz of Fujitsu. But do stay with us as we're going to bring you now the opening numbers in Tokyo and Seoul on the other side of the break. We've still got 1 hour to go here on Squawk Box. Do stay with us right here on CNBC.
We're committed to see.
Good evening, everyone, or good morning, depending where you are. Right now, I don't have anything open. You can see is no position long or short in this white box. So this means we are flat. If I post the screen like that, this means we don't have any position. As soon as we will have a position, I will post this screen so you can see I'm long or short, and you can take it if you like it. If you don't like it, don't take it, okay? So right now I'm still looking for news, a lot of news about the Australian dollar. I guess they're gonna give money to the business people for loan or something. This is all the news about, so basically everything from Australia, a lot of news in Australia. Australian dollar, it was moving about, it went up and down like Australian dollars. Let me see something here. Australian dollars. It looks like it's a buy. Right now we don't have a mixed signal. We have a mixed signal because when we have a buy signal, you will see this line above 50, and we trading above this 250. So this is a buy signal. What you see right here, we are above, but we are not above the 2 moving average. We only above 1 moving average, but the other. So that's why you are stuck between these 2 lines, and we don't know where we're going. But when everything line up, this is a good trade. Like this is a buy signal, this is a sell signal, this is a buy signal. You see, when you start trading above this two low moving line average, and this is above 50, we are going the right direction. So what I can do here, what we can do, we can just draw trend line, and we draw a trend line like that. So if we're going down, our target will be, if we break this trend line, we're going down. If we break this trend line, we're going higher. So let's put it this way. So the target will be around, how much this year? About 50 bps. So if we break this line, we're going 50 pips. If we break this line, we're going down 50 pips. Okay? So let's watch it, and I'll keep you updated if I do anything.
Looking pretty good and pretty stable just ahead of the Fed. And in the meantime, on the data front, we were just talking about this with Martin, the Bank of Japan Tankan survey showing big manufacturers December index at plus 18, expectations calling for plus 18 in the next quarter, so better than expected here. Big non-manufacturers, plus 9 for December, plus 8 for next quarter. Big firms, CapEx next fiscal year, plus 9.3. Australian markets have been trading for an hour. This is where we stand. We're up by about 37 points there, and a big week for central bank meetings, of course, with the Fed, ECB, the BOE, and the BOJ, alphabet soup, isn't it? Central bank decisions from a bunch of Asian central banks as well as those banks that I mentioned, the central banks I mentioned earlier. But of course, one of the key decisions we'll be waiting for is the US Federal Reserve, of course, out Thursday, Asia time. Will Kaloris joins us now. And Will, on the back of the latest inflation data, isn't it all academic? Hasn't the market made up its mind over the pace of tightening and I guess the all-important dot plot and what that tells us about the policy path and the number of rate hikes is going to be critical?
The number will be incredibly critical. And again, as we were mentioning before, it just depends on what camp, or I suppose irrespective of what camp that you are in, what the Fed actually ends up doing, because there is this, I suppose, chasm between what some certain groups of people are expecting in terms of Fed policy. Are they going to go with an aggressive hiking strategy to really dampen what we have been seeing in terms of inflation, not this year, but moving into the start of next year once the tapering program is indeed complete? Or is it going to be a matter of doing maybe 1 or 2 rate hikes, like over at UBS, like a couple of the top tier firms do suggest, and then potentially you see, instead of an aggressive rate hike strategy, instead of 1, 2, 3, 4. Instead, what you then see is them using the balance sheet and using the runoff of the balance sheet as a means of transmitting that monetary policy, which can be just as effective as going in hard on hikes. And at the same time, doing that doesn't necessarily spook the markets as much, because you're obviously also looking at the valuations on certain asset classes, the risk-free rate. When you're calculating all of these things, you're using the rates to actually do that. So it could be a different kind of method that the Fed does use, and it is one that is gathering steam in terms of this kind of expectation. Now, there are some people that, following on from this inflation print, think that it's all but locked in, that we are going to see the more aggressive tapering. So that would mean that if they do jump that or lift that to around about 30 billion, that would actually see that March is the ending of the Fed tapering, or the necessity to taper, but they've still got 8.8 billion, or 8.8 trillion, I should say, rather, on the balance sheet. And if they do that balance sheet runoff method, then you're actually cutting a lot of that out, or you're winding that down quite significantly through letting some of those maturities expire. And that could be, again, like I said, a more easy way of dealing with the transmission, and again, not spooking the markets, which will be absolutely critical. But I also just quickly wanted to touch on a couple of things that we're also looking at that do play into the maximum employment, because you've got to remember, this is the last thing that the Fed is basically looking at in terms of when to start hiking rates, because they've basically all but said, Fed Chair Powell, that the inflation side of things do necessitate any kind of rate hike. So right now you've got unemployment at 4.2%. You'd probably need to see that below 4% for that to be classified as maximum employment. You'd need the part rate to kick up a little bit to 62.2 to 62.4 or thereabouts, perhaps just a little bit higher, Mandy. But right now we're seeing wages growth absolutely surging. You've got the latest consumer sentiment data that shows lower income households are the most exuberant that they have been since 1980. They're expecting wages to come through. So it's going to be interesting to see if those wages don't come through, whether or not you do see the unemployment rate go down, or whether maybe people will be holding out to get higher wages, and how that all plays into the dynamic. So there's a lot of things all in the mix right now, Mandy.
A lot of things, as always in the mix, and I would never want to be a policymaker as a result. Well, China's policymakers, meantime, emphasizing stability over and over and over again for their economic priorities next year. Let's get more on what the annual Economic Work Committee meeting had to say with Sam Vardas. Hi there, Sam.
Hi there, Mandy. I wish I had $1 for every time that word was used, 25 times in this document. So really stabilising growth is the aim of the game here, setting the tone for the economy moving forward in 2022, certainly as authorities remain on high alert about this slowing growth. Certainly, according to a document from the meeting, which Xinhua managed to get their hands on, officials said China's economic development is facing a triple pressure, they said. And what that is shrinking demand, supply shock and weakening expectations. Yes, economists have pointed out that that is a pretty rare acknowledgement by authorities, but certainly stability is at the core of the Communist Party, particularly as it is heading towards that 20th Party Congress, but also as authorities are really trying to promote a positive image of the economy right now, particularly around the Beijing or Winter Olympics. So some of the big takeaways from this meeting was that China will introduce more tax cuts and front load, so bringing forward some of these policies, really emphasising that this would be done in an appropriate way, conducive to economic stability. China will also pay close attention, they said, to really supporting the job situation at the moment. Officials also calling for a coordinated approach to fiscal and monetary policies, reiterating this flexible and a targeted approach, particularly when it comes to the monetary side of things, with a particular emphasis certainly on helping the SMEs. So that emphasis was largely consistent with the Politburo meeting earlier in the week. They did talk about anti-monopoly and also this houses of living and not for speculation, which does sort of suggest that these campaigns, these crackdowns will continue, but perhaps we won't see this structural reform looking as aggressive as we have seen in the recent year, particularly as they look to more pro-growth in 2022, Mandy.
Thank you very much for that, Sam. Coming up after the break, we're going to discuss inflation data and Omicron, do a strategy session on what it means for your portfolio. We've got Sue Trin of Manulife Investment who'll be joining us right after the break. Do stick around for the interview.
Thailand has built
Welcome back. Let's take a look at these markets. We've got the Nikkei 225 putting on just under 300 points, actually, and the Kospi up by about 17 points. S&P ASX 200 in Australia trading at around 7,388, putting on 35 points. So looking reasonably constructive out here as we kick off the week and as the market seems to have taken inflation in its stride with the US November CPI number. Can the same be said for the Fed this week? Let's find out with Sue Trin, senior macro strategist at Manulife Investment Management, joins us from here in Singapore. Sue, great to see you. If we do see a hawkish pivot, and a lot does rest on the dot plot at this week's FOMC, can we take that? Can we take it over here in Asia, especially India and Indonesia, who were perceived as the Fragile Five?
Morning, Sri. Great to be back with you. Look, the Fed's messaging has done a really great job in terms of priming the market for a much more hawkish pivot. So arguably, it's already in the price. The Fed wants to get taper over and quickly in the next few months, really underscored by Dudley's recent comments that he suggests getting QE over and done with, or the tapering process over and done with by the end of March. Now, the markets have already priced that in. We do feel very cautious on calling a 2022 rate hike, however, given that we think that the growth outlook looks rather uncomfortable, at least for the next 6 months. Now, what it means for Asia in general, India and Indonesia are in a much better position relative to 2013, if that's what you're talking about, where we had the taper tantrum. Yes. Looking at their external balances, much better placed. The run up in terms of hot money inflows, much more subdued relative to 2013. Now, between India and Indonesia, we do think India looks more promising in terms of the moves that the Indian government has made in terms of really focusing on longer-term resilience long after the pandemic is over. Look to their budget earlier on this year, look to their recent asset monetization program, really positive stuff there.
So you said that the growth outlook looks somewhat uncomfortable. Does that imply that Omicron and the path of the virus broadly threatens the recovery out here?
When we sat down and we mapped out the market regime factors for 2022, we really struggled to come up with the upside risks to growth for the first half of 2022. And that was before the emergence of Omicron. Some of the factors that I'm talking about here is the likelihood that China's growth would continue to decelerate, the fact that many governments, many major governments are actually tightening fiscal policy, monetary stimulus is being withdrawn, we're having an energy shock. All of these factors do make us a little bit more cautious for the first half of next year. The good news, however, is that we do see that the second half of next year will be a little bit more promising in terms of the balance of upside and downside risks. Some of the positive factors that we would look to would be the likelihood of an inventory rebuild, acceleration, capital expenditure, and perhaps a complete return to office. Now, of course, Omicron is a little bit of a fly in the ointment. So far, the market is taking it in its stride. It's just simply too early to be making definitive calls as to just what the damage of Omicron is going to be. But so far, the early news does look rather promising to the extent that hospitalizations, deaths do look relatively low relative to the spike in COVID cases themselves. And that's exactly what we want if we want to get on top of COVID.
Indeed, just a couple of weeks ago, the markets were in a full-scale Omicron panic, weren't they? Because, of course, we weren't exactly sure, and we still aren't sure just how deadly this particular variant is. But yet the markets have managed to recover, right? So in other words, is there a lesson to be learned here that as we become more and more immune, if you'll excuse the expression, from a market point of view to bad news on the virus, do you think that buying the dip on any kind of panic with any new Omicron or other variant news could be a good, at least short-term strategy?
It would What's really important here is which market you're talking about. That is certainly the state of Western capitalism, which is that investors are rewarded and have been conditioned to this buy the dip strategy. Every time we see a dip or any kind of hiccup in growth, we're rewarded by injections of liquidity, which is very positive for financial assets. That has been the regime that we've been in, especially since the global financial crisis. A really important pivot now that China is taking is that it's saying, hey, that's not the regime that we want to be in anymore, and we have to actually push back on, and I'm quoting here, the brutal growth of capital. So it's really important which market we're talking about, and certainly is the case in Western markets.
A fair point. And earlier on, you were talking about lingering growth challenges. And I remember a time when we had news on slower growth, that could actually be good news for the markets, right? Because, you'd extrapolate and say, well, it might mean, therefore, that central banks can remain, accommodative with their policy. But I'm wondering how much that is going to be complicated into next year by the fact that we've also got high inflation. So central banks that otherwise might be very keen to remain accommodative perhaps can't afford to be so.
Look, the CPI number out of the US on Friday really highlights that point, nearly 7% year on year. But if you break apart the components and what was driving that spike in inflation, it's energy, it's used cars. In other words, it's supply or the lack thereof. That's cost push inflation, and that's the kind of inflation that central banks really are hard pressed to address in a meaningful way, certainly with the blunt tools that they have at their disposal. What about demand pull? If you've got inflation running at 7% and look at what it means for real wage inflation, we're talking about deflation in some pockets of the economy. So it's really no surprise that the demand pull is really lacking. So this is, plays into one of our many factors for being cautious about the extent of Federal Reserve tightening next year.
So that divergence between cost push and demand pull is really muddying the waters for global central banks. You absolutely nailed it. Thank you very much indeed for joining us with those insights. Sutrinder, Manulife Investment Management. Right, South Korean President Moon Jae-in kicks off a 4-day state visit to Australia. He's the first Korean head of state to visit in 12 years. Moon holds a summit with Australian Prime Minister Scott Morrison today, with cooperation agreements in green tech, as well as defence and cyberspace. Moon will head to Sydney tomorrow, where he meets opposition Labour Party leader Anthony Albanese. You're looking at live pictures there from Canberra, and Australian Prime Minister Scott Morrison addressing the press in a joint press conference with South Korea's Prime Minister Moon Jae-in. We're going to squeeze in a quick break here on Squawk Box. Back in 2 minutes. See you then.
Taiwan's innovation.
Welcome back. Supply chain constraints are reportedly easing for consumer products, but can the same be said for vaccine supply? Shipping vaccines across the world poses its own unique set of challenges, and developing countries without the infrastructure seem to be especially disadvantaged. So where do we stand now, and where do we go from here in 2022 in terms of the vaccine rollout, especially in the emerging markets? Let's bring in Jens Drews, President Asia Pacific at Kuehne + Nagel. He joins us from here in Singapore. Jens, thank you for your time. First of all, question on Omicron and its discovery in South Africa. Does that underline just how vaccine inequality and inequity remains a stark problem for the developing world?
Thank you for having me this morning, Sri, and thank you for being on the program again. When you look onto vaccines and pharmaceutical products, it's very important to see first the specifics to look at this. It's very highly sensitive. Of course, it also then needs to be transported in a time-critical as well as temperature-controlled environment. And here, first, what I like to say is from our side, from the logistics side, in particular when I talk about us as a Kuehne + Nagel, is that we don't see to be a bottleneck in the distribution of vaccines. While I'm saying that, is pharmaceutical companies have very specific requirements on distribution of pharmaceutical products, in particular vaccines. And the high standards that the logistics company has to meet is very much reflecting our investments that we have made already back before the COVID-19 started in 2018. Our pharma network has been highly invested. Let me outline what is very important and what comes down to what makes a difference. For us, the first part that we invested in 2018 is that we doubled our GXP certified stations. The GXP certified stations are the experts on the ground, the muscle on the ground. These are the stations with our people who are working in line with the standards of, for example, the WHO. The second one is that we made a strategic investment into a company called Quickstart. And Quickstart is an expert in critical trial logistics. And the third one is our expansion in logistics hubs, particularly in Europe, USA, and Asia, for example, here in Singapore. So with this, we have already shipped to date 750 million of COVID vaccines, and we are counting. And not only yes.
Yeah, and so would you say that the lessons learned from the past year or so are that the supply chain is now smoother, more effective, and are we now better positioned to deliver the booster shots, particularly to the developing world, at a faster pace and more effectively?
Yeah, what I try to say is that logistics is not the bottleneck. Where the bottleneck is that, of course, manufacturers and countries work very close together and decide eventually where the distribution goes to. And we are working very, very closely together with these network of GXP stations that I just mentioned. And we provide the services and work together in the COVAX program very intensively. So the logistics is not the bottleneck, at least what I can say for us as a company.
Logistics is not the bottleneck. When you consider that we've had almost 2 years living with COVID, Jens, to try and get this right and get it into the arms of the people who need it most, there are still so many countries out there in the developing world, Papua New Guinea, just here north of Australia, even parts of Asia, like, Thailand, the Philippines. Still a lot of people have not been able to get their vaccines. If logistics isn't the issue, what is?
The decision of where to distribute vaccines are coming from the countries in combination with the manufacturers. So, but you're also saying that there is, of course, logistics challenges. And with our investments that we have made, what I mentioned before, for example, with a company of Quickstart, is that we are working with them together and the manufacturing to provide also the logistics infrastructure where it's well needed. give you an example. We have invested and innovated this year so-called temperature pods. These temperature pods were needed in countries where the infrastructure is not there, particularly when you talk about temperature control and cold chain. So they were easy to deploy, very flexible and agile, and helping countries to provide vaccines in the countries where needed. These are countries where we supported the distribution, for example, to Bhutan. I just mentioned one example where we distributed some vaccines as well. What you need there is as well the people on the ground who can handle this. And that's what we're doing through our GXP certified stations. You need this infrastructure. Without that, it is not possible to distribute the vaccines.
Today, we are dealing with COVID-19. Tomorrow, we could be dealing with something else. What have we learned from this crisis, Jens, in terms of being able to distribute pharmaceuticals around the globe? What have we learned that we can apply in the future?
So what we see is why we are confident in our solutions and working with the pharmaceutical companies is because of the investments that has been made before COVID. Our pharma investment started in 2018. It is a time when you have to invest and ramp up your knowledge. It's very important. So this is not something that is new. Vaccines and vaccine distribution was already necessary and required before COVID-19. So, and that's what we invested before in. It's not only vaccine, but also pharmaceutical companies that working on other products that are very temperature and highly sensitive. It is a long-term game, and what it needs is collaboration among different partners. It's not only one company who's able to provide the solution that changes everything.
Right. Thank you very much for your insight. Jens Truus of Kerner and Nagel. Thank you.
Thank you very much.
Coming up after this, we're going to be speaking with the Philippine Secretary of Finance, Carlos Dominguez, about the country's readiness to further ease restrictions from coronavirus to prop up the economy. That interview is coming up next. Don't go away. Welcome back, everybody, to Squawk Box. Well, the Philippines is expected to set a new quarantine alert level later on this week from the current level 2. That's the second most relaxed level. But there are calls to delay easing the lockdown measures as the threat of the Omicron variant has yet to be made clear. So far, the vaccination rate in the Philippines is estimated to stand at only around 36% of the population. Well, Carlos Dominguez is the Philippine Secretary of Finance, joining us now from Manila. Secretary, thank you very much for joining us today on Squawk Box. Let's talk first of all about the easing of the lockdown measures, because obviously there are a lot of things to weigh up. There are always benefits and costs to doing so. Are you prepared to delay the easing of those lockdown measures given this new variant?
Well, let's put it this way. Again, as you mentioned, there are costs to whatever decision we make. However, we are confident that we can better manage and contain this pandemic, whatever variant the virus spawns. For one, our vaccination program is proceeding in scale. We have received, as of the 10th of this month, 156.3 million doses of vaccines. We have vaccinated for at least one shot 92.7 million Filipinos, and for the double shots 37.3 million. We are also well on our way to providing the booster shots for the most vulnerable people in our communities. Our coronavirus, the beds assigned for coronavirus right now are only 21% occupied. Our cases have gone down from a high of 26,000 a day in mid-September to less than 400 a day now. So we are very confident that we can manage these any virus that comes up. Of course, we do that by being very cautious. Thank you.
Mr. Secretary, I've got to ask you about the politics, I'm afraid, and elections in May 2022. What is your recommendation to the incoming president about dealing with the national debt and narrowing the deficit?
I have mentioned publicly a number of times that there are 4 serious issues that the next president will have to address. The first issue, of course, is the national debt. And the real solution to that is to grow the economy so that there will be more business activities that can be taxed, and we can be able to outgrow the debt level that we have. Incidentally, our debt level is only around 62% at the moment, and we expect it to start going down next year. This is, of course, increased from around 39.5% in 2019. Number 2, the second issue that the president has to address is the issue of inequality in our country, mainly because it is the poorer people who have been affected very badly by the loss of jobs in this COVID environment.
Yes.
The third issue is inflation. Inflation which is imported mostly from high fuel prices, high logistics prices. That is the third issue that the president has to address.
Yes.
And the last but not the least issue is the issue of climate change. We are one of the most vulnerable countries in the world to climate change, and we are seeing its effects already now. Thank you.
Mr. Secretary, if you rightly believe that it's important to mitigate and reduce income inequality in your country, then why are you opposed to a wealth tax?
At the moment, we believe that a wealth tax is actually going to end up with a flight of capital from the Philippines. I think most countries have abandoned the wealth tax. I think there are only 3 or 4 countries in the world that are doing a wealth tax. I know for one, France, when they had a wealth tax, a lot of money migrated across the border to Geneva. So this is what we are concerned about. Anyway, our taxation right now is very progressive. We have a VAT, which is a tax basically on consumption, which is and the more you have, the more you tax. The more you have, the more you will spend, the more tax you pay.
And given the fact that there is the national election in May of next year, sir, how confident can foreign investors be that there may be a continuity in policy even if there is a change in leadership?
We have a long history of continuity in the economic field, from the time of Cory Aquino in the 1980s, in the mid-80s, through President Ramos, President Estrada, President Arroyo, then the second President Aquino, and now our financial and economic policies have been very, very stable. Of course, different administrations have different emphasis, and of course, different administrations have different political capital and political will. But essentially, the policies have been the economic policies have been very stable.
What are the advantages of investing in the Philippines as a foreign investor than, say, investing in neighbors?
Well, for one, we have a very robust economy. We are enjoying our demographic sweet spot. Our average age here right now is 25, and we are very well educated. In fact, Filipinos are in demand across the world, and our economy has been growing very quickly. From 2015, when our poverty rate was 23.5%, we brought that down to 16.5% by the beginning of 2019. And we were well on our way to bringing our economy down. Our average growth prior to the COVID was around 6.6% per annum. So this is a very good place to invest. As soon as we overcome the COVID contagion, I believe our economy is going to boom.
Mr. Secretary, let me pick up on that, because the Philippines, pre-COVID, and more so now, arguably, has become a go-to destination for supply chain relocation within ASEAN. Where does that put the outlook for foreign direct investment, longer-term capital in the Philippines in 2022 and beyond, sir?
Well, let's put it this way. Since the CREATE law was passed and made effective in April of this year, so for the first 6 months, foreign investments are already 42% higher than a similar period in 2020. And it is actually 26% high. Foreign investments are 26% higher in that period, April to September, than they were in 2019. So we are seeing a very, very robust increase in our foreign investments coming in, partly due to CREATE, but partly due to the very strong fundamentals of the Philippines.
So can you give us some visibility on green bonds and your plans to issue the Philippines' maiden green bond? When is that going to happen, sir?
Well, actually, the private sector has already issued around $4.6 billion in green bonds. The government, the Philippine government, is about to issue green bonds, and it will happen sometime in the first quarter of this year. Next year, sorry. First quarter of 2022.
And let me just pose a question to you on the back of a report. This is Union Bank of Philippines is saying that it's going to be looking into the report that it's frozen several bank accounts amid an investigation into a report they were allegedly used to receive funds from hacked accounts at another lender. This is, of course, involving criminal activity and also cryptocurrency. And this is an increasing occurrence at banks. What in the Philippines, either you or the central bank, what can you do to try and prevent further such activity from occurring in the Philippines?
First of all, the central bank is on top of this problem. There were two large banks, I think, at the moment that are involved in it or have reported problems with hacking. And the central bank is doing its best to investigate and to close the gaps. We in the Philippine government, I am in charge of the government financial institutions, and we already have enhanced our cybersecurity measures, starting even a year and a half ago. So we are ready for hacking, but of course, well, you know, hackers are very, very smart, but we are taking every step to protect our depositors and our banking systems from criminal activity.
Mr. Secretary, what is your message to the thousands of overseas Philippines workers in sectors from services to shipping in 2022? The pandemic has been very, very hard on them. And if you can also give us a sense of the flow of remittances from those overseas workers in 2022, just what is that looking like?
Well, the remittances actually have not gone down. Actually, up to this year, our remittances are up around 6%. There are, of course, certain areas where our employees abroad have been hit, particularly in shipping. As you may know, we are the largest suppliers of seamen, seafarers in the world. Of course, they have been hit. And I will just say to them, we have protected them when they have returned. We have provided support and jobs training for them. But let me say, as soon as this COVID contagion is beaten, I believe that there will be a surge again in shipping and logistics, and will provide a lot of opportunities for our very well-trained, very efficient seafarers in the Philippines.
That's good to know, Mr. Secretary. Onto the external picture, China's economy is slowing. We know that. China's a major trading partner. And then, of course, the US Federal Reserve is going to start the taper process and tightening. And many are talking about a hawkish pivot and what that could mean for emerging markets in our region. Externally, how would you describe market and economic conditions, and just how challenging would you say the external environment is for the Philippines?
Well, our major trading partners, again, that is another issue that the next president will have to deal with, and it's inequality of growth in our trading partners. We may have to start rethinking our export strategy, given the different paces our trading partners will grow. But we are confident that our major trading partners, which essentially are China, Japan, the US, have the contagion under control and will continue their growth pattern apace. Again, we are also looking very closely at the winding down of support. In fact, here in the Philippines, we are already beginning to wean ourselves from the support that our central bank has provided us, and which is around 10 billion US dollars. We intend to pay that off by June of next year. But starting next month, we are bringing down our debt from 500 some billion pesos down to 300.
And Mr. Secretary, just a very final question on the exchange rate. How would you characterize the level of the Philippines currency, the peso, in terms of whether it is consistent with future export growth?
Well, the Philippines peso has been relatively stable throughout the pandemic. In fact, in 2020, we experienced quite a bit of revaluation. However, since for the last 12 months, I think we have devalued around 5%, which is roughly in the middle of the pack of our neighbors here. And we consider this, the central bank is looking at this very closely, and we are very confident that our monetary policy, our very strong reserves, will not result in very large jumps or depreciation in our currency.
Good to know, sir. We'll leave it there. Thank you very much indeed, Mr. Secretary, for joining us, and great to catch up with you. Wish you all the best, sir. Thank you. Carlos Dominguez, the Secretary of Finance of the Philippines. Now, as we get closer to the end of this year and the start of a new one, CNBC polled 10 top strategists about their investment approach for 2022. You can read all about it on CNBC.com. And hear from the likes of Jim O'Neill and Dan Niles, among others. We're going to squeeze in a quick break. We're back in 2 minutes.
Stay tuned to get a free
Welcome back. A Japanese leasing company Orix's shares right now. Should we take a look? Yeah, why not? Having a good day, up by 2%. Nikkei reports that the company will sell its software business Yayoi to American investment fund KKR. The report puts the sale price at around 240 billion yen, or over $2 billion, about triple what Orix paid back in 2014. The high price tag coming on the back of strong growth in the software as a service market, SaaS, which Yayoi has about a 60% market share in. Forex has been increasingly moving away from leasing due to the fall in interest rates and focusing more on business investment. Mandy.
In the meantime, Sri, we've got a couple of stories out there. Hyundai Heavy Industries is its planned acquisition of Daewoo is reportedly slated for an EU antitrust veto. The South Korean shipbuilders announced the deal back in 2019, but the deal has yet to be given the go-ahead by the EU. The Reuters report saying that Hyundai Heavy offered some remedies, including the sale of a shipyard, which the European Commission apparently rejected as being too little. The Commission has until January the 20th to come to a decision. Hyundai Heavy shares up 2.4%, Daewoo Shipbuilding off by more than 1%. In other South Korean news, South Korea's POSCO is planning to spin off its steel operations and create a holding company. The new structure is aimed at helping POSCO find new opportunities. Should shareholders approve the split in a meeting on January the 28th, it will go to effect on March the 1st. POSCO up by nearly 1.8%, Sri.
Mandy, Malaysia has charged Dyson supplier ATA IMS for violating labour laws. Foreign workers working for ATA allegedly made to work excessive overtime hours and live in appalling conditions. A previous independent audit by Dyson reached a similar verdict, causing the British consumer electronics company to sever ties with the Malaysian firm. ATA has yet to comment on the charges. Right, bringing it back to the markets, and Taiwan comes online at the top of the hour. We'll get you set up for the trading day there when we return in 2 minutes.
4 years ago, I was
We're in the home stretch of Squawk Box, but plenty more to still go, including a preview of how the Taiwanese markets could open up their trade in about 6 minutes' time and counting. Emily, what are we looking at?
Yeah, that's right, Mandy. We're looking at a positive start for the Taiwan market as we get up and running for a brand new week of trade. Futures are pointed up up 0.4%. So this would be a rebound for the TAIEX, which ended the day down about 0.5% on Friday, 17,826. Sentiment getting hit by the discovery of a domestic COVID case. This is of the Delta variant, and concerns that the government could raise alerts, which would then effectively hurt consumption. So we're going to be watching out for some of these COVID-related stocks. We've got a bunch of these mask makers as well as pharmaceutical companies. These vaccine makers are traded in the Taiwan market. Also looking out for TSMC on the back of the company's latest sales numbers for November. It was up 10% month on month. Up on year, it was up more than 18%. The figure coming in at $5.3 billion for the first 11 months of this year. TSMC commanded sales of $51.7 billion. That was an increase of 17%. Flipping over to the Hong Kong markets, coming up online in the next 5 minutes in terms of the pre-market. The market officially opening at 9:30, as we all know, and futures are pointing to a stronger start here as well. Futures up 0.3%. The starting point this morning just tucked under that 24,000 handle. We should easily clear that threshold. A couple of things that we are watching out for today. Any more updates from SenseTime? Last Friday, we were waiting on the pricing of this stock. It was expected to be debuting this Friday, but of course, things have now been derailed because the Biden administration, his Treasury Department, has put the company on an investment blacklist over alleged human rights abuses in Xinjiang, namely the Chinese military industrial complex companies. What this means is it prohibits the purchase or sale of any securities traded on any exchange. So potentially this means that we may not see a debut at the end of this week. We'll find out and get an update. Shri, it's back to you.
Emily, thank you very much indeed for that. That wraps it up for this edition of Squawk-Box. I'm Sri Jayarajan with Mandy Drury. Do keep it here on CNBC as we bring you the rest of the market opens. The Street Science team is coming up next. We'll see you tomorrow.
Be first on top of
Hey guys, we're still trading between this two trend line. We never break up or down, so just be patient. Every time I will do a trade, you will see it here, long or short, and how much profit we made or lost. So you will see the profit or loss in this column, how many lot, and this is long or short, and which currency we will trade. Right now, we are flat.
studio at the Singapore Exchange. This is Street Signs.
Hello and welcome to Street Signs. This Monday, I'm Matthew Taylor in Singapore. These are the top stories that we're watching on the show today. Markets rise following a record high for the S&P despite a hot US inflation print that hit a near 4-decade high. All attention this week now turns to the Fed's final meeting of the year. Japan's Tankan survey showing services sentiment picking up as the economy gradually recovers from the pandemic, but confidence among big manufacturers remaining flat with the outlook still murky. And China looks to support its economy with stable policy, focusing on fiscal support as it wraps up its economic work conference. Happy Monday, everyone. Asian markets are looking positive after we did see a bounce for Wall Street in the Friday trading session despite that hot inflation print. The New Zealand market slightly on the back foot, but we are seeing gains elsewhere. Markets just coming online. Singapore up by about 2/3%, and the Taiwan market better by around about 0.4%. The Japanese markets firm were up by about 1%. The BOJ's Tankan survey showing that confidence amongst big manufacturers staying flat in December, while sentiment amongst the country's large service sector firms improved for the first time in 3 months. But the outlook a lot more uncertain, with big and small manufacturers seeing conditions worsening in the March survey. Well, let's remind you of the lead from Wall Street because it was a strong performance. And in fact, it was the best week that we've seen for a number of the key averages like the SP500 and the NASDAQ since February. We did see strong gains by the close of trade. The Dow up by 216 points, or about 2/3% higher. The three major averages shrugging off another hot inflation print, with CPI for the month of November rising 0.8% month on month, 6.8% on year, and the annualized rate was the highest in around about 4 decades. We're going to be talking about this a lot more on the show, and the implications, of course, for that Fed meeting later on this week. But first, let's go to the Taiwan market. You are seeing the TAIEX higher now by about 61 points, or about 0.3% to the upside. Emily Tan has all of the opening trades for us in the Taiwan market this Monday. Hi, Em.
Hi there, Matt. Good to see you. And a firm start for the TAIEX as the Greater China markets come online on this Monday morning. We're looking at 17,893, a bounce of about 0.4%. Sentiment did get hit last week on the discovery of a domestically discovered case of COVID. This was of the Delta variant, but the concerns do persist about the government raising the alert level and the restrictions, and that entail could hurt consumption on the island. TSMC shares are better for 0.3%. The contract maker of chips, the company reported for the month of November up 10% month on month. That is $5.3 billion. 11 months of this year, 51.7 billion, and that's an increase of 17%. Just a quick scan of the COVID-related stocks, if you will. We have the mask makers and the vaccine makers. And Medigen is the one that makes the vaccines that are currently being used on the island, and it's the one that President Tsai Ing-wen was given. Universal is the maker of masks, so the stock is down 2.6%. Medigen shares outperforming here, up 1%. Flipping over to the Hong Kong market, futures are pointing to a stronger start here as well. So we're following this trend that we are seeing around the region here. Futures up 0.4%. The Hang Seng Index will get started this morning just under that 24,000 handle at 23,995. So the Hong Kong market, along with China, coming online in the next 25 minutes. Matt, it's back to you.
Emily, thank you very much for that. Well, speaking of the mainland China markets, let's also give you a look at what the futures picture is indicating there, because investors will have a slew of macro commentary to mull over after officials in Beijing concluded their annual economic work conference. The suggestions for the open on the mainland bullish, up by more than 1%. Let's go to Sam Vardis now, who has all of the details on what we can expect on the markets and plenty more. Hi, Sam.
Yeah, there's comments on Friday, certainly looking encouraging for the mainland markets, Matt. The key word was stability. It was used 25 times in this document which came out of this. So really setting the tone for the economy in 2022. Stabilising growth is really the aim of the game here, as authorities are concerned about this economic slowdown. According to a document which Xinhua saw, officials said Chinese economic development is facing a triple pressure. And they say this includes shrinking shrinking demand, supply shock, and also weakening expectations. Economists have actually pointed out that this is a pretty unusual, rare acknowledgement coming from Chinese authorities, but they say next year's economic growth should prioritise stability and shoulder the responsibility of stabilising the macro economy. So stability, as we know, is critical for the Communist Party, particularly moving into this next year where they will be holding this 20th Party Congress, as well as wanting to promote an image of a positivity, certainly around the economy, particularly around the Beijing Winter Olympics. Some of the big takeaways from this meeting was that China will introduce more tax cuts and front load. So bringing forward some of these economic policies, emphasising that this would be done certainly in an appropriate way, conducive to economic stability. They also talked about paying close attention to the job situation and also financial risks, and also coordinating fiscal and monetary policies. And there was another big focus on the SMEs. So certainly consistent with the Politburo's meeting last week, as we were reporting on, which economists have said is more pro-growth than this year's. What was different, anti-monopoly showed up, as did this stance, houses are for living and not for speculation. Those are the references to the big, regulatory crackdowns that we have seen. But there has been some suggestion that perhaps those structural reforms may not be as aggressive heading into 2022. So that will certainly be one to watch, Matt, for investors.
Absolutely. Sam, thank you very much. We'll be back with you when the China market opens in about 25 minutes from now. Moving on, let's give you a look at Treasury yields holding steady stateside, just below the 150 level. In fact, we've just managed to creep above that. If you look at the 10-year 150.08 after that hot US CPI reading for November. Will Kalouris has the details and joins us now with more. Hi there, Will.
Good morning, Matt. Yeah, that's exactly right. We did see it coming in incredibly high, both on the headline and on the core level. Let's look at the more important core CPI level. However, that actually printed higher by 0.5% month on month. That 4.9% annualized is actually the highest that it's been since October 1984. And you can perhaps look a little bit deeper into some of these numbers and perhaps strip out the top 5 impacts to the upside when it does come to inflation. You've got used cars up 2.5% month on month, cars up 1.1%, furniture up 0.6%, hotels up 2.9%, rentals up 1.1% month on month. And all of that added 1.89% to that underlying read, that core print of around about 4.9. So it really is 3% if you strip out those one-offs. And that's what's going to be key moving forward, whether or not we do see the stickiness to the upside in a lot of those specific numbers when it does come to this inflation print. But it also has to be remembered, all of this is coming at a time where wages growth is absolutely surging in the United States as well. If you just look back to that last print for November coming out of the Atlanta Fed, it was sitting at around about 4.3%. If you look at the latest US consumer survey, the expectation now for the lowest socioeconomic standing has actually jumped by over 20%. So it's the biggest jump they've actually seen month on month since 1980, about them expecting to see wages increasing moving forward at the same time. So all of this inflation is pushing up, all of these wages growth is pushing up the inflation expectations that we've seen trading at around about a 5% mark right now. So it sets up a very, I suppose, interesting situation for the Fed. And we're getting that meeting coming through next week, Matt.
Yeah, absolutely. This week, it's going to be interesting. What will this hot CPI print mean for the Fed? Of course, we are expecting to potentially hear this week that the central bank will speed up the tapering plans, of course, as we move into 2022.
Yeah, and it will also be interesting when it does come to their, I suppose, rate hike justification, and to explain that. So there's obviously this broad expectation that we are going to see a doubling of the tapering, and that would mean that in terms of that taper being finished, it would finish by around about March as opposed to May on the current schedule of that 15 billion. But also is going to be the language coming from Fed Chair Powell regarding when rate hikes can actually start. And the reason why this is important, so you've got that dual mandate, you've got the issues when it does come to inflation, getting it back within the target or having it excessively above target for in one respect. And basically what Fed Chair Powell said at the last testimony is that it's incredibly likely that part of the mandate is going to be met. So now what it comes to is the maximum employment expectations or the maximum employment mandate from the Fed. Now, is the unemployment rate sitting at 4.2% enough? Probably not. It's probably going to have to go down to below 4%. The part rate will obviously have to kick up to between, say, 62.2 and 62.4, but somewhere thereabouts in order for that maximum employment to be met. So the reason why that's important is there is now a lot of people that are suggesting, well, hang on, the Fed could be hiking as soon as March. Some are suggesting that the first hike will come in September. But then at the same time, you've also got to look at it from the perspective, Matt, that there could just be the runoff of the balance sheet, perhaps 1 or 2 hikes, and then just letting the maturities on those bonds keep expiring. So then you're drawing down the balance sheet and only having a limited amount of hikes. So it's going to be interesting which way Powell wants to go and whether or not we get any signals from him later this week in that respect.
Absolutely. That's what everyone will be watching for. Well, thank you very much for that. Well, it's not only the Fed this week. We do have a very busy week when it comes to central banks. The ECB, the BOE and the BOJ will all meet this week too, while in the emerging markets, Bank Indonesia, the Philippines Central Bank and the Turkish Central Bank will also be out with policy decisions. Well, let's get some analysis now and bring in Tai Hui, Asia Chief Market Strategist at JP Morgan Asset Management, joining us from Hong Kong this Monday. Thank you very much for joining us and great to see you there. As we move into 2022, potentially now a third year of double-digit gains for the markets, a third year of living with COVID and potentially a third year of double-digit gains. How bullish are you going into 2022? And do you think that we can see, because to use that cricket terminology, a hat trick for the markets in 2022?
Well, I think we are pretty constructive on risk assets going into 2022, largely on the back of the fact that we're still expecting global growth to maintain their pace. You've seen, as Sam mentioned earlier, China is starting to relax their fiscal policy. That should provide some stability. Europe and the US, they're very much in the middle part of the economic growth cycle. I would argue that Asia and emerging markets are still yet to really make full recovery from COVID. So with all those in mind, I would think that risk assets, especially equities, are in a pretty good shape. That said, because of valuations, because the earnings growth is going to come off from the peak of 2021, I think the return target or the return momentum will be a little bit less ambitious compared to this year. But nonetheless, I think compared to, for example, government bonds or fixed income, equity should still outperform.
What could potentially hit or disrupt that rally as we move into 2022?
I think 3 things. The Fed's schedule in terms of raising interest rates, I think they're still trying to do this in a fairly orderly fashion. But as inflation and also the job market, as you mentioned earlier, continues to shift, if the Fed had to raise interest rates much more aggressively, obviously that could create additional volatility. But to me, the biggest issue is probably still COVID. The Omicron variant has created a bit of a scare. I think markets now starting to calm down. But nonetheless, I think we're still working through a lot of the uncertainties with future variants and whether vaccines and medication will be able to cope with future variants. And the last one is China. I think, again, the good news is that the government is very much aware of the slowing momentum of the supply side shocks of expectations. I think, from that perspective, while it is a risk factor, I think that's much more manageable compared to COVID or the Fed.
Could a faster liftoff, though, from the Fed? We know it's been well telegraphed, but could that spook markets, particularly in light of the inflation data that we did get out on Friday as well? We've been running through that 4-decade highs when it comes to the pace of inflation growth there that we're seeing. What do you make of that? Because we know that the Fed has, of course, dropped the transitory phrase when it comes to how it's viewing inflation. It sees it as a little bit more sticky. So if we do see a faster liftoff path, could that potentially disrupt the markets?
Well, I think that's why this week's FOMC meeting is really, really interesting and really, really important, because while we can discuss and debate whether it's going to be end of 2022 or mid-2022, some people even said, as you mentioned earlier, March 2022, to me, is not just about the first liftoff, it's also about the subsequent pace of interest rate increase. Now, the Fed so far has been quite conservative when it comes to how fast or how aggressive they'll raise rates in 2023, 2024, still, at least for now, predicting 2 to 3 hikes a year. If that were to be true, it's still a very gradual rate hike cycle. And don't forget, even by the end of 2023, maybe even mid-2024, real policy rates is still going to be 0, maybe slightly negative. So overall, I'm still expecting a very gradual rate hike cycle, which means that policy accommodation will still be with us for quite a long time. And therefore, a lot of the income assets, such as high yield corporate debt or emerging market fixed income, even high dividend stocks, will still be in strong demand.
Right. When you break that down then for investors in the Asia Pacific, how does that all translate into investment decisions that you're making in the Asia Pacific markets? You mentioned that you're still constructive when it comes to risk. So across equities, is there a market in particular that you like? You were talking about China before. It, of course, trailed its peers when it comes to market performance this year. Are you anticipating something better for China markets as we move into 2022?
I think so. I think we still advocate a globally diversified equity allocation, but rather than focusing on the US and Europe, I do think 2022 should allow investors to rotate a little bit more back to Asia as well as China. As you rightly said, China has trailed in 2021 because of regulatory changes, because of a lot of the economic pressures that the government is now recognizing. I think that policy shifts to be more supportive of growth should be a positive. And then for the rest of Asia, it's been very much driven by export performance. But with rising vaccination rates, I do think that more Asian governments will be able to reopen in a much more sustainable way in 2022. And that should allow domestic demand, tourism flows to resume. And that, again, should provide some upside surprises to corporate earnings.
Okay, let's go through sectors. We're just putting on the screen there some of your calls, in particular healthcare, tech. Unpack that for us in a little bit more detail, geographically where, and of course, they're fairly diverse sectors out there. Is there a specific part of tech and healthcare that you like?
For tech and healthcare, to me, it's a much more long-term portfolio construction component. So it's not necessarily just for 2022. If anything, with rising rates, tech and healthcare tends to come under a little bit of pressure. But I do see potential corrections or a downside on these markets to be really interesting entry points for long-term investors for the next 2 to 3 years, even 3 to 5 years in building the portfolio. Obviously, the US technology sector continues to be in really good shape if you think about their potential long-term growth. China, despite all the regulatory issues, I do think there are new emerging areas in technology, for example, semiconductors, software, even some of the renewable energy that belongs to the tech sector. I also think they will be quite interesting. And even some of the darlings of the last 10 years, internet, e-commerce, once they've acclimatized to the regulatory environment, I do think the valuations start to look really interesting.
Tai, thank you very much for joining us on the show today. Tai Hui there from JP Morgan Asset Management. We've got the daily yuan fix in as well. The PBOC setting the yuan midpoint at 636.69 against the dollar versus the last close of 637. Remember that we've been seeing a lot of strength coming through in the Chinese yuan, particularly over the last week or so. There was a little bit of intervention there going on at the end of last week to try and stem the strength that we've been seeing in the Chinese yuan, and the midpoint set today at 636.69. If you also want some more investment advice as we head into the new year, head to cnbc.com, where our colleague Tanvir Gill has been surveying several renowned market strategists, including Jim O'Neill and Guy Spear, to get their 2022 investment ethos. There's a link there on your screen if you want to go and read about everything that they've had to say and their predictions for the next year. Well, coming up next on the show, G7 foreign ministers signalling out Russia and China in their latest statement with a stark warning to Moscow. Those details next. Welcome back. Well, the G7 is warning Russia against attacking Ukraine in meetings hosted by the UK Foreign Minister Liz Truss in Liverpool.
Is that the world's largest economies are united. We've sent a powerful signal to our adversaries and our allies. We've been clear that any incursion by Russia into Ukraine would have massive consequences for which there would be a severe cost.
Well, the group called on the Kremlin to de-escalate tensions at the border. Russia denying plans to invade Ukraine, saying the West was gripped by false assumptions about it. Speaking to NBC's Meet the Press, the US Secretary of State Antony Blinken said that the G7 countries were prepared to act in a coordinated way if necessary.
There is something even bigger at stake here, and it's the basic rules of the road of the international system. Rules that say that one country can't change the borders of another by force. One country can't dictate to another country its choices, its decisions, and its foreign policy with whom it will associate. One country can't exert a sphere of influence over others. That's what Russia is purporting to assert. And if we let that go with impunity, then the entire system that provides for stability, prevents war from breaking out, is in danger.
Well, the US Secretary of State will be kicking off his first official trip to Southeast Asia since President Biden took office. He arrives in Indonesia today and will then head to Malaysia and also Thailand. He will seek to further the administration's Indo-Pacific strategy, rallying a united front amid China's rising power in the region. Well, the G7 also signalling out China in its statement, saying that they're concerned by Beijing's coercive economic policies. The CEO of the Abu Dhabi Sovereign Wealth Fund, Mubadala, which owns chipmaker Global Foundries, speaking to Hadley Gamble in an exclusive interview, and he weighed in on the state of US-China relations and the implications for the UAE.
It is in the interest of everyone to have a global integrated economy. That's served us well in the past, and I think will help in the future, not just the United States, but I would say every country around the world. So I think I am personally of a view that the issues we're seeing today are quite substantial, particularly between some countries, the United States and China here specifically. But I think they're not issues that are insurmountable. When I look at it in the context, and you've asked me that question as a business leader, I see it very plain vanilla from my perspective. The United States is the world's largest economy. China is the second largest economy.
For now.
For now. And in a matter of time, China will be the largest economy. You know, is it 5 years? Is it 10 years? Is it 20 years? People will take different views, but it will happen at some point. In today's lens, these are the two largest economies in the world. And for any investor, for any business leader, and for any supplier of anything, having access to these markets, to these two markets particularly, but having open access, I think is very, very important. So anything that helps maintain an environment that allows that access and allows companies and of course countries to benefit from open trade, I think this is conducive for growth. Yeah. So back to me. We're as a country here in the UAE, a country built on commerce, trade, growth. That's what we're all about. We trade with East, we trade with West, North, South, we trade with everyone. That's what's been the foundation of success for the UAE over the last 50 years. And when you look at the next 50 years, if anything, we're doubling down and tripling down on that. And to do so, we have to continue to grow with the West, the United States, Europe, South America. We have to also double down on the East. These are incredible economies. China, India, Japan, Korea, very important markets. Markets that we've had, I would say, exceptional relationships over the last 50 years, and relationships that we want to grow. So we want to be in that middle. It's a good position for us to be in the middle, and it's a good position for us to continue to be an objective, commercially conducive investment location, but also investor in this growth story.
Well, coming up next on the show, we have the Hong Kong and mainland China markets coming in line. In just a few moments, we'll have all of the opening trades for you when we come back right after this.
Power Lunch.
Happy Monday. We've got Hong Kong and China markets coming online, and the Hang Seng Index managing some gains on this first early minutes of trade with gains of about 1%, 24,242. 8 shares are better for 1% as well. The tech index also tracking higher by the same magnitude. Just a quick look at some of these heavyweight stocks before we move on. We got Tencent, Alibaba, and Meituan all tracking higher rather than 2%. So this should be a sector that outperforms if these gains continue to hold. Alibaba shares now bouncing closer to 3%. I'll pull up shares of Hong Kong exchanges and clearing. This is another one we're watching because we were slated to have SenseTime debut on the Hong Kong market come Friday, but that has all been thrown into jeopardy now with the U.S. Treasury Department blacklisting the company, putting on its Chinese military industrial complex companies list. This is over alleged human rights abuses over in Xinjiang. The company was supposed to price its shares last Friday, helping to raise as much as $767 million. That did not happen. What we can expect now is that this should be delayed because they're going to have to update their prospectus. They've got U.S. investors like Silver Lake with a 3% stake. Fidelity is another one. They're going to have to sell out of this in order for this to proceed because of this latest development in terms of it being on the investment blacklist. So throws things into disarray for SenseTime. Hong Kong exchanges with all these geopolitical moves expected to be a key beneficiary with more listings into the city here. The stock is up 1.25% at 474 and change. Just a quick mention of Sun City. The shares taking a nosedive today, down more than 5%. This as the company, in a form of a letter to its employees widely distributed on the internet, has announced the complete cessation of its business. This after previously we had the company's former chairman being arrested by Macau authorities for crimes including alleged money laundering. So this, as we're watching Sun City Group shares are down 1.5%. Summit Ascent shares, also a company linked to Sun City, down 7.25%. So that's what's going on here in Hong Kong. Let's get over to Sam for an update on the early moves in the Chinese markets. Good morning.
Good morning, and thanks very much for that. And as expected, we are seeing mainland Chinese shares joining the trading week, the new trading week, on a higher note. The Shenzhen Composite sitting up around 0.4% at the get-go. We are seeing the US dollar Chinese yuan, meanwhile, changing hands at 6.362. It comes after the PBOC, of course, called time on the Chinese currency's rapid rise last week. So certainly keeping an eye on that this week as well. We did see the CSI 300 index actually rallying to over 3%, which was a 20-week high last week off the back of certainly a lot of these encouraging comments coming from Chinese authorities, the PBOC with that RRR cut. Looking ahead, of course, we do have data coming out of the mainland this week with those housing prices, but also that trio of economic indicators. So certainly investors waiting for some direction from all of that this week. But certainly in the meantime, we have had some more encouraging commentary coming from Chinese authorities wrapping up their annual economic work conference on Friday. This is, of course, where they thrash out China's economic direction for the next year, really setting the tone for 2022. Stability was the key word here, as authorities are really on high alert in the face of this slowing economic growth. They did say that China's economic development is facing a triple pressure at the moment, including shrinking demand, supply shock, and weakening expectations. And so some of the big takeaways was certainly tax cuts and also front loading, bringing forward some of these policies, paying close attention to the job situation, preventing financial risk, and also a coordination of these fiscal and monetary policies. But we've got Ronald Wan waiting in the wings here. He's the non-executive chairman at Partners Financial Holdings, joining us from Hong Kong. Nice to have you with us this morning, Ronald. Let's start with that economic work conference, which wrapped up on Friday, certainly setting the tone, as I said, for 2022. Stability, that word was used 25 times in this document. How confidence building is that for headline growth in 2022, and what are the sort of implications for the markets? I mean, certainly some of these comments have looked quite encouraging for investors.
I think the overall projected annual growth rate for next year will be something like 5 to 5.5%. But actually, we've seen slowing down in economy right now. So a lot of policy measures has been taken up by the Chinese government right now. At this point of time, I think what the market has been focusing on is to cut in interest rate, because we've seen the cut in RRR ratio last week, and also adopt certain targeted reduction in interest rate. But see, now what we are focusing on, whether there would be across all spectrum, a general cut in interest rate, that it would be very essential to maintain the momentum for the small and medium-sized enterprise, as well as release the debt burden and financial burden of a lot of companies. That would be something essential, to maintain the momentum for next year. If there will be a cut, of course, I think the general market performance and also the conditions will be improving.
Yeah, let's unpack that a little bit more because, of course, in this document, policymakers are certainly pledging more support in 2022 and front-loading some of these policies, as they call it. What do you think that will actually look like? And also, do they cut again in February, do you think?
I think, first of all, as I've mentioned on, there would be certain, monetary fiscal policy, to be adopted by the Chinese government. But what is more important is to stimulate the domestic demand. Basically that will be one of the key engines of the Chinese economy. The trading, export, import sectors, which actually has been beyond the control of the Chinese government, but talking about the domestic consumption, that would be something which the government can do. Basically, they're trying to stimulate the demand by, stimulate the rural area, consumption market, and also to shift certain demand, from the city area to other, relatively remote area. That would be something which we'll be looking at, and also which we have to look at the fixed asset, investment element. The government may adopt a softer measures, against the property sectors. If all those composite measures can be adopted, I think, generally speaking, I think the overall market will be improving. Also, the cut in interest rate in the first quarter in next year may be possible because that will be something what the market has been looking for, and also it will definitely help to improve the market sentiment as well.
Right. How do you navigate the recent strength that we've been seeing for the Chinese currency, for the Chinese yuan? And what's your expectation as we go into 2022 about the levels on the currency, and how does that impact investment strategy and your investment decisions?
I think at this point of time, I don't think a strong renminbi is something the government wants to see, because it definitely will affect the export sectors, but it will help, to release the, inflation measures, because a lot of commodities has been imported from other countries. But talking about the general policy of China, basically they want to have a weaker renminbi, in next year. So what I have mentioned earlier on, a cut in interest rate definitely will, soften the renminbi, exchange rate. At the same time, we see certain inflation, pressure in the state, and an increase in interest rate in the state will definitely create a hedging effect between renminbi and US dollar, and a weaker renminbi will be resulted as well. So I think what the government is trying to do right now is to calculate the exact timing of the interest rate cut. I don't think there would be any cut in this year. Most likely will be the first quarter of next year, and a weaker renminbi will be resulted in next year.
Okay, let's talk about your investment strategy then. You say that you're liking things that are really linked to domestic consumption. And I guess that makes sense if you say there's going to be, of course, more stimulus going in to support the domestic side of the economy in China as we move into 2022. So what are some of the sectors then that you'd be interested in either adding to or perhaps discovering for the first time?
No, for the Chinese economy, for a lot of investors, a lot of people will be interested in certain specific domestic consumption sector, which will be focusing on the new energy car and also certain domestic retail or manufacturing sectors, because we all know that Winter Olympic is coming up in February. So a lot of policy have been taken up by the Chinese government to stimulate certain sport area and also some clothing, sectors. Basically, we would expect, positive, expectation in those areas as well. And also, what I have been focusing on right now is that Chinese government may cut the interest rate. So basically, I think the property sectors will get certain benefits as well, because most of them have been in heavily debt. and the financial burden has been heavy. If the cut in interest rate can be expected in the next quarter, basically, I think the overall property market will be improving as well.
Okay, Ronald, we have to leave it there. Thank you very much for joining us on the show today. Ronald Wan there from Partners Financial Holdings. And Sam, we'll check back in with you a little bit later on. In the meantime, we're off for another short break right now. The UK raising its COVID alert level as the Omicron variant threatens its healthcare system once again. Those details right up to the break.
Tune in for Tech Chat.
Right now, we don't have any trade right now. You can see nothing open, buy or sell. Every time we open a position, you will see it here in this area. If we don't have nothing, the screen is gonna be like that. We said Aussie dollar, I'm waiting to break this line or break this line. If we break higher, we're going 50 pips up. If we break lower, our target will be 50 pips down. So if we stuck between these two lines, I'm not doing anything. That's why we are flat right now. Now, the best signal right now, CAD-yen. So let's see CAD-yen.
Welcome back. The UK raising its official COVID-19 threat level to 4 at the weekend, saying that the rapid spread of the Omicron variant has pushed the country into more risky territory. According to the chief medical officers of England, Scotland, Wales and Northern Ireland, the healthcare system is at risk of becoming overwhelmed given the more transmissible nature of the Omicron variant. Prime Minister Boris Johnson also issuing a warning about vaccinations, saying it's unclear if 2 doses will be enough to combat the new strain.
No one should be in any doubt. There is a tidal wave of Omicron coming, and I'm afraid it is now clear that 2 doses of vaccine are simply not enough to give the level of protection we all need. But the good news is that our scientists are confident that with a 3rd dose, a booster dose, we can all bring our level of protection back up. I know there will be some people watching who will be asking whether Omicron is less severe than previous variants and whether we really need to go out and get that booster. And the answer is yes, we do.
Well, let's bring in Dr. Kavita Patel, now non-resident fellow of the Brookings Institution and former Obama White House policy director, joining us from Washington, D.C. Thank you very much for being there and great to see you. Let's talk about the Omicron strain, because it's now been a few weeks since, of course, it really made headlines because we know it was discovered last month. But are we any closer to knowing anything more about the severity of this strain, about how effective vaccines are in combating it, and any other information that we've been waiting to find out?
Yeah, Matt, we're getting it in pieces. We know a couple of things. We know it's more transmissible, more than Delta even, so it's easier to give and to get. But we have had some really reassuring signs and signals from South Africa and some neighboring countries in Africa, where they have had an incredible number of cases, but have not seen the severity that we had really hoped we could avoid. So that's good news. In terms of vaccines, there have now been a number of studies done, including with the Pfizer vaccine, that demonstrate that indeed, as the UK Prime Minister mentioned, a booster dose does give you more antibody production that they believe will hold against Omicron. We're still seeing that from lab data, Matt, and we'll have to kind of align that with real world data, but it is a positive signal. Now it just becomes a scramble across the globe to have enough shots to do first shots and to do booster shots.
Yeah, absolutely. Let's talk about this variant then in a little bit more detail. And we were just referencing there, we are seeing a spike in cases in a number of jurisdictions around the world. Yes, the Omicron variant might be more transmissible, but data is also suggesting that perhaps it isn't as lethal, or it isn't as deadly, or it doesn't have the same strength when it comes to previous variants that we've seen, like Delta. Should nations then be worried, be raising alert levels like we're seeing, if in fact this strain is less severe than prior ones?
Yes, and I think the reason to raise those alert levels now, Matt, are really because, unfortunately, it takes several weeks to see that severity, and we have to watch it closely. It is reassuring, as you point out, that we haven't seen that lethality, but we don't want to wait until we see it in order to take precautionary measures. And unfortunately, we still have so much of many of our countries that we're talking about, many countries in Asia, the UK, the Americas, that are just simply not vaccinated enough to begin with. That exposes, unfortunately, billions of people. Even if it's mild illness, Matt, this is something that's easy to give. And the more people we give it to, also think about it this way, more chances to mutate. And we don't want this virus to have that many chances at staying alive and mutating into possibly something more severe. And so that's all the reason to raise the alarm levels up across the world.
Right. You said that you're closely watching the numbers that we're seeing in the United Kingdom, for instance, and elsewhere. What does it tell you about the trajectory then of the pandemic as we move into 2022? Are there signs that things are slowing down and we're moving from a pandemic to an endemic, or is it just going to continue whilst we have these variety of new strains coming through?
Yeah, I wish that I could say that I'm seeing enough signs that we're moving into that endemic phase. Unfortunately, the numbers just do not support that. But here is good news. We are seeing that where we do have these pockets of vaccinated regions, parts of France, parts of the UK, even parts of the United States, that we see less of the severe outcomes, less deaths, less hospitalization. We're still seeing sheer numbers of cases, Matt, but they are not as severe. So overall, I take that as a positive signal that if individuals are vaccinated, they can start to kind of live more normal life than they had before. And I think employers and businesses are also starting to mimic that by allowing people to return to work. So 2022 as a forecast will be a better year, but we'll still see cases and unfortunately deaths that go with it.
Right. When do you see us moving from, of course, the pandemic phase to the endemic phase, or is it simply too early to be able to tell that? And given the case numbers that we're seeing around the world jumping at the moment, how much do you put that down to a number of course, international borders now reopening? We know as we've moved into the holiday season that governments have been keen to reopen borders and allow people to either return home or visit friends and relatives. How much do you think that that is exacerbating the transmission of the latest variant?
You know, it's interesting on the transmission and borders. We have learned that travel restrictions simply do not work. They might buy countries a matter of days to help identify a plan or a path forward, but they simply just do not stop the virus from spreading. And we really do see the spread not from international travel or between country travel. We really do see spread within countries, within states, within local regions because of social habits. And I do think that, for example, the United States testing requirements will make a significant difference in ensuring that people who are sick identify themselves earlier and simply do not travel, do not get on the plane if possible. And then in terms of when we can kind of see the shifting to a pandemic, to an endemic, it is too early to tell, but I do hope that the COVAX and the World Health Organization kind of postulating that we'll have a majority of the globe vaccinated by hopefully Q3, Q4 of 2022, that's when I know we can all breathe a little easier because this should be endemic as most of the globe is vaccinated. But we have a long way to get there.
Right, absolutely. Final question for you, because it's interesting. We look at some parts of the world where there are high vaccination rates, yet there are still a number of new cases, a number of new infections, a number of new clusters. Yes, the hospitalisation rates may not be as high, but I wonder, once we do get to that point in Q3 or Q4 of next year where the majority of the world is vaccinated, we are still going to see outbreaks cropping up. And despite the fact that we have seen cases less severe in those that are vaccinated, governments don't appear to, I don't know, take that on board. They still get worried about rising case numbers. They still want to lock down. They still want to put in restrictions to prevent those that perhaps haven't been vaccinated or are more vulnerable. So is this something that will just continue, do you think, until, I guess, the virus is eradicated, if that's something that epidemiologists and physicians out there think that is possible?
I do think it's possible. I don't think it's possible to eradicate the virus, but I do think it's possible to shift our policies from just looking at sheer case counts to starting to understand where is there true severity or lethality, to your point. We're just starting to see that shift where we're seeing the hospitalizations and deaths decoupled from the numbers of cases. That's an important trajectory. That's an important kind of set of numbers that we'll have to look at so that the next surges, which we know we will have, that the next surges, when they happen, that we don't just use crude case counts. We're going to have to start to shift to what we think we need to count in order to implement some of these mitigation procedures. And I hope that does not mean lockdowns, because they simply don't work.
Dr. Patel, thank you very much for your insights on the show today. Dr. Kavita Patel there of the Brookings Institute. Thanks very much. Well, elsewhere today, we are watching another developing story. It's been nearly 2 days since a string of tornadoes tore across the United States, with officials now trying to assess the damage as they search for survivors. NBC's Kate Snow reports.
Volunteers going door to door.
Anybody here?
Heavy equipment working all day long, cleaning up on a massive scale.
You gotta tear down and rebuild.
Yeah, this town's going to look. It's not going to be the Mayfield that all of us knew. It's going to be a different town, but we'll make it Mayfield.
On a cold, sunny Sunday across Kentucky, people picked through the debris of their lives. And at Mayfield Consumer Products Candle Factory, some good news today. Owner Troy Probst telling us Saturday afternoon they rescued 2 workers after locating one of their cell phones.
Everybody's trying to call everybody, and I think as some of the debris is getting removed, assuming that allows, more signals to get through some of the rubble and different things.
They reached someone in the pile?
Yes, somehow.
But the company tells NBC News at least 8 workers are deceased, 9 unaccounted for.
How many kids?
Between the 2 of us, we have 8.
Autumn Kirks came here to meet with coroners. She still can't find her boyfriend, Joe Ward. They started working at the factory just weeks ago, trying to save up to buy a house.
I don't know what to tell him because I don't know. And not knowing is worse than knowing right now. He was within 10 feet of me in that hallway.
That's the last time you saw him?
And I have not seen him since.
She's trying to stay strong for her kids.
I love you so much.
Denise Cunningham hasn't eaten or slept much since Friday. She called her 21-year-old son, Devin Burton, after the tornado hit, and a coworker answered.
And they're all screaming for help. All she could tell me was that my son told me that he loved me, that he didn't think he was going to make it.
110 people were inside the factory that night.
If you knew the weather was coming, was there any thought to maybe suspending production?
In hindsight, of course, I think all of us would do something differently because the path the storm takes. But by the time you know that that's going to come, it is such a gamble to say leave, because the last thing you do, it says don't get in your car.
Workers say there were warnings around 7:30 that night, but no tornado. Some employees left. Edward Stubblefield says he thinks his cousins had to stay.
Had to be. If not, you lose your job.
Some families saying the factory should never have been open that night.
They knew it was coming, and they kept those poor people in that factory working. And I am more than angry. I think that they should be held accountable for everything that has happened. There was plenty of warning.
Coming up next on the show, shipbuilders Hyundai and Daewoo's tie-up could face a big roadblock by the EU. We'll have those details when we come back.
This is not just a mind.
Welcome back. Well, some stocks that we are watching today in South Korea, the tie-up between shipbuilders there, Hyundai Heavy Industries and rival Daewoo, is reportedly facing an EU antitrust veto. This after both companies declined to offer solutions to ease antitrust concerns. Hyundai saying on Friday it expected unconditional European Commission clearance after regulators in Singapore, China and Kazakhstan gave approval. The European Commission is set to decide by January the 20th. We've got Daewoo shares weaker, Hyundai shares though moving slightly higher. Coming up on the second hour of Street Signs, Brii Biosciences wins China's first approval for COVID-19 antibody therapies as an additional treatment option amid a rise in local cases. We'll speak with the company's CFO in the next hour of Street Signs.
We're committed to see.
Hello, you are watching the second hour of Street Signs here on CNBC. I'm Matthew Taylor in Singapore, and these are the top stories we're watching for you this Monday. The rally rolls on. Asian markets starting off the fresh trading week on a positive note as investors look to a slew of central bank meetings that will be headlined by the Fed over the duration of this week. A roller coaster ride for Sun City shares as the stock resumes trade in Hong Kong. The Macau gambling group confirming a loan default at a company led by its controlling shareholder. And Binance plans to withdraw its application to run a crypto exchange in Singapore.
Live from CNBC studio at the Singapore Exchange, this is Street Signs.
We are seeing gains right across markets in the Asia Pacific this Monday to kick off the fresh trading week, and things look fairly constructive as well. We're seeing the Japanese market up by around about 1%, 0.8% higher for the South Korean market. The Jakarta market just joining the trading session, higher by around about 0.5%. Gains elsewhere, of course, on the back of that strong performance that we did see on Wall Street on Friday, despite the fact that we did get hot inflation numbers. Well, let's go to the Greater China market. Shanghai firmer by about 0.9%. But the outperformer, take a look at Hong Kong, half an hour into the trading session, and we've got a gain of 1.6%. Let's get out to Emily Tan for all the movers there in the Hong Kong market. Hi, Em.
Hi there, Matt. And we're seeing a nice spike in the Hong Kong listed shares today, outperforming, as you mentioned, higher by 1.6%, 24,382. 8 shares, better for almost 2%. Tech shares, the outperformer, up 2% as well. We got ATNM traded higher, with Baba being the big leader here, up 4.4%. And Meituan not too shabby as well, with gains of closer to 5%. So we're seeing a nice, strong performance in the Hong Kong market today. But a couple of things I want to bring to your attention as we continue to track Hong Kong exchanges and clearing and this expected influx of new listings into the Hong Kong market, with the increased geopolitics and potential delistings of Chinese tech companies in the United States for various reasons from Chinese side and the U.S. side. But we're also tracking what's happening with SenseTime as the company by the U.S. Treasury Department getting blacklisted in investment blacklist, and this throws into array the company's planned debut here in Hong Kong on Friday. They did not price the shares as planned last week. $767 million expected to be raised. A delay is expected because now they have to update their prospectus, and now that the expectation that the U.S. investors can no longer touch this company, they do have U.S. shareholders like Silver Lake with a 3% stake and Fidelity as well. So all of this does need to be worked out, and China's largest AI firm. We're also looking at shares of Sun City. A couple of developments here, as the company in a letter to its employees says that is officially announcing its complete cessation of its business. The Sun City Gaming Promotion Company, this is the operators of the junkets. The company, in view of the force majeure factors currently encountered, the company regretfully announces termination of its business with immediate effect from December the 10th. Sun City shares, though, bouncing today. So it's kind of been all over the place, opening lower by about 6%. But now we're seeing a huge rally in the stock, up 5%, last done at 15 cents. Matt, it's back to you.
Emily, thank you very much for that. Well, let's go over to, of course, the mainland China markets now. And we could see more fiscal support after the country's leadership wrapped up its annual economic conference. Sam Vardas is back with us to tell us all about those details. Hi again, Sam.
Hi there, Matt. And yeah, authorities really wanting to stabilise growth now, certainly looking forward to economic growth in 2022. They are concerned about this economic slowdown that we have seen. And so they are talking about front loading, bringing forward a lot of these policies, particularly when it does come to infrastructure investment. They are looking for a coordination between this fiscal and monetary support, and also preventing any financial risks, and also trying to boost domestic demand. They're also, talking about a lot of support for these SMEs, which was certainly consistent with the Politburo's meeting that we saw last week, which economists said has been very pro-growth compared to the aim of the game this year. But it does come, as authorities have said, China's economic development is facing the triple pressure now when it comes to shrinking demand, supply shock, and weakening expectations. Economists have said this is a bit of a rare acknowledgement by Chinese authorities, but these officials are saying that next year's economic growth should prioritise stability and shoulder the responsibility of stabilising macroeconomy. So certainly some of those comments looking encouraging for the markets, which have already been boosted by the monetary easing that we saw last week with that triple R cut. We are seeing that CSI 300 index extending those gains we saw last week, up around 1.5%, getting a lift from those consumer staples stocks up around 2.5%. I do want to quickly mention the COVID situation, though, because we are now seeing 100 new cases on the mainland yesterday, 80 of which are locally transmitted and 74 of which are in Zhejiang province. And I do mention that because we have now seen a number of companies listed saying that their production has been suspended because of some of the restrictions in that province around these COVID curbs. And so these are some of the companies we are talking about. We're seeing HomeLink, for instance, down almost 5.5% at the moment. That is based in Ningbo, which makes plastic goods. So not a good day. We are, Matt, seeing the economic cost of some of these very tight restrictions over in China.
Yeah, absolutely. Sam, thank you very much for that. Well, it is, of course, a big week for central banks with the Fed decision, of course, the big one that markets will be glued to. Policymakers will have the latest inflation print to mull over, which show prices accelerating at the fastest pace in decades, of course, on Friday, and that could further up the Fed's timeline for tightening. Will Kalouris joining us now with those details on what to watch ahead of that Fed meeting this week. Hi, Will.
Hey again, Matt. Yeah, and the key is going to really be what form of tightening if it does get accelerated, because yes, we do know, we are very aware that there's this growing expectation that we are going to see the taper accelerating somewhat coming through at this meeting. But when it comes to the tightening, that we're going to obviously get those dot plot expectations at the same time, but it's just how fast the Fed decides to get when it does come to its rate hikes moving forward, because there are a number of tools at its disposal that aren't necessarily centered around hiking the cash rate over there in the United States 4 times in the space of 1 year, because they can also utilize their balance sheet. And this is something that a lot of people are now pointing to as perhaps the way forward for the Fed, in particular when you're trying to transmit that monetary policy in a way that you don't necessarily want to spook the markets or mess with the risk-free all that much. So there is this growing, I suppose, call that instead of, say, for example, having, like I mentioned, 4 rate hikes coming through in 2022, or once every quarter, you could have an initial 1 or 2 hikes coming through from the Fed in 2022, perhaps one in March if they do this accelerated taper, because that would mean the tapering stops by March at the current rate of tapering. And then you could have 1 hike there, another hike in June, and then just utilize the retiring of the maturing securities on the Fed's balance sheet. And that would act much in the same way as if you had been hiking across the board, because it basically does exactly the same thing, Matt, and it doesn't necessarily impact the markets in exactly the same way. But all of that being said, with that hot inflation, with the Fed doing whatever it is doing right now, if you look at the US Treasuries, if you look at the S&P, the markets aren't necessarily thinking we're going to see an excessive amount of hikes coming through in 2022 anyway.
Well, we'll wait and see this week. Thank you very much for that. Well, let's talk about inflation, because it will also be top of the agenda as G7 finance ministers meet later on today. Economists warning that high inflation could persist into next year, hurt by supply bottlenecks and rising wages. The COVID situation with the Omicron variant spreading and climate concerns will also be on the agenda for those ministers. Well, let's bring in Alexandre Tavazzi now, global strategist and head of CIO office at Pictet Wealth Management, joining us from Hong Kong. Great to see you there, and thank you very much for joining us. You say that the economic cycle still has some way to go, so can we deduce from that you're still bullish on markets and suggest that the party, when it comes to the rally that we've seen, isn't over yet?
It's not over yet because of the way the companies are operating. If we exclude any Omicron new wave, then we should be having a global growth of around 4.5%, which is above its normal potential rate. So judging from there, earnings are going to grow by about 10% in the US, 8 to 15% in other places of the world. If on top of that you add on buybacks and dividends, then as an equity shareholder, you're pretty well rewarded. Probably something between 8 and 13%, depending on the markets. But definitely equities are the best place to be, even with a small rise in inflation rate.
Okay, 8 to 13% returns then. What could trip up that rally, though? You talked about a few things initially there when it comes to, of course, virus variants. We're also talking about a normalization of monetary policy in the United States and by other central banks as well. What is a caveat to that call on the markets there that could potentially trip up any rally or any more gains as we move into 2022?
Well, the obvious one is Omicron, because we don't have a lot of information about it. What we know is that it is less serious than Delta. And by the way, the European government are still fighting against Delta. Omicron is not yet the reality. But should authorities decide to lock us down once again because of Omicron, then the whole growth scenario will be at risk, of course. But what we hear so far is that the symptoms are lighter with Omicron than compared to Delta. So we have big hopes that this is not going to happen. The second thing which you have mentioned is a policy mistake. We know that central banks want to raise interest rates, but gradually so, as we have just heard. And the market is already there. If you look at the 1-year forward curve in the US, it already anticipates 2.5 hikes in interest rates. So we think this is already within the market scope. But of course, should they go for higher interest rates or maybe a quicker tapering, that could be an issue from the market point of view.
Okay, let's break it down to this part of the world then. If you're looking across the Asia Pacific with all of this in mind, which market stands out to you as one that will probably outperform the others as we move into 2022? Because we know that the China market didn't perform as well as some of its peers across Asia over the course of this year, 2021. The Japanese market, yes, we saw a bit of a rally around what was going on with the political situation there and the shift to a new prime minister, but things there perhaps stalling a little bit as well. So what do you like then across Asia Pacific?
Yes, we do like ASEAN countries because they have a very interesting feature. Their economy was hurt in 2021 by the COVID. And actually, when we look at which countries are going to have a higher growth in 2022 compared to 2021, ASEAN countries stand out as the base effect as we go into 2022 is going to be rather strong. So it's one of the few areas on the planet where the 2022 growth rate is going to be higher than 2021, which on the earnings side for equity holders is going to be a positive as well, outpacing the rest of Asia. And then you have mentioned Japan, which has an interesting feature, 10% of a fiscal spending compared to GDP. This is going to hold up the Japanese economy. So these are two areas where we have high hopes. When it comes to China, we need to know further measures. We have a stability measures being taken. It's probably too early to go back into Chinese equities. For two areas stand out, ASEAN countries and Japan for the time being.
Let's unpack China in a little bit more detail then, because last week the topic du jour was really what was going on with the embattled and indebted property names, where we did get, of course, ratings agencies saying officially that they were in default when it comes to the likes of Evergrande and Kaiser. Is this still going to be a risk, and how much of a risk to investors in China as we go into 2022? And there was, of course, earlier this year, a lot of fear about contagion as a result of what's going on in the property space there. But as yet, it doesn't appear as though that has materialized.
True. I think these two cases are a reminder to all of us that we need to be active investors and choose company by company according to its own benefits. I think these are liquidity issues that we're dealing with on specific companies. But as we have heard and seen in the past weeks, some measures were taken so that a few companies' cases do not result in a global credit crunch for all of the rest of the other companies. And actually, we've seen some other companies being able to issue bonds, albeit at a pretty high price. So we see those measures containing the contagion in a few cases where already going into the crisis, those companies have the liquidity issues. So we think for those companies, unfortunately, time is out and it's going to be difficult for them to recover fully. But for the rest of the market, the recent measures that were taken allow us to think that other companies being in this market to try to refinance their debt will have this possibility, and hence we avoid a major banking crisis. And we don't think that we're going to have a property crisis as a whole in China, but just concentrated on a few of them.
Yeah, earlier on the show, we were talking about, of course, stimulus coming into the Chinese economy as we go into 2022. And one investor in China said that you really need to look at what's going on when it comes to domestic consumption, because that will obviously be a beneficiary of the stimulus that we see go into the Chinese economy. And I know that when it comes to one of your top sectors in your investment strategy, again, it's a shift towards services. Talk to us about that.
Well, this is something we see on a global basis, but in China it's going to be the case because initially when the economy reopened, it was all about goods consumption. People went back into the streets, were open, and were able to trade goods. Now, we think services is going to be the next leg because we're more and more able to consume things that were close to us, which is travel, restaurants, and the like. And actually, this is where we're starting to see prices on the services sector starting to moving up. Of course, the key issue here is whether consumer spending will be hurt by what goes on in the property sector. As I said before, as the measures of containment have been taken, we don't think this is going to be an issue. So basically, the second stage of the recovery, the second stage of the reopening is moving consumption from goods into services, which is in a way helping the economy to maintain a high growth rate.
We have to leave it there. Thank you very much for joining us, Alexandre Tavazzi there of Pictet Wealth Management. Thanks very much for those insights. And if you want some more insights as well, as we head into the new year, move over to CNBC.com, where Tanvir Gill has been surveying several renowned market strategists, including Jim O'Neill and Guy Spear, getting their 2020 investment ethos. There's a link on your screen if you want to find out exactly what they're suggesting. Well, coming up next, G7 foreign ministers turn up the heat on Russia, warning Moscow of severe consequences if it invades Ukraine. The US Secretary of State outlining what is at stake. We'll have that interview coming up for you after the break. My favorite app? Well, the G7 issuing a stern warning to Russia at the foreign ministers' meeting at the weekend. The ministers condemning the Russian military buildup at the Ukrainian border, urging Moscow to de-escalate and pursue diplomatic channels. The group warning of quote-unquote massive consequences and severe costs if Russia attacks Ukraine. The US Secretary of State Antony Blinken spoke about that on NBC's Meet the Press.
Our strong preference would be for a more stable, predictable relationship with Russia. But if Russia continues to take reckless and aggressive actions, we will respond. And not only us, partners and allies around the world. That's why I was at NATO just a week ago. That's why I'm here at the G7 meeting. And I think what people need to understand is that Ukraine is important, and we are resolute in our commitment to its sovereignty, its territorial integrity. But there is something even bigger at stake here, and it's the basic rules of the road of the international system. Rules that say that one country can't change the borders of another by force. One country can't dictate to another country its choices, its decisions, and its foreign policy with whom it will associate. One country can't exert a sphere of influence over others. That's what Russia is purporting to assert. And if we let that go with impunity, then the entire system that provides for stability, prevents war from breaking out, is in danger. That's why this is so important. That's why the president's been very clear with President Putin.
Why hasn't the action of Russia amassing troops and terrorizing Ukraine right now been a trigger for any punishment?
Well, it's been a trigger for action. It's been a trigger for us bringing together allies and partners around the world, starting in Europe with our closest partners, NATO, again, where I was just a couple of weeks ago, bringing people together to make very clear not only the deep shared concern, but the fact that we are prepared together in a coordinated way to take very strong action if Mr. Putin continues his aggression against Ukraine. So we now need to see whether he's not only received the message, but responds to it. And there is another way forward. That's something else the president suggested to President Putin. And I've done the same with my Russian counterpart and others, and that is diplomacy. Russia and Ukraine agreed many years ago to something called the Minsk Agreements, a way of diffusing the crisis in eastern Ukraine, giving Ukraine its border back. And what we'd like to see now is actually Russia implementing its commitments under that agreement. We're going to test that proposition together with our European allies and partners and see how Russia responds.
But the fact that he's able to amass troops at the border, get a video conference, and now, by the way, Vladimir Putin wants a face-to-face meeting. I'm curious, is that at all on the table?
Look, the video conference is important because as much as I can do with my counterpart, as much as other colleagues in the government can do with theirs, when it comes to Russia, President Putin's the one person that really counts, and it's very important for President Biden to speak directly, clearly to him, so that he understands from the leader of the United States exactly what he risks if he pursues aggression with Ukraine.
I don't mean to sound cynical here, but we've heard that rhetoric for 7 years through 3 administrations, and Putin's behavior just hasn't changed.
Well, what we've seen in recent weeks and recent months is concerning signs of an accumulation of forces on the border, plans to commit renewed aggression against Ukraine, which is exactly why we brought countries around the world, but starting in Europe, together to make it very clear that there'll be very severe consequences for that. President Putin has to make his calculations. He has to decide ultimately what's in Russia's interest. He'll make those calculations. We've been very clear about what will follow if he renews his aggression on Ukraine.
If Germany were more open to essentially shutting down the Nord Stream 2 pipeline, do you think Vladimir Putin would pay more attention? Does he think Europe basically is keeping the U.S. from doing more?
Well, that pipeline, Chuck, as you know, doesn't have any gas flowing through it right now. And in fact, it's a source of leverage on Russia, because to the extent President Putin wants to see gas flowing through that pipeline, if and when it becomes operational, it's very unlikely or hard to see that happening if Russia has renewed its aggression on Ukraine, if it takes renewed action. So I think President Putin has to factor that in too, as he's thinking about what he's going to do next.
Well, Secretary Blinken will be arriving in Indonesia today as part of his visit to Southeast Asia. It's his first official trip to the region since President Biden took office, and will also be headed to Malaysia and Thailand. It's part of the administration's Indo-Pacific strategy amid China's rising power. Ahead of that, the US imposed extensive human rights sanctions on individuals and entities tied to China. Myanmar, North Korea and Bangladesh were also targeted in that list. China's embassy in Washington denouncing the move as a serious violation of its internal affairs. Coming up next on the show, we'll bring you the details of Japan's latest read on the Tankan survey. Sentiment amongst the country's largest service sector firms was up for the first time in months. More details after the break.
Stay tuned to get a free
Welcome back. Well, the Japanese market about to head into the lunch break right now. The Nikkei 225 is moving higher. You can see there on The heat map at 0.9% moved to the upside, 252 points higher. And we've got the dollar yen rate holding fairly stable around 113.53. The Bank of Japan's Tankan survey showed business confidence amongst the big manufacturers staying flat in December, while sentiment amongst the country's large service sector firms improved for the first time in 3 months. But the outlook here is a lot more uncertain, with both big and small manufacturers seeing conditions worsening in the March survey, and rising costs were an issue within the inflation outlook at the highest level since 2015. Let's give you a look at how some of the blue chip stocks, that's what I'm trying to say, in Japan are faring. It is a bit of a mixed bag. Sony firmer, but we've got some weakness for Toyota, off by about 1.6%. Toshiba is also lower as well, trading down by 1.3%. Coming up next on the show, the Fed holds its last meeting of the year this week, and we'll discuss what's in store and what it could mean for the US dollar with our next guest right after this break.
Halftime report.
Welcome back. Let's give you a look at the Forex majors right now. We've got a little bit of upside coming through for the US dollar index, 96.142, but only a very slight move to the upside. Elsewhere, euro dollar 113 even, Aussie dollar 71.67, the yen 113.51. Now let's show you cable as well, 132.56 there. The Chinese yuan looking like this Monday, the spot rate 636.16. Well, let's bring in Koon Go now, head of Asia research at ANZ Bank, joining us now from Singapore to talk more about the FX markets. It's really a big week when it comes to central banks and, of course, the Federal Reserve. What did you make of the inflation print we got Friday stateside, and is that going to influence anything at this FOMC meeting this week?
Well, the inflation numbers pretty much came in line with expectations, but still at the highest in almost 4 decades. You got to say inflation is an issue in the United States, and it's set to stay elevated for some time. And even if it moderates in the second half of next year, it's likely still going to stay well above the Fed's inflation target for some time. That's why we anticipate the Fed will have to increase the pace of their tapering at their meeting this week, and we think they will start to wrap up their bond purchases by March next year, and that really gives them the flexibility to start hiking rates earlier than initially anticipated, most likely sometime around June or July next year.
Right. What would the pace of the tightening then look like if we get lift off the first hike in June or July? Is it one and done in 2022, or do you see multiple moves out of the FOMC?
I very much doubt it's going to be a one and done, given that interest rates are pretty much at levels that are inconsistent with how fast the U.S. economy is expanding at. This is the start of a policy normalization. Having said that, I don't think the Fed will be moving at every single meeting. At this stage, we're looking at 2 rate hikes next year. Potentially 3 if inflation remains an issue. Let's not forget that given the high level of indebtedness in the U.S. economy, each 25 basis point rate hike by the Fed this time will have a much more powerful impact than previous rate hikes before, which is why we think they will continue to tighten in a measured manner.
What's your outlook for the US dollar index then, if we, of course, do get a hastening up of the speed of the taper, and then indications that we'll get a lift off in rates middle of 2022? We've got dollar index sitting just above the 96 level at the moment. How much more upside is there in it if we do have a decidedly more hawkish central bank?
Look, I believe the US dollar will stay firm into the early part of next year, but I don't believe the US dollar is set to rally much further from here. The main reason is that the market is largely already pricing in around 3 rate hikes by the Fed next year. And even if you looked at how the US dollar reacted last week to those inflation numbers, it didn't really rally too much on a
Okay, I think we've lost Kun Go there. We'll try and get his signal back up. But in the meantime, we will move on right now. Give you a look at what's going on in the oil patch, because we'll be watching for OPEC's monthly oil market report later on today. Now, prices have been rallying and turned in the best week last week since August. Goldman Sachs global commodities head Jeff Curry expects prices to head towards $90 a barrel from next year.
One thing that's apparent going into year end, just given the volatility, is that risk is going to be slow to come back into this space. We don't think until after the first of the year that you start to get a lot of risk ready to put positions on. They get a clean slate after January 1st. At that point is when we think you get the real upside back towards $90 a barrel.
The latest round of Iran nuclear talks resuming over the weekend. The UK says there's still time to save the deal, but that it was Iran's last chance. While Tehran says good progress was being made on the negotiations in Vienna, but remained critical of European powers' stance on the deal. Iran accusing the European parties of not bringing constructive proposals to the table to help revive the deal. Well, those talks will centre at the discussions. Those talks will come rather as we also get discussions between the Israeli Prime Minister Naftali Bennett during a visit to the UAE today. His arrival marks the first official visit by an Israeli leader to the Emirates. Bennett will meet with the Abu Dhabi Crown Prince as he looks to strengthen ties with the Gulf amid the ongoing tensions in the region. Israel has previously mentioned the prospect of joint defences with Gulf Arab states that are also concerned over, of course, Iran's activities. All right, well, let's go back out to Kun Go, Head of Asia Research at ANZ Bank. We lost you there for a minute. You were just talking about your expectations for the US dollar going forward, but let's move beyond that. And if we do, of course, see a faster taper and then tightening out of the Fed, which currencies do you think will come off worse as a result of that? Okay, not having much luck today with Kun Go, so we're going to head off for a break right now on the show. Coming up next, Brii Biosciences wins China's first approval for its COVID-19 antibody therapy as cases rise. It's also looking for approval in the US. We'll speak to the company's CFO about all of that coming up next. Well, let's get you an update on the COVID situation around the world right now. COVID-related deaths in the United States hitting the 800,000 mark, according to a Reuters tally. The country seeing more loss of lives due to COVID this year than 2020, despite widely available vaccines. This is due to the more contagious Delta variant and also vaccine hesitancy. The nation now bracing for another possible surge this winter as the Omicron variant spreads. Well, the UK raising its official COVID-19 threat level to 4 over the weekend, saying that the rapid spread of the Omicron variant has pushed the country into more risky territory. According to the chief medical officers of England, Scotland, Wales and Northern Ireland, the healthcare system is at risk of becoming overwhelmed, given the more transmissible nature of Omicron. The Prime Minister Boris Johnson also issuing a warning about vaccinations, saying it's unclear if 2 doses will be enough to combat this new strain.
No one should be in any doubt. There is a tidal wave of Omicron coming, and I'm afraid it is now clear that 2 doses of vaccine are simply not enough to give the level of protection we all need. But the good news is that our scientists are confident that with a 3rd dose, a booster dose, we can all bring our level of protection back up. I know there will be some people watching who will be asking whether Omicron is less severe than previous variants and whether we really need to go out and get that booster. And the answer is yes, we do.
Meanwhile, researchers in Israel have found that the Pfizer-BioNTech booster shot provides significant protection against the Omicron variant. The results from the study are similar to what the 2 vaccine makers presented earlier last week, increasing hopes that the 3rd dose can help protect people from the new variant. Well, here in Asia, shares of Brii Biosciences are currently trading like this, weaker by about 12%. This is despite China approving the use of its neutralizing COVID antibody therapy for adults and minors aged 12 to 17. The combination of drugs showed an 80% reduction in hospitalizations in its phase 3 clinical trial. A report on the effect of the drugs on the Omicron variant is likely to be released in the next few weeks. The FDA, meanwhile, is reviewing the drug for emergency use. Well, I'm pleased to say that Angang Lee, the CFO of Brii Biosciences, joining us now for a First on CNBC interview live from Shanghai. Great to see you there, and thank you very much for joining us. Explain to us how this treatment that you've developed works in fighting COVID-19.
Sure. So our Amulbarbimab and Romlusevimab, they are 2 neutralizing antibodies that were originally obtained from human bodies. They were produced by human bodies to attack the virus specifically to block the entry into the cell and to clear them. So we utilize the human nature of this immune system to attack the viruses.
Okay, as we were just outlining there, you've received some approvals in China. How widespread is the use of your drug at this particular moment in time? And what are your expectations on how widely used it will be going forward?
We just got approved, so we are working with the government, different government agencies to talk about government stockpiling of our antibodies. And so far, before it's got approved, we have worked with Chinese government to provide emergency treatment for many patients. I think right now we already treat more than 900 patients in China. And we did a very large scale phase 2-3 study outside of China. And that provides enough evidence that this treatment is effective against the COVID-19 disease.
Right. We mentioned there in the introduction that when it comes to the work that you're doing on the latest variant, the Omicron variant, there is still some work to do. Can you share with us any update on the efficacy of your treatment when it comes to combating the effects of the variants, the different strains that we're seeing?
Sure. Actually, we just announced that we received the results from a number of independent labs showing that our antibodies remain active against the Omicron variant. So we are very excited about this. And this proves that our combination strategy is a good one, because from the beginning, we decided that using one single agent, one antibody, will be in high risk if the virus develops into multiple mutations. But with two complementary antibodies, we see that our antibodies remain active against all the variants of concern. So we are very happy to see that, and we believe that it will be important to fight Omicron and all the future variants.
We know that in particular parts of the world, there has been a lot of vaccine hesitancy. Now, I know that your treatment is not for a preventative vaccine measure, so to speak, but how do you combat these kind of thoughts out there within the community when it comes to vaccine hesitancy and people perhaps not wanting to get COVID treatments? Is that something that you've struggled with, trying to convince people as to the benefits of some kind of medicinal treatment?
Sure, I think people need to understand the science better. I think, using the vaccine and the antibody treatment will be good for the community, for the entire human being, to fight against this COVID pandemic. So we definitely will urge people to get vaccinated and also use the necessary treatment when they get infected.
What work have you done on your treatment being mixed or being used in conjunction with the other raft of vaccines that are already out there in the marketplace?
We haven't done much with the vaccinated population yet. I think in our trial, we have mostly involved the people without vaccination. But certainly when we use the medicine to more people, we'll get more evidence about the effectiveness and also how they interact with the vaccination.
You, of course, have received your approvals in China. You're also in discussions with the United States. But where else will you be targeting next to try and get this antibody approved, this antibody series approved, and of course rolled out in other countries? What's next on the agenda for you?
Yeah, so we are prioritizing the countries in which that we conducted our phase 3 trials, which include South Africa, Argentina, Brazil, Mexico, and a few other countries. So we are a small company, and we are open to work with our partners to provide the widest access to as many patients as possible.
Are you working with any agency to try and distribute the product to those places that have a very low vaccination rate? Parts of Southern Africa, when we're talking about the Omicron strain, there are low vaccination rates there. Are you talking with anyone about potentially putting your product out there in the marketplaces that are underserved or have low vaccination rates at this current juncture in time?
Yeah, we're certainly talking to many partners, and including the areas you mentioned. So we'll be active in those conversations and try to broaden our reach globally.
Okay, well, we wish you luck with it. Thank you very much for joining us to give us your insights today. Ankang Lee of Bri Biosciences there. Thank you very much for joining us. Well, let's go over to Australia now, because in that country, Australians are gearing up for quarantine-free travel ahead of Christmas. The state of Queensland reopening its borders to domestic travellers for the first time in 5 months today. Qantas says it will fly nearly 10,000 passengers to and from Queensland on Monday on about 100 flights. Western Australia will also announce its plans later today. Around 70 cases of the Omicron variant have been detected in Australia so far. Let's give you a look at how the travel stocks are trading in the Australian trade today. We do have a weaker performance for the likes of Flight Centre and Webjet. Some of the other travel agency firms there moving higher though. The broader S&P ASX 200 trading to the upside today. We're gaining about 0.6% on the ASX 200, 44 points firmer at 7,397, Aussie dollar at 71.66. And Crown Resorts looking to open its Sydney casino early next year after it ran into regulatory problems. The casino had its license suspended shortly after opening in December last year following reports of ties to organised crime groups. Well, coming up next on the show, Binance is withdrawing its application to run a crypto exchange in Singapore. More details on that when we come back after this break.
Why are millions of
Welcome back. Well, Binance's Singapore entity is withdrawing its application for a license to run a crypto exchange. The move would end the company's efforts to open a regulated crypto exchange under the Monetary Authority of Singapore's supervision. Binance Singapore will close operations by February the 13th, and its Asia business will instead focus on blockchain. Well, Bitcoin prices back above the 50,000 level. They were just a short while ago. 48,769 is where we sit. The Ether price, 3,977. But prices did move back above 50,000 overnight. Now, amid the rise in investor interest for digital currencies, the Abu Dhabi state fund Mubadala says it's investing in the ecosystem around cryptocurrencies, as the CEO tells our own Hadley Gamble in this exclusive interview.
This is a business that had, $200 billion worth of crypto value 2 years ago, and it's $2.5 trillion today and growing. So I think, while many people are skeptics, I do not fall in that category. I think now I see it as real. Now, I think the regulatory environment that isn't there yet in its final form, and will have to be there at some point, I think will come in and will help, I think, transition this asset class into something new. From our perspective, I think we look at the ecosystem around crypto, and I think we are investing in that ecosystem. That's in the blockchain technology, energy usage, etc.
Well, venture capital firm Andreessen Horowitz recently invested $36 million into blockchain infrastructure startup Miston Labs. This after earmarking $2.2 billion to invest in cryptocurrency-related stocks earlier this year. The firm's general partner spoke to CNBC's Julia Boston about why he's excited about the space.
We are right on the precipice of a big technology transformation. Web3
which really has network effects at its core. If you look at a cryptocurrency like Bitcoin, I find it valuable because you think it's valuable. These NFTs like Bored Apes and games like Axie Infinity, these are all products that where you need a community, you need a network of folks to be excited about it. And anyone building these products faces a cold start problem because they have to get the right Discord communities and the right people excited about their projects from the start. Otherwise, they just won't work. And so this has been a really interesting area of investment for us. In particular, I'm very excited about the convergence of video games and Web3. It's a big area for me and something where I am spending a ton of time.
Andrew, can you have multiple cold starts? I'm thinking about Clubhouse, and sometimes it seems like, a snowblower, you're trying to prime the pump and then pull it, and sometimes it stalls. It seems to have had multiple starts and catch momentum and then not. From behind the scenes, what do you do when you see something like that happen? What kind of advice do you give to founders and operating teams to get momentum going again?
Yeah, well, I think first, Clubhouse is such an interesting example of the cold start problem because they really figured out how to solve it very quickly. They got launched in the tech community and they just went completely viral. And in under a year of the app being out, they've been able to go from 0 to millions of daily active users. But I think that when you examine all of these products, what you find is that network effects is not a silver bullet. It's not something where you get it and then everything just automatically works. Even Facebook actually had various starts and stops, a half dozen on their way to being a huge product. And I think that my book really is meant to encompass all the tactics and strategies that you need to do to face this down as you are trying to grow your product.
That's interesting. What does it say about the level of financing or capital that you need to achieve escape velocity to the point where if your user growth, for example, flattens out, your existence is not somehow threatened as a whole?
Yeah, well, I think the most powerful part about network effects as a concept is that you can use your network. So imagine Uber, for example, using its network to ask people to refer other riders and other drivers into the network. You can use your network to re-engage people. So if you have a dormant user that's churned, if people are all of a sudden sending messages to them inside the platform, they'll come back. And so all of these reasons are why these network products actually, if you look historically, have been able to reach hundreds of millions of users, billions of users, without actually spending tons of money on marketing and advertising. And as a result, all that venture capital funding, my job is to, of course, to invest in these companies, ends up being spent on product development and on the team and not on all that customer acquisition cost along the way. And so that's one of the really appealing parts of these kinds of companies.
Well, let's give you another check on how the Asian markets are faring this Monday. It is a positive start to the trading week. You can see we've got all of the major markets tracking higher. The outperformer, it's been the Hong Kong market for much of the session with a gain there, as you can see, of 1% for that market, 240 points higher. We're also seeing a strong performance in Japan as well, the market there gaining almost 1%. And also in the mainland China markets, the Shanghai Composite firmer by around about 0.75%. This, of course, follows a strong lead in from Wall Street on Friday. And let's give you a look at US futures ahead of the Monday trading session stateside. Things also looking like there will be some positivity coming through. The implied open for the Dow up by some 132 points ahead of the first trading session of the week, which of course will be dominated by, of course, that central bank Fed meeting. Well, coming up in the next hour of Street Signs, the pandemic prompting technology disruptions such as the rise of virtual banks across the world. We'll explore the disparate growth of digital banking across developed and emerging nations with one expert in the next hour of the show.
Be first on top.
Welcome back. You are watching the third and final hour of Street Signs here on CNBC this Monday. I'm Matthew Taylor in Singapore. These are the top stories that we're watching on the show today. SenseTime will reportedly cancel its Hong Kong IPO until further notice after it was blacklisted by the US. The process could start as soon as today. Asian markets holding on to gains, taking a raft of central bank meetings this week in their stride. And oil prices building on last week's rally, shrugging off concerns about the Omicron variant.
Live from CNBC studio at the Singapore Exchange, this is Street Signs.
Very constructive performance for markets across the Asia Pacific this Monday to kick off the fresh trading week. Of course, we did see a strong performance in the United States on Friday, despite those strong inflation numbers. But you can see right across the Asia Pacific markets, we are seeing strong gains. Japan up by almost 1%, 0.5% to the upside for the South Korean market. Australia, New Zealand in the money. New Zealand was weaker a little bit earlier, just moving higher now. China and, of course, Hong Kong and the mainland doing well too. The Shanghai Composite, 0.8% higher and almost 1% firmer when it comes to the Hong Kong market, which is the rank outperformer in the region today. You can see we've got the Hang Seng Index 221 points higher there. Emily Tan has been tracking all of the moves for us and is joining us now once again with the latest on the SenseTime Hong Kong IPO, which apparently not happening now. This was something we were following at the end of last week, and we're getting some more details out today as well. Hey again, Em.
Hi there, Matt. And it is unlikely because of the latest development coming through from the Treasury Department in the United States following the addition to the U.S. blacklist. It is now a Chinese military industrial complex company that's over alleged human rights abuses in Xinjiang. And what we're seeing in reports now is that the IPO is delayed until further notice. This is what is being reported, and an announcement from the company should be made as soon as today. This decision is still subject to regulator approvals. On Friday, we were expecting the company to price the shares. That's according to the IPO schedule for its $767 million Hong Kong IPO with that debut that was originally meant to happen on Friday. But this was all thrown into disarray following it being slapped with a blacklist on investment. So what that means is it prohibits the purchase or sale of any securities traded on any exchange, not just in the US, but also here in Hong Kong. And of course, that brings into question, well, what happens to the US shareholders like Silver Lake, which holds a 3% stake, and Fidelity as well. So this delay is expected, and we're going to be waiting to hear that official update from the company. But on Saturday, they did issue a statement saying that we strongly oppose the designation and accusations that have been made in connection with it. The accusations are unfounded and reflect a fundamental misconception of our company. We regret to have been caught in the middle of geopolitical tension. So that is a statement that was issued by SenseTime on Saturday. We are waiting on the official announcement from the company, and this is China's largest artificial intelligence firm. Matt, it's back to you.
Emily, thank you very much for that. Well, let's give you a check now on how the US futures picture is stacking up ahead of the Monday trading session stateside. And we are seeing positivity for the three major averages, which is indeed supporting the tone across the Asia Pacific markets and trade this Monday. Well, the three averages shrugged off another hot inflation print on Friday, with CPI for November rising 0.8% on month and 6.8% on year. That annual rise was the highest in nearly 4 decades. Well, Will Kaloris has more and has been tracking everything that's been going on with the CPI data. The market's dismissing it, but it's unlikely that the Fed will do the same this week.
Very unlikely, Matt, in that regard, because they are obviously going to be keeping a close eye on, I suppose, perhaps the nature of the inflation that we are seeing, because there are, again, a number of different ways that you can look at it. You can see these top line headline numbers and be, I suppose, aghast at the fact or the rise in which we have seen inflation coming on over the course of the last few months. You can look at the underlying inflation numbers on a 3-month basis and see there is a relatively stickiness to the upside when it comes to some of those components like services, like food, like in terms of even car sales. But at the same time, if you're thinking about it from the concept that this is a relatively easy comp for the inflation numbers to beat, you might find yourself within the camp that a lot of people are suggesting that by H2, once all of the H2 2022, once all of the supply chain issues are likely to be cessated, once you have a lot of this stimulus coming off, that we might see a little bit of an easing of inflation. So that is what's probably going to have to be where the Fed does decide to act in a sense. So are we going to see at the meeting this week basically them suggesting they're going to accelerate the tapering program, doubling that to 30 billion? Are we then going to see a little bit of a shift in their mentality? I was looking over some of the commentary coming from UBS, for example, and basically what they're suggesting the Fed is going to likely do is that by the June meeting, they're going to decide to start a balance sheet runoff program. This is basically what we were mentioning earlier, letting some of the securities to mature. So it's not necessarily rate hikes, but it's another policy transmission method that the Fed can utilize. And they actually think that they're going to hike in September of 2022. Now, another firm over at RBC Capital Markets, they're basically of the thought that the Fed could hike as soon as March, once the tapering finishes, Matt. But then all they have to do following on from that is just do that balance sheet method, and then they've got that cover. They can keep the markets happy and not hike rates too much, but they're still transmitting the monetary policy. So it's going to be interesting to see if Powell gives any clues later this week about his line of thinking when it comes to how that monetary policy is going to look in 2022.
Absolutely. We'll find out this week. Will, thank you very much for that. Well, let's go to Timothy Mo now, co-head of Asia Macro Research and Chief Asia Pacific Equity Strategist at Goldman Sachs, joining us from elsewhere in Singapore. Great to see you there. Thanks very much for joining us. You say that the global macro backdrop is looking less favorable as we move into 2022. Does that mean equities are looking less favorable as well?
It does, Matthew, but it's important to note that we still prefer equities among other asset classes. So the very quick story is that the twin forces of economic growth and monetary policy are going to start becoming more adverse for risky assets. So growth is obviously going to slow from its post-COVID recovery highs. It's almost inevitable that happens. And as many people are aware, the Fed is likely to start the tightening first by enacting the taper and then by starting to raise. We actually just changed our views on what the timing of the Fed first hike. We think that will be in May of next year. Previously, we were looking for June. So basically, the sort of the twin pincers of slower growth and higher rates are something which typically is not as favorable for risky assets. But it's important to note that the levels are still favorable. Growth is still good and financial conditions are still accommodative. So we roll all that together and it says to us, we think equities can still perform, but just not as well as we've enjoyed in past years. So that's sort of the broader macro backdrop that we're looking at for 2022.
Right. So you don't think that this normalization to policy, whether or not it's the Fed or other central banks around the world, will be a catalyst to turn markets around that have seen a pretty impressive performance over 2021?
Well, I think it really depends upon where you're looking. For Asia, which obviously is the area that I'm particularly focused on, we've had quite poor performance this year, led by China, as I'm sure everyone is well aware. We actually made a call to upgrade our view on China because we felt a lot of bad news had been priced in, and we feel that the risk reward looks favorable now for reasons we can perhaps discuss later. I think the risk to some of that might come perhaps from the United States, which, as you just said, has had a very strong year, up roughly 25%. And so the potential for some sort of a pullback, could be there, although that's not something that we're explicitly calling for. And indeed, we're looking for the S&P to rise to 5,100 by the end of next year, which would from current levels be high single digit to pushing 10% up from current levels.
Okay, well, talk to us about some of your calls then. You were just talking about China there. I note that you've upgraded China to overweight based on an improving cyclical factor and inexpensive valuation outlook as well. Is this also based on what we've seen over the last week or so as well? We got the RRR cut out of China. There's talk about a lot more stimulus coming in to really prop up and support the domestic economy there.
Well, that's right, Matthew. We feel gratified and encouraged by the developments which are taking place subsequent to the call we made, which is about a month ago now. And to be more specific, we're seeing some signs of easing of monetary policy, the triple R cut, as you've mentioned, but also some other aspects as well that were mentioned in the Central Economic Working Conference, which just ended. So there's a somewhat more accommodative tone there. We think China policymakers are trying to walk a reasonably narrow path between being somewhat more accommodative from cyclical perspective, but not foregoing the structural strategic intent to not overstimulate and not to deviate from the larger objective of reducing aggregate leverage levels, particularly in the property market. So we think that will roll up to is a somewhat more accommodative fiscal stance. We're looking for the augmented fiscal deficit to rise from 11% of GDP to 12%, so about a 9 percentage point additional increase there. And then for some additional moderation in terms of monetary policy. And together, we think that constructs a more favorable cyclical backdrop, which the market would probably enjoy and seems to be pricing favorably at the current point.
Okay, let's talk about, with respect to ASEAN, you like Indonesia and Singapore. They've been moved up to overweight and Thailand to market weight.
Yeah, that's right. Really, the big picture on ASEAN is that it has underperformed the rest of the region and indeed the world for literally the last decade. If you zoom out and look at say, a 30-year chart or at least a 20-year chart of the relative performance of the ASEAN sub-index versus the broader regional index, it goes in sort of larger sort of cycles. And we've just enjoyed, quote unquote, a 10-year down move. And we think that's coming to an end for three key reasons. One, because economic growth is actually going to recover and improve next year in stark contrast to most of the rest of the world. And that's, of course, as the region comes out of its COVID-inspired downturn. Number two, we're going to see monetary policy start to firm. There's a normalization pattern or trend going on globally. And that should be good for the banking sector, which is the largest sector within the ASEAN regional index. And then third, and excitingly, there is a trend towards the digital economy becoming more evident within the overall index. So the key numbers here are that the internet sector is currently 6% of the index. That's going up to 17% in just a few months as greater proportions of various companies are included in the index. And as we have further IPOs or further introduction of digital economy companies, you're going to see the nature of the ASEAN index begin to shift. And that echoes what's happening currently in India and also, more importantly, what's happened in China in the last 10 years and the significant wealth creation that took place as a consequence of that shift. So we think there's a number of reasons to take a more constructive view on ASEAN, and that's why we've done our upgrades.
Okay, final question before we let you go. You just mentioned there what you've done with India, but also South Korea there. Both of those markets being moved back down to market weight by you?
Yeah, super quick. It's not because we're particularly bearish, but obviously you have to make room for a market as large as China in terms of overweights and underweights, just to make sure that everything adds up. In India's case, it's very simply just a case of valuation. The market's a bit ahead of itself in terms of valuation. I'll give you two statistics. One, the forward 12-month price earnings ratio is about 23 times earnings, which is 2.3 standard deviations above the 10-year mean. And number two, the relative valuation of India versus the rest of the region is just recently peaked at 65% premium. And that's a record high going back as far as we have data. So we just think the market's a bit ahead of the fundamentals and needs to have something like a time or perhaps a modest price correction to allow the underlying earnings to catch up. So we're very positive in India over the medium term, just feel it needs to take a bit of a breather here. And that's more or less the reason in Korea. Korea is really just a function of slowdown and exposure to the global cycle. It's the most cyclically exposed economy and also quite sensitive to the semiconductor cycle, which currently is under a modest downturn. So we're kind of stepping aside in Korea until we might look to re-engage sometime in the middle of next year. And all that, as I said, to make room for the upgrade of China.
All right, good stuff as always. Timothy Moe there from Goldman Sachs. Thank you very much for joining us on the show today with those insights. Well, moving on, and if you want some more investment advice as we head into the new year, head over to cnbc.com, where Tanvir Gill has been surveying several renowned market strategists, including Jim O'Neill and Guy Spear, to get their 2022 investment ethos. The link there on your screen, so you want to head over to cnbc.com to read more about that. Coming up next, we will check in on the market reaction in the China markets as a COVID outbreak in one Chinese city there is forcing companies to suspend production. We'll have those details coming up for you on the other side of the break.
2 out of 3 guys experience.
Welcome back. Well, let's get you a check-in on how the mainland China markets are faring because COVID fears again on the radar with several companies forced to shut operations following a surge in infections in China. Let's get more. Sam Vardis is joining us to tell us all about these details. Hi again, Sam.
Hey there, Matt. Yeah, authorities reporting 101 new cases on the mainland yesterday, 80 of which were locally transmitted, and 74 of those have actually been found in Zhejiang province. And I say that is significant because this is actually marking the first local outbreak in that province all year. The Securities Times is now reporting that 17 companies in Shaoxing City in Zhejiang province have now suspended production. And this was a directive from the government as part of these restrictions to curb this COVID spread. And so we are seeing some of those companies really bucking the broader gains that we are seeing in the mainland markets today. Actually, this doesn't include companies that make pandemic-related goods. But while we are seeing some broad-based gains there, we are seeing some weakness when it does come to those companies that have halted production for now. This is not a lot of cases, relatively speaking, 101 new cases, but certainly it is putting China's COVID zero approach certainly to the test. While this has been certainly good for things like exports, we do know that this has come with a bit of an economic cost as well. And as I say, this is some of the companies that we are talking about halting production over in Zhejiang province. You've got HomeLink, for instance, down almost 5% right now, which does make plastic goods. So certainly keeping an eye on that situation, Matt, if that gets any worse or hopefully improves.
Yeah, absolutely. And Chinese officials wrapping up their annual economic work conference on Friday. What were the key takeaways from that? Because there's a fairly interesting, I guess, dialogue where they set out a number of things that they will and will not do, essentially.
Yeah, certainly a more accommodative tone, you could say, coming from authorities. The key word was certainly, once again, stability, appearing 25 times in this document which came out of this economic work conference, really stabilising growth, the aim of the game here for these authorities as they are getting increasingly concerned about this economic slowdown. Officials saying China's economic development is now facing three pressures: shrinking demand, supply shock and weakening expectations. Economists economists have said this is a bit of an unusual acknowledgement coming from these authorities, which is certainly significant, but they have said next year's economic growth should prioritise stability and shoulder the responsibility of stabilising macro growth there. So stability, we know, is certainly key to the Communist Party, particularly heading into what is typically a conservative year for China with that 20th Party Congress. Authorities also wanting to promote a positive image of the economy, particularly around the Beijing Olympics. So we're seeing some of the big takeaways being front-loading, bringing forward some of these policies, particularly when it comes to infrastructure investment, introducing more tax cuts, emphasising this would be done certainly in an appropriate way, conducing to this stability. They've also talked about focusing heavily on the job situation and also boosting domestic demand. Officials also calling for this coordinated approach between macro and also, I should say, the fiscal and the monetary policies, but still reiterating that they will be taking this flexible, targeted approach, and particularly a big emphasis on supporting those SMEs. Matt?
Sam, thank you very much for that. Well, coming up next on the show, we'll hear exclusively from the CEO of Abu Dhabi's Sovereign Wealth Fund, find out if their big bet on the chip giant Global Foundries is paying off despite the ongoing semiconductor shortage. We'll have that coming up for you right after this.
สวัสดีค่ะ
Welcome back. Well, shares of Global Foundries been trading up about 30% since its October NASDAQ debut, in which it raised $2.6 billion. Mubadala, Abu Dhabi's $243 billion sovereign wealth fund, has a majority stake in the American chipmaker. Mubadala's CEO sat down with our own Hadley Gamble to discuss the fund's investment in the company and the outlook for the semiconductor industry.
I think we made a very good, now in retrospect, thematic view in terms of where we saw this industry going back in 2007. And of course, I think over the last 12, 13 years, it's been an incredible journey with reaching a very important milestone, which is taking that company public in 2 months ago.
So you're planning to spend as much as $1 billion to increase capacity. How soon do you think we'll see an end to this global chip shortage? When will supply meet demand?
Well, we've lived through that journey. When we entered that business back in 2007, it was AMD. It was investing in a company which we thought was going to be a company that will be very successful, that had a differentiated technology, but that was, at that point, doing two different things, doing the design side of it and the manufacturing side of it. I think the view we took back then was, of course, with AMD, that the manufacturing side needs to be spun off because achieving scale and being able to compete on a global platform required it to essentially service many customers. So turning from a aspect of a business within AMD that was serving one customer in AMD to then being an independent manufacturer, an independent foundry, that led to the establishment of global foundries and eventually what we'll talk about then more, which is the journey of global foundries. I think that was the first very important decision point back in 2007. AMD back then was small. I think had very interesting prospect. We had a very, I would say, strong view about the semiconductor business, technology, where it was going. And I think we made a big bet on AMD. And over the years, AMD, you know the story, has been an incredible success. Its CEO, Lisa, has been one of the most incredible CEOs, I think, in the sector. Well, to be honest, in business overall, really phenomenal CEO. And with that, we've seen AMD become now the player we were always hoping for back in 2007.
In terms of that growth and the need, supply meeting demand, what's your outlook? Because you have a bird's eye view on this at this point. So
it took 50 years for the semiconductor business to turn into a $500 billion business. It's going to take probably 8 to 10 years to double. And it's going to double right after that, probably in 4 to 5 years.
Yeah.
So you take that as one very important data point. You combine that with another very relevant data point. There's only 5 players. There's 5 foundry businesses, global foundry businesses, 4 of which are in Asia.
Yeah.
One of which, Global Foundries, has, I think, the unique differentiated platform of being in the United States, in Europe, and in Asia.
Well, let's tell you about some stocks to watch today. Australia's coal seam gas producer Senex agreeing to a $610 million buyout by South Korean POSCO International. It's after the trading arm of the steel giant POSCO raised its offer for a third time to $4.60 a share. POSCO International already owns oil and gas stakes in Southeast Asia and is seeking to further diversify into gas operations. The acquisition is expected to be completed in late March of next year. Well, meanwhile, Australia's Ramsay Health Care is buying the UK's Elysium Healthcare in a $1 billion deal. Elysium operates 72 mental health care sites in the United States and will allow Ramsay access to that market as more and more people are seeking support for mental health amid the pandemic. Ramsay Health stock on the back foot today, though, weaker by just over 1%. Well, coming up next on Street Signs, virtual banks have been taking off in a big way, challenging legacy players. But are the valuations justified, and which countries offer the best opportunities? We'll have more on that for you after the break. Welcome back to Street Signs. Well, digitisation has been accelerated by the pandemic, and banks in Asia are not immune to it, with digital banking gaining in popularity. Mobile banking has been especially popular since the start of the pandemic, with the likes of Kakao Bank and Rakuten making waves. Kakao Bank in particular, which IPO'd in August, has now surpassed the market cap of South Korea's legacy banks and is that country's largest financial stock. Well, let's go into this in a little bit more detail. Michael Mukdad is Senior Equity Analyst over at Morningstar, joining us now from Tokyo. Explain to us the growing prominence, or you could even say the explosion that we've seen when it comes to digital bank and digital bank offerings.
So I can't hear the speaker.
Okay, we'll let you go and try and sort that out. And for the moment, we'll go to a break and we'll come back and continue this conversation.
I'm Dr. Lakeisha Simmons.
Well, let's go back now to Michael Mukdad, Senior Equity Analyst at Morningstar, joining us from Tokyo for the discussion that we're going to be having about the digital banking landscape. Explain to us the prominence. Why has digital banking, not only digital banking companies, but also services more broadly, really exploded in the last little while?
Well, 2021 has really been a big year for digital banks in Asia. I mean, I think you mentioned Kakao Bank, had its IPO in August, and since then, we've had lockup expiries and whatever, but it has continued to be the largest market bank in Korea by market cap, and its market share in Korea is only 1% or so. So, and the profit level, of course, is relatively small compared to the legacy banks. So really to have maintained the largest market cap, bigger than Shinhan, bigger than KB, I think maybe it was a surprise to some observers, and I think it shows the potential certainly for Kakao Bank. And then, but it's not just Korea. We've seen a lot of movements, and this is what's in the report that I published with other colleagues at Morningstar who cover Asian banks across the Asian region for digital banks. For example, in Indonesia, they're the fourth largest bank by market cap is Bank Jago. That was just a very tiny bank until recently. It has basically been taken over by an investor group to turn it digitally. So, and we've seen many countries that have been issuing licenses and where there's a lot of movement. So the report really goes in country by country to where are their potential, where are their threats to the legacy banks, and basically what can we expect going forward.
Right. Let's talk about that in a bit more detail. Why are we starting to see this proliferation? Is it because people are shifting to doing everything online, e-commerce? So why should banking essentially be any different? There's new technology which makes it safer. There are new players out there which are disrupting the way that the banking model works in a number of these countries. And there's also penetration, I guess, into some markets, because you were talking about the large potential when it comes to Indonesia and the Philippines. And we know that the Indonesian population, there's a large portion of that that's unbanked as well. Are all of these factors the reason behind the growth that we're seeing?
Yes, I mean, one of the questions, I guess, could be like, why now? We've had, I'm in Japan, and in Japan we've had digital banks for 20 years now, and they've been steadily growing. It's nothing new. I mean, we've had the transition from PC to smartphone, and I think in the report, we go into kind of why is this taking off now, and some of that, I think actually the biggest catalyst was that in many countries, the bank regulators were quite reluctant to give licenses to challenger banks, for fear of, financial stability. I mean, sometimes you have interest groups like, say bank labor unions, that sort of thing. And I think really a big change happened in 2014, and that's when China, for the first time, licensed some private sector banks in China. And among those was WeBank and MyBank, so basically the banks, supported by Alibaba and Tencent. And after that happened, then we saw Korea, kind of go and say, well, okay, we can license Kakao Bank and K-Bank, which is a competitor for Kakao Bank. So I think that was one catalyst for a lot of countries. And so that's why we've seen, it takes, several years to move from, applications for licenses to granting of licenses to actually launch of services. And I think that's the point where we are now, where most countries have licensed challengers, and where the virtual banks are in the process of launching services or have launched, and we start to see the growth phase.
How have the legacy banks responded? Because I imagine that legacy banks will have had to alter their product to match some of this disruption that's coming in from the likes of digital banks. And our banking markets, I know you want to run through a few of them, the most advanced when it comes to digital banks. We've been talking about already Korea and Japan. The most potential, the Indonesia and Philippines. Can these markets coexist with legacy banks and also digital banks? They're not going to cannibalize, or will they cannibalize some of each other's market share across a variety of areas?
So the report I think for the most part comes to a kind of balanced conclusion. So I mean, we can see in Kakao Bank that the current market cap is larger than the legacy banks, but obviously there are limits. Basically, one of the conclusions that we came to in the report is a lot depends on the liquidity and the funding conditions in each jurisdiction. So, for example, I mean, there's a big difference between Japan and Korea. In Japan, all of the banks find it easy to gather deposits and actually find it difficult to deploy the deposits profitably. So if you're a virtual, you don't actually, as a virtual bank, you don't have to pay anything extra really to gather deposits. But on the other hand, it's hard to gather them, through funding and do that in a sustainable way. And so I think actually in some ways, Kakao Bank is one of the unique ones globally. And the other thing that Kakao Bank has, besides operating in that sort of macro situation, is that it is connected to Kakao, which is a major messaging platform. And one of the things we also saw in Southeast Asia is that we think some of the ones that look best positioned to grow and win are the ones that are supported that are connected to Grab, ride hailing applications or messaging applications. They have an ability to get the growth. In terms of how the legacy banks can compete, I think really the threat is in the retail space. But when you get to more complex institutional business, then then the virtual banks are in the same position as the legacy banks. They can't keep that same low cost structure.
Michael, appreciate you joining us to give us that insight there. Michael Muqdad from Morningstar. Thank you very much for joining us on the show there. Well, coming up next on Street Signs, oil prices adding on to the 8% gain that we saw last week. Investors may not be as worried about the Omicron impact, but there's still plenty that could affect the oil patch, including Iran talks and, of course, OPEC. We'll discuss the most important things that you'll need to keep and watch out for in the oil patch after the break.
Make holiday shopping.
Welcome back. Let's give you a check-in now on the oil patch. We are seeing gains Asia side for both of the contracts. WTI 72.66, a gain there of just over 1%. A similar size percentage gain for Brent with the price action at 76.08. We'll be watching for OPEC's monthly oil report due later on today. Oil prices have been rallying and turned in the best week since August, and the momentum is set to continue, with Goldman Sachs global commodity head Jeff Curry projecting that prices will head towards $90 a barrel from next year.
Given a combination of poor returns over the course of the last several years, plus ESG, investors were wary of oil and commodities to begin with. Then you add this volatility, and we saw this type of volatility around the Delta variant back in July, and then once again right around Thanksgiving with the Omicron variant. A lot of investors said we've had enough with this space at a time that it needs capital more than ever. And so what we're seeing is a lack of capital to be able to grow the supply base, particularly when we look out into next year, when it's all likelihood OPEC's spare capacity will be exhausted. The likelihood of an Iranian deal is declining, and we have yet to see any significant shale drilling. So this market starts to look pretty tight into 2022, which creates a lot more upside risk, particularly given where the forward prices and even the spot prices are today.
You look at how the odds are stacked is what I'm trying to get to. You look at how the odds are stacked with Omicron, and we're hoping for the best, that they're mild cases. Then we've also got these therapeutics that we were just talking about. You may get a fourth shot. The Omicron might not be like Delta in terms of just spreading everywhere. So that could go away, and you're still left with this supply issue. And you've got those therapeutics that are coming in maybe 3 months, 6 months. So it just seems like this is really temporary, any demand concern. So are you looking for sharply higher commodity prices, oil as well?
Well, I mean, the one factor here, the big story in oil was the vol market. You look at positioning in flat price that's directional. It had already come off tremendously. Where all the positioning was in the vol positions. You also saw that in the equity market. And when Omicron hit and brought oil prices down, at least on the forward basis in calendar 22, down to around $65 a barrel, you started to get into that strike zone. The dealers had to sell and sell and sell to cover their positions, which is why it was so violent to the upside. That's what we call a negative gamma effect. And that brought you all the way down And then immediately, as soon as things started to stabilize, and as you pointed out, people realized, oh, Omicron is not nearly as bad as we thought. You started moving back up to those strikes, in that buying, whipsawed you back up to 75. We still have more upside risk associated with this negative gamma effect. But I think one thing that's apparent going into year end, just given the volatility, is that risk is going to be slow to come back into this space. We don't think until after the first of the year that you start to get a lot of risk ready to put positions on. They get a clean slate after January 1st. At that point is when we think you get the real upside back towards $90 a barrel.
Well, elsewhere, the latest round of Iran nuclear talks resuming at the weekend. The UK says there's still time to save the deal, but that it's Iran's last chance, while Tehran says good progress was being made at the negotiations in Vienna, but remained critical of the European powers' stance on the deal. Iran accusing the European parties of not bringing constructive proposals to the table to help revive the deal. Well, let's discuss everything affecting the oil patch in much more detail now. Alejandro Barbosa is the VP of Crude Middle East and Asia Pacific at Argus Media, joining us from Tokyo. All right, it was a bullish week for the oil patch last week. Do you think it can continue into the end of 2022?
There certainly seems to be support for prices, given that there doesn't seem to be anything concrete or final coming out of the negotiations in Vienna. There seems to be an impasse there about how quickly Iran can actually reduce its enrichment, while at the same time how quickly they can get some relief from the sanctions. And as long as that impasse is there, we're talking about as much as 1 million barrels per day that is not coming back to the market. So that is giving support to prices. And if you combine that with the open option that OPEC has allowed itself to continue managing the market, not only during its monthly meetings, but with what they call an open session, where they can adjust output at any point in time. That's certainly providing very good support for prices now.
Do you think that there will be any resolution when it comes to the talks with Iran? And if the talks, of course, are successful, how likely is it that, as you spoke about, in terms of around 1 million barrels of Iranian oil per day coming back onto the market, how likely is it that all of that would come back onto the market anyway?
I think the market is taking that possibility seriously already for some time, and OPEC themselves have to allow some space for that oil to come into the market. But we don't expect at Argus that any of this 1 million barrels per day will reach markets before the second half of 2022. So we still have several months where the additional output that is coming from OPEC will be required to rebalance the market. We also expect that in the current environment where Omicron has made it a lot more visible what the threats to demand might be going forward, OPEC is going to keep a much closer eye on balances, and as soon as they see that there might be some situation of oversupply developing, they will ramp up. They will start cutting production and adjusting output. Now, if they see additional output from Iran, they will have to as well make space for that additional oil from Iran.
Were you surprised that we didn't get a move of that magnitude, or a move of that nature, I should say, at the most recent meeting just a couple of weeks ago? Because there was a lot of talk that we would see OPEC essentially take its foot off the accelerator a little bit and change that output number from 400,000 barrels per day. Given the sharp rise back up that we've seen in oil prices, and the fact that OPEC decided this time around they weren't going to do anything, do you think that the Omicron variant then is essentially a damp squib? It's not going to have much of an impact at all, and that the initial sharp move that we saw to the downside in oil markets was just a knee-jerk reaction because people didn't have enough information out there about the new variant?
OPEC Plus showed a great degree of responsibility by carrying on with the planned increase. Now, at Argus, we believe that Omicron itself could account for as much as a decline of 1.6 million barrels per day of overall demand when you even it out or average it out over 2022. So yes, this is an important factor to keep in mind, but as we were hearing earlier, it's likely that we will have vaccination. It's likely that the market will start to deal with those lockdowns, and we will start seeing any ramp down in activity come back up. And that should keep demand growing, and that should keep prices around the mid-70s for the rest of this year and into next year. That's the forecast from Argus.
Right. I was just going to ask you about that because you would have heard what Jeff Curry was saying just before we came out to you. A little bit more bullish, eyeing a $90 price when it comes to oil. Do you agree or disagree, or do you want to agree or disagree with anything that he had to say?
I think there's always the potential for spikes in prices, or as we saw it 2 weeks ago, for the price to collapse in the face of any news that seems to fundamentally alter the balance of supply and demand. But we've got a very well managed market by OPEC, and now that we've got also a clear signal from the consumers that they wouldn't like inflation to just continue, and they have an interest in keeping prices somewhat under control. The mid-70s seem to come across as a very agreeable or very positive price for both producers and consumers. And I am sure that OPEC will do everything it takes to keep the market around that level.
Okay, we've of course got a lot of central banks meeting this week, including the Fed, where it's expected to fasten up the timeline for its taper program, and then the lift-off in rates could come sooner than expected. Could there be any reaction in the oil markets to this? Because higher rates stateside are likely to be a drag on consumers.
If you actually look at where the demand is coming, and you see that Asian economies at a slow pace, but they are recovering, we don't expect that will have a material impact on oil demand. So overall, we believe that the market is very well supported, and that fundamentally, if we see some weakness in demand that may be related to the virus or to the tapering, OPEC is going to deal with that, and that's going to keep the prices well supported.
Alejandro, I have to leave it there. Thank you very much for joining us. Alejandro Barbosa of Argus Media there. Thanks very much. Well, the Indian markets are just kicking off the trading day, up and running now. Let's get out to Mumbai for all of the early action with CNBC TV 18's Sonal Buttra. Hi there. What's moving in the markets today?
Good morning. Actually, it's everything that's moving around in the market today, taking cues from the global markets. The SGX Nifty indicated a bump up, a gap up opening, and that is what is happening. The Nifty is up around 100 odd points. The Sensex up almost 400 points. And the Bank Nifty is also making some big waves, up around 1% as we speak. Across the major sectors, it's a green that we are seeing. Just a couple of stocks in the red today, but which are the top gainers? Dr. Reddy's, because of approval that the company has received. We also have Axis Bank, which is up around 1.5% because there's an upgrade coming in from Goldman Sachs to a buy from a neutral rating. We also have ICICI Bank, which is moving higher, up around 1.5% as we speak. Steel stocks as well doing really well. So we have Steel Authority of India Limited up around 4% in the broader markets because of a large deal that has taken place. GSPL is the other stock we are watching out for. But of course, watching out for ITC. The first ever analyst meet happens tomorrow. The stock is surging ahead of that particular meet. Overall, not many cues that we'll be watching out for. Largely global, the 4 central banks globally will be meeting, and that is something Indian markets will also be tracking.
Absolutely, just like the rest of us in other parts of Asia as well. Thank you very much for that, Sonal Buttra there from CNBC TV 18. Well, that's India. Let's give you a look at how the markets are faring across Asia Pacific, because it is a very strong start to the trading week for a number of these markets. You can see we've got the Hong Kong market amongst the outperformers today, a gain there of more than 1%. We're also seeing the mainland China market, the Shanghai Composite, gaining about 1% as well. The Japanese market is firmer by around about 0.75%. The New Zealand market was lower, but now putting in a fairly robust performance as well. We've got a gain there of about 0.8% as that market does prepare to close in the next few minutes. The Australian market, we've got about an hour left in the trading session. They're firmer by about 0.2%. Elsewhere, we are seeing strength as well coming through for the likes of Singapore and also Indonesia. US futures suggesting that the kickoff on Wall Street will also be positive ahead of the Monday trading session. We did have a strong performance as well on Friday stateside, despite the fact we did get those hot inflation numbers. By the close, the Dow was up by 216 points, or about 0.6%, but things are looking positive, not to the same degree, but the implied open for the Dow up 131. And before we go today, Max Verstappen is the Formula One world champion, winning his maiden title with a last lap pass on rival Lewis Hamilton in the Abu Dhabi race that was marked with controversy. Hamilton pipped Verstappen for the lead from the starting line and led for the majority of the race, seemingly headed for a record 8th world title. With 10 laps to go, Red Bull's boss said the team needed a, quote, miracle from the racing gods for Verstappen to have any chance of winning, and the racing gods must have heard. A safety car 5 laps from the end, bunching the field. The much debated decision by race control to let through the lapped cars separating Verstappen and Hamilton, heavily protested by Mercedes. Fresher tyres on the Red Bull car allowing Verstappen to pass Hamilton and claim championship victory, as you can see there on the podium. And that does wrap up this edition of Street Science. I'm Matthew Taylor in Singapore. Stay tuned to CNBC. Plenty more coming up for you right after the break.
We're committed to
kept.
There's a pride of ownership here, just with the way it's landscaped. But it's been on and off the market for 3 years. I feel it's kind of like dating a girl from LA. Presents itself, looks nice on the outside, but is all up on the inside.
Aaron Kerman has sold over $5 billion worth of luxury real estate, serving the wealthiest clients in LA's most exclusive zip codes.
I would like to price this house right at 10.
He's known for selling difficult homes no one else can.
This is like a multi-million-dollar view, but the pool is looking sad.
Don't hurt its feelings.
And he does it by telling rich owners what no one else will.
The furniture, though, honestly, is awful. You know that puke moment where you're just getting dizzy, like you want to throw up? Horrible. Horrible. No. Horrible.
He's like,
Now, in a challenging market,
Nobody is selling homes. They're all just sitting there waiting for a buyer.
he's taking on his most stubborn sellers yet.
So you can either believe in this product or don't represent me.
While helping his ambitious team with tough listings of their own. Together, they'll fight for every client.
We'll see how we can play this. Try to get you as much money as we possibly can.
And they won't rest until they close the deal. Tonight, a contractor client is convinced he knows the business better than Aaron does.
Look at your courtyard.
It's a beautiful courtyard.
It looked like you just wanted to die in it.
And Tay struggles to find the right digs for her demanding celebrity dad.
I don't want a house on the street. I want someplace that looks like David Hasselhoff's house.
This is Listing Impossible.
why do you feel like you're getting cold feet? What is actually changing? It doesn't even make any sense.
Come on, Jax, Lucy.
We sell the market. We don't create it. If we're listed too high, the buyers will let us know. And then we'll ask you for a price reduction.
As the saying goes, what goes up must come down. And in the usually robust luxury real estate market, prices and sales have been steadily declining over the past year, with no end in sight.
Welcome, everyone. We obviously know the market's beginning to change. We're seeing numbers drop in terms of actual sales volume. We're seeing sales prices drop. We're seeing inventory get a lot higher. We could take advantage of that moment, though, and price things correctly. And if they're unrealistic, let that seller go. Wish them luck and let another agent take it on, fail, and eventually they're going to call us. I once had a seller call me the Obi-Wan Kenobi of real estate. If a property makes sense to sell, let's work on it. I don't watch Star Trek, but I think it's a compliment. Speaking of sellers that have made some bad decisions. Wonderful.
Here we go.
I got a call recently from a couple out of Calabasas. They own a home in the Oaks, which, as you guys know, is a very fine community over in Calabasas. It's currently listed at 4.4, and they've been on and off the market for years. If you guys want to take a look at the house right now and get a little bit more information on it, they called and they were ready to make a change. So I wanted to bring this to you guys and see who has experience in Calabasas and who may want to work with me on this property.
You and I had the second highest sale in Calabasas last year. I know the area, I know the gated community.
Anybody else? Yes, Lewis.
I've lived in the Valley for a long time. I have friends that live in the Oaks, actually, and I know people that are looking to move there, and so do my friends.
Friends or friends' parents?
friends that still live with their parents.
So I currently have a listing in Hidden Hills. It's actually in escrow. So gated communities are kind of my thing, and I think I could really bring something to this listing.
The one thing I love about Nisha is everything's her thing. Have you guys noticed? Like, she's like my thing. So yes, in this particular situation, I'm gonna go with Nisha. She has the most recent active sale in that area. And as you guys know, that's super important because you could take that existing buyer pull list and utilize it for the shift.
Congrats, Niche. High five. Cocktails on Niche.
It's not sold yet, all right? Calm down.
Today, Aaron and Nisha have arranged to visit their potential new clients in Calabasas. It's a very affluent suburb of LA and home to many celebrities, too.
The ex-Justin Bieber lived here.
The ex-Justin Bieber?
Well, he lived here. He doesn't live here anymore.
I was like, who's the ex-Justin Bieber?
This house has been off and on the market multiple times. It makes the house very undesirable. And there are over 20 houses that are currently on the market in the Oaks, similar to his. This is going to be a challenge. Was traffic really bad today?
It's always bad. We live in Los Angeles. Listen. You hear nothing. Although it does feel a little Stepford Wivesy. Like
Oh, it's so
there's no
Stepford.
one out here. Do you think anybody's stabbing their husband inside their house?
Okay, it's not that separate, right? Let's relax. Co-listing with an agent means that we are splitting the work and the commission 50-50. So the total commission I'd be making on the Calabasas home is $110,000. It would be $55,000 each.
It's a little dated.
That's a little vanilla.
It's like me dating a 50-year-old.
Hey there. Hey, how are you?
Hi,
I'm
nice
Aaron.
to meet you.
Pleasure.
Nice to meet you.
Aaron, who is this?
This is Sasha.
Oh, she's so cute. Oh, you know, I have one that's like 11. She's the love of my life. She's a Havanese.
Yeah. Well,
She really is the love of his life.
we bought the house back in 2005. Everything in this house we designed and we put together. This house is amazing, and there's no reason why it wouldn't sell.
Such a pride and joy.
The house is in a great shape. I mean, we loved our house just the way it is.
How many kids do you have?
We have 3 girls and Sawyer.
And Sasha.
And Sasha.
So this is going to be a family affair.
Yes.
They do a little bit of construction, remodeling. I buy properties and I fix them up and I sell them. And Aya is the most amazing esthetician.
My studio is in the backyard. I spend my time there every day.
We definitely want to get the house sold. Right now, we don't need this very big house.
Most of the time, it's just Mike, and one of the girls at home. You know, it's time to downsize.
Do you want to walk around the house so we can give you some feedback?
Yeah, would love to hear it.
The bones of this house are great. The scale is amazing. It's a great open floor plan, right?
We want to start here because when the buyer walks through this door, this is what they see.
Our goal is to help get you the highest price in the shortest amount of time. And so a buyer has to walk through your door and go, oh my God, I love it. I always tell sellers, a buyer will make their decision on whether they want to continue to see a house or whether they like it the first minute they walk in the door. When we walked in, we were confused by the color palette. You have obviously a choice purple color. Do you love purple?
I didn't pick it.
Yeah, that was me.
Yeah, it was Mike who picked it. I was away. I was away for a month.
So I never realized that it is
purple.
Sometimes purple.
All the time purple.
No, it's not all the time.
Maybe not at night.
Very purple.
Not all the time.
That purple color, they were because the wrong shade can cost somebody hundreds of thousands of dollars.
It depends which part of the house you're looking at, and it's not looking all purpley. It's a beautiful, beautiful paint. Who cares about the paint or the color when you have this? No, I'm serious. You know what I'm saying?
Our eye immediately went to your office. Right?
Okay, it looks gray over there.
Well, that's the least of our problems in this room. Your first sensory experience was like a bad office desk, a horrible office chair. Your first few minutes walking through this house is bad, to be honest.
The decor in the office needs a touch, definitely.
It needs a complete redo.
Again, if it's important.
It's so important. Mike, who's in the business, doesn't understand why his house isn't selling. Anybody in the industry is oftentimes so difficult because they feel like they know as much as us. Look at your courtyard.
It's a beautiful courtyard.
Well, it could be. There was nothing good about the courtyard. It had astroturf on the floor. It had the wrong color tile in the fireplace. It had dead plants. So the fact that it looked like you just wanted to die in it is symbolic of something very wrong with the house. The choice to have this courtyard, I could see in theory could have been nice. But what it did was it cut up some of your floor plan. You ended up with like a couple of rooms that ended up being kind of small. When if you didn't have this would have been a little bit more of a fluid spot.
This is a jewel. This is not a dump. This is an amazing home in one of the most amazing locations in Calabasas. And it's not going to sell, it's going to fly.
In nearby Hidden Hills, Aaron's agent Tay Hasselhoff is working with her dad David to find him a new home. But first,
what you do is you open this up and you pour it in.
They've got some other business to attend to.
Here we go.
And now you can see the fish are going nuts.
Oh, look at him go.
And the eels will come out.
Look at him eat the shrimpy.
It's so funny, they know the ladder.
I love that.
And I'll bring out the ladder and I go,
So cute. Today is exciting because my dad's been thinking about possibly moving. So my dad has agreed to let me list his house if I'm able to find him a much bigger house that fits his criteria.
So, what's going on?
Hustling and bustling and getting things going. A lot of real estate new clients. It's been interesting because I feel like a lot of people are coming to me to help them find a house rather than list their house.
Isn't it a hassle off?
You know, I'm finding that it's more of a buyer's market, which is really interesting. The market has completely softened. There's a 30% increase of homes that are on the market just this year. Since buyers are in the driver's seat right now, it makes so much more sense to just be a buyer's agent at this time. And I kind of have the perfect client, my dad.
I bought this house as kind of an interim because the big house where you actually grew up in, you know, we had to sell because the phone wasn't ringing. The phone's ringing now. And suddenly I've gotten to a place where I've outgrown this house and I need some privacy.
I think working for your family member, especially my dad, is awesome because you know exactly what he wants. So it kind of makes it an easy process in the sense that you know what he expects from you, so you better bring it.
Gated community, a lot of property, privacy. I like the gated community. I'll tell you why. We don't even have a guard on our gate. And I'm the one who's a proponent for like spending extra money so we have a guard because there's been paparazzi. There's people that want to know where the Hoff lives. And,
of course.
And then the driveway to me is the most important. My last house, I bought it from the driveway.
Yeah. My dad definitely likes a big driveway. It's actually a really good time to buy because a lot of these houses are just sitting on the market. So for you, it's a great time to come in. And if you like a property, we'll get it pretty well.
In a buyer's market, sellers have to adjust to market demands, a reality that Aaron and Nisha are trying to explain to Mike and Aya.
Let's keep going.
No shaming with my bedroom. Aaron.
You know, this house could be glamorous. This house could have a little regal feel to it, and there is nothing regal about this moment. The lights are the wrong scale. I like antiques, but not against the bed.
We like our bed.
But what about this are you attached to? Because you don't lay on this.
Oh, we do a lot of things on this.
Okay, well, I don't want to touch it. So
the master bedroom needs to be the spot for pleasure or relaxation. You have the Sherlock Holmes bed. You have these small lights. You have these like grandma nightstands. From a sellability point of view, there is nothing sexy about this bedroom. What a beautiful setting.
Yeah.
It is.
We're big proponents of light, and we feel like the blue is very aggressive, and I'd like to soften the tone.
Having a white color palette will be less distracting. And then you'll really appreciate the backyard, the landscaping, the pool.
Outdoor space is so critical here in Southern California. People are buying for that in and outdoor flow. And so, you know, their eyes go straight to that backyard. And it really is one of the most important parts of any given home.
Again, that was something I've done when she was out of the country.
Girl, this was an expensive trip.
Some women get jewelry, some women get new cars. I get a new house, a new paint on the wall.
Why do you like to change the house when she's gone?
Because if she would be here, she wouldn't let me.
This is my studio.
Oh, a lot of stuff.
This really should be a pool cabana room. It's amazing for that.
Oh God, now you're touching a sensitive point.
I just went from an oasis to your workplace, and it feels it.
The most difficult part for me about moving is relocating my business to another place. I do believe strongly that it can stay like this while he's showing the house.
The thing is, because it is so geared towards your business, some people might lose that vision of seeing it as a cabana room or a guest house.
This is not closing or changing till the day I move.
Coming up.
What are we looking at today?
The first one's in the Oaks. That's like the community that all the celebrities live in.
I'm a celebrity.
So it would work perfectly.
Oh, that's great.
What's on your holiday
is not closing or changing till the day I move.
It's the only house in the Oaks that have actually a separate unit. It added about 400 square feet to the house.
The fact that you have one of the only approved exterior structures is a
Huge.
huge value.
How would you turn it around? Like, what would you make out of this?
We want to curate this in a way that a buyer is going to be like, okay, this is an outdoor either guest house or cabana.
How does that make you feel?
I need to catch my breath.
If Aya wants to sell her home, the office has to go. Let's start with staging. It's a must. We think the whole house needs to be staged. I would estimate staging to be $18,000 to $20,000.
I don't think so.
Because?
I had just staged a beautiful home for $7,000.
Not all stage companies are created equal. It doesn't look right, and it didn't work. And you're still at ground zero. Now you've spent money, you lost time, and you have to stage it right. Nothing is worse than a bad stage.
The second thing is going to be painting the interior.
That purple has to go. That's going to cost $15,000 minimum. Courtyard. Fixing the fireplace is probably going to be at least $6,000.
So when you sum everything up, what are we looking at?
All right, so that's 33 plus 6. Let's call it an even 40.
I just hate to invest now $40,000, $50,000, I'll be honest with you.
That 40 is going to sell your house.
It's 1% of an investment in your house.
There is no formula that I use to figure out how much a seller should be spending prior to a house launch. Every house and every seller is really different. In Mike's case, his house needed a lot of work.
What are we going to sell the house for?
Right under 4 would get you moving up.
This is a strategy before you freak out to get multiple offers to drive the price up. We just did it in Hidden Hills.
And it worked.
If you're going to list it under 4, you're going to sell it, but you're not going to get multiple offers and you're not going to get offer 4. I'm not willing to accept anything below that.
In the Oaks, the average selling price is $4.1 million. So we really feel the house is overpriced. There are 22 houses on the market, all in those price points. So people are going to have options. For buyers and sellers, it's like they have one transaction, right? They're selling one house and buying one house. But they don't realize I do it every day.
I checked out some of what has sold. Closer to the 5 and 4.5 mark has been recently updated kitchens, bathrooms, flooring.
We really think that under 4 mark is the right move for you.
Just think about it.
Yeah, we'll
Sleep
think
on
about
it. Get into the bed that you love so much and
We love this.
think it. I don't want to talk about it. All right.
All right,
Let's
guys.
go.
Thank you so much for your time. We really appreciate it.
Today, Tay is taking the Hoff to see some potential homes in Calabasas, including one in the same neighborhood as Mike and Aya. The properties range from $3 to $5 million.
Yay!
Long time, huh?
You look so good.
Oh, I just came from an audition. Do I look green?
You look very green.
Since you decided to become a real estate agent, are you enjoying it?
I love it. So in the past year, I've had one listing, but I've had a lot of transactions being a buyer's agent. Born and raised in LA, I know the city like the back of my hand. Why wouldn't I be doing real estate? I love it.
You're able to bring out the best in people, and because they trust you, that's why it's called, Real Tay.
Yeah. I have my own hashtag. It's #RealTay. A lot of these real estate agents aren't real. They just want their commission. They don't really care about you. So for me, when I got into real estate, I wanted everyone to know you just get real with Real Tay.
And I'm glad that you're able to do something that's real because Hollywood's not real.
Yeah.
But, looking for a house it's a real deal. What are we looking at today?
The first one's in the Oaks, which I love because that's like the community that's all the celebrities live in, and it's
I'm a celebrity.
You are a celebrity, so so it would work perfectly.
Oh, that's great.
The reason why I love the Oaks is it's super private. Hello, we have a showing today for Hasselhoff. Yes, it's in my trunk. Hold on. A lot of these communities, the guards aren't the best, but always the guards at the Oaks community will never let anyone that's not supposed to come in. So if you want to have a party, you better have that guest list printed out because no one's coming in without you going through that guard gate. Thanks, you too.
Next time, could I make sure that I get 2 hamburgers, French fry, and a shake?
Onions on that?
No, absolutely onions. Okay.
Great.
All right, thank you.
Stink all day. Bye. I like the street.
Yeah.
Hello. Hi.
I'm David. How are you?
Hi, Missy and Proda. Nice to meet you.
Nice to meet you. Hey, bro.
If you're looking for a view home in the Oaks, this is the quintessential home.
Okay, nice.
Huge family room.
Wow.
Stunning views.
The timing is really good right now to be a buyer's agent because a lot of these houses are just sitting on the market and these sellers just think their house is worth so much more than it really is.
Wow.
Yeah. Wow, it's a really beautiful view over here
Yeah.
for sure. This first house has a lot of amenities that my dad is looking for. There's a home theater.
Chiller, you have a nice office. Careful.
A gym.
It's a good size. It's light and bright. It has nice high ceilings. It's one of those homes that you can just move right into.
Loads of bedrooms. I like how the men's closet is smaller than the woman's closet.
Yeah, I need a bigger closet than this.
He also wants a long, beautiful driveway.
Part of your soul, that little driveway. So when you drive up, you go, wow, that's David Hasselhoff's house. But I'm a little concerned that there's not much of a driveway, you know? I don't like the driveway. I don't like the neighbors being right next door. I like your space. Lock and load.
Lock and load. What were your thoughts? What'd you think about it?
I thought it was overpriced.
Yeah.
It looks like a little house on the street. I don't want a little house on the street. I want someplace that looks like David Hasselhoff's house.
Coming up.
You don't have to be Eric from Beverly Hills to sell it because the house is amazing.
He's basically putting down what we do as saying anyone else can do
Right.
it. And that's bull.
Look, cleaning the outside.
Aaron and Nisha could lose a $4 million listing if they can't agree on terms with their client.
The decor in the office needs a touch, definitely.
It needs a complete
Again, if it's important.
Meanwhile, David Hasselhoff is still yearning for that perfect driveway.
I'm a little concerned that there's not much of a driveway, you know?
Well, here we go. The next one, Calabasas Park Estates. The second property we're going to see is listed at $2.995 million. So at least there's a driveway up to this one. The only caveat that I see is that it is a shared driveway with another neighbor.
All right, baby. So go take a look.
Okay, Daddy-o. I like the high ceiling.
Yeah, beautiful.
I like high ceilings, but with this house, when you walked inside, there were so many pillars, they were just blocking the view. You know, I felt like I was in a Greek temple. My dad would probably wake up in the middle of the night and smash his head into one of those pillars, and there he goes. This is kind of cool. 2 steps down. It's kind of interesting.
How much is this house?
2.9. They dropped the price from 3.1. I feel it's very reasonably priced. It's a cute backyard.
Yeah.
I'm curious to see this guest house, though.
It looks like a lot of space. We put all my memorabilia up, completely cover everything.
Everything.
Yeah.
He's like, this guy is so conceited, he made
Give
his
it over
entire
here.
guest house about him.
My first house that I bought took 8 years. 8 years to find the right place. This house would be perfect if it was set away from all these other places with a nice driveway.
Got it. Do you think it's going to take that long this time around, or do you think Tay can do it quicker?
That would be great. I can't say they'll definitely offer it. I'm not inside their head. But when I say they're motivated, I'm not kidding.
You know, I don't want us to seem desperate because when someone wants the property, they come back. End of story.
Hey, Nisha.
Yeah.
I'm going to call Mike right now.
Okay, hold on. I'm coming.
When Aaron last spoke with Mike and Aya about the listing in Calabasas, they hadn't yet agreed to new staging and painting.
I just hate to invest now $40,000, $50,000, I'll be honest with you.
That 40 is going to sell your house.
Much less what the new asking price should be.
I don't want to take this project if he's not willing to take the time, energy, and money to do it. So I think we kind of need to stand our ground on this. And if he doesn't want to take it, then we walk away from the listing.
Let's just try and wrap it up and move on one way or another.
Hey, Mike, it's Aaron and Nisha. I heard you agreed to $3,999 and pay staging. Look, it costs money to make money. Painting the house would cost $15,000, and staging the house is going to cost $20,000.
I've been thinking about it. Work with my wife. I will pay for the painting. I will pay for the staging.
I always knew I loved her.
Make sure that you do a wonderful job. I believe in you guys. So let's make it happen.
Are we good with the price point that we discussed?
The 4.25.
Here's the thing. You had the house on the market before. And and everybody saw the great backyard and the bones of the house, and nobody has bought it yet.
I believe that at that price, it is the lowest price per square feet. And you don't have to be Aaron from Beverly Hills to sell it.
Your last recorded price was 4.2 and it didn't sell.
It was for 2 weeks, and then I took it off the market.
Time is not on your side. If you,
That's right. Pricing is very, very aggressive.
You mean over your last price?
Listen, we're going in circles here. You know our feelings. The worst thing a seller can do is raise their listing price after it's been on the market for 2 years with hardly any showings and no offers. It's the worst idea I've ever heard.
You are going to sell the house because the house is amazing? Okay.
Take care.
Thank you so much.
Bye-bye.
Thank you. He's basically putting down what we do as saying anyone else can do.
Correct.
And that's bull.
For real estate tips, behind-the-scenes content, and much, much more, visit listingimpossible.cnbc.com.
Tune in for Tech Check.
So far, the Hoff's house hunt has failed to yield a good candidate. But it turns out the answer may be very close to home.
Hello.
What are you doing here?
I have really good news. The house next door, I know it was taken off the market.
Yeah.
But it's back on the market again. And I thought, might as well go check it out. They dropped the price from $6 million to $4 million. So it's, come in completely
Dropped to
done.
$2 million?
Yeah, crazy. The fact that the house next door dropped 30% is only just kind of showing that a lot of these sellers are just pricing it way too high. They just don't listen to their agent.
I got about 30, 40 minutes. Shall we go
perfect.
look at it?
Yeah, he absolutely loves the neighborhood. And I honestly think this house has pretty much everything.
I love this house. You know why I love this house?
Why?
It's got parking
I know.
for like 5 cars, which is great. Now I can buy more cars.
Finally, I found a driveway that impresses him.
Wow.
Wow.
I love the chandelier.
Beautiful in here.
Wow, they've redone this place.
Yeah, they put a lot of
Yeah,
money
I don't
into
want to
this
mess it up. I'm gonna pick up my shoes.
Yeah, good idea.
Where?
Oh, look at your socks. Those are great. It's nice because it's a big flow, and then I know that in here would be the office.
You mean the office?
The office. Look how big this office is. Like
I
huge
know.
high ceilings.
Oh. Can I tell you something?
Yes.
See that chandelier?
Oh my gosh, the same chandelier in your house.
Why?
It's a sign.
No,
It is
why?
a sign.
I looked in the window
Oh.
and I saw that chandelier and I said, get rid of my chandelier. I want that one. Whoa, this is huge. Hello. This reminds me of our house in Hawaii. Oh my
Look at how they
God.
organize their cookies.
Whoa.
Wow, that is the most OCD cookie organization. That's a great idea for my next listing. Oh my God, I love that idea. Decorate with cookies. Now tell me if you can envision yourself living here. This is your headquarters. This is your room.
I think it's too far away to watch television, but I like it very much. Let me think about it because I think its price is right. We should make an offer. Can I ask a strange question?
Yes.
What if someone has been murdered in the house? Does the owner have to reveal that?
Yes. So if I knew that somebody died here, I have to let you know that somebody died.
Can I ask you another question?
What?
Since I know this house, and what if your back lawn was infested with snakes?
Yes.
And the snakes were poisonous and they scared your children. And you called your next door neighbor, which happened to be a television star, and asked them to help build a snake fence to keep the snakes from coming out. Would you have to reveal that there's been a snake fence up there?
In my opinion, it adds value to the property and the house because you do live on a hill. Calabasas is known for having wildlife. If you have a snake-free backyard for your family, of course it increases the value in the property. Now it's at $4,188,000.
So if we came in at 3.7 and they countered with, say, 4,
yeah, then it's up to
We
you
should
to
do that
accept.
then.
Okay.
We should make an offer.
So why don't we do that? We'll come in at 3.7 and I'll write the offer up. And then if they want to counter us back, great. If not, and they accept, then it's yours. My dad knows that I really know what I'm doing and that I put my heart and soul into my clients' lives. And I'm just happy that he's allowing me to take that step with him. All right. Want to bring the umbrella?
Yeah. Such an awesome house that it'd be great to have.
Goodbye, new home.
I already have the chandelier.
I know.
Painting and staging are underway in Calabasas, and Nisha needs to check in on some last details.
Painting ladders, that's a good sign. Oh, don't walk under the ladder. That's bad luck.
Oh, really?
Yeah. Wow. The paint color, I feel like, has made a huge difference. I feel like it brings out more of the warm tones in the floor and the wood. I love that even the beams pop more.
Yeah.
You know? One of the things I wanted to address with you is upgrading the courtyard fireplace. We just kind of wanted to bring a couple options so you and Aya can decide.
Yeah, absolutely.
Okay.
Let's take a look.
I'm going to grab Aya.
All right.
It's important to get the seller input because we want them to like the finished product before it goes to market. At the end of the day, If they support the product, then we know that we're all a unified team and that team should get the home sold.
Hello.
Hello.
Good morning.
How are you?
I'm good. How's everything going? It doesn't look like you've moved much yet.
No, we're going to be packing up tomorrow.
Okay, great.
I actually have some great news. After a long discussion with Mike, we have decided that I should go and expand myself, and I am opening a place in Calabasas in a commercial area. We're going to open a spa there.
You're going to move completely out of the house. This is huge. I'm really excited for you. That's really great.
If it wasn't for this move, I don't think I would ever take that step.
Selling a home can be a huge life-changing event for sellers. When sellers are ready to let go, something shifts, and that is always for the better.
What our goal is to actually make this an oasis. We want to bring in plants. We want to bring in furniture that's really inviting. And we also want to take away the really dated terracotta tile and put something that's really on trend, this kind of Moroccan or Spanish tile. Which ones do you guys prefer?
I choose this one because it's softer.
This is how you need to look at it.
I think it looks great.
Okay.
All right, we're completely on the same page.
Yeah.
That's good. This is amazing. We don't have to argue about this.
Nisha has locked in those final details with Mike and Aya. The final touches are being put on the fireplace. Stagers are moving in the furniture.
Appreciate it. And then we'll match that one.
And we're ready to go full out for this launch. However, his asking price is still too high.
Okay, we're gonna do a cream bed. The question is, do we move the bed to that wall?
I got something better hurry.
All right, that's all I needed.
Coming up.
Hey guys, welcome to your own house. So we hope you like it.
Oh my God.
It's a mixed up world.
It's been a month since Aaron and Nisha first met with Mike and Aya, and finally they're ready to reveal the changes they've made.
Hey guys, welcome to your own house. Are you guys ready for the big moment?
Let's do it.
So we hope you like it.
Oh my God.
Beautiful white walls. I love that. Gives more of an open space.
For me, the purple clashed with everything, the floor, the walls, and now the house actually feels elegant, warm, it's new.
I agree. I really love this bedroom.
Your bed before was like black leather, and now you have a cream linen bed
Beautiful.
frame. It's like the complete opposite.
This is a great example of less is more because it's gorgeous.
You guys had this really bright blue furniture. For us, it felt like your eye just went straight to the blue. So our goal was to really just kind of lighten up the space.
It looks really clean,
When you look out to the space, what you actually see now is the backyard.
I actually like white better.
Wow, that looks beautiful.
We felt like it was really important to get that indoor-outdoor flow, and the new buyer is going to feel what the space was originally intended for.
Because it's really, really nice now. Oh, yeah.
The tile looks great.
Yeah.
This courtyard here was one of the most problematic areas of this house. Nisha and I felt so sad just sitting in it. Now I actually want to sit by the fireplace, hang out here. Mike and Aya's house turned out incredible. It was contemporary, it was fresh. It was like a brand new home.
Now, after I've seen what you've done, the price is definitely going up.
So you're at $4,250,000. We're at $3,999,000.
Under 4. Yeah, absolutely not.
Talking to Mike, he thinks he knows everything. He thinks he's right and thinks that he should be taking this huge premium price when there's 20 other homes in his community that haven't sold. Our concern is that the market is tough right now and people are not running to buy luxury homes, and you fall into that category at this price point.
The lowest number is 4.25.
The same price? What the If that's your absolute number, we will do everything we can to get you the highest number.
Everything is so beautiful that I have no doubt that you'll have multiple offers.
We would love for that to happen.
I just want to move some lanterns to the front.
I'm really excited about the launch party Nisha and I have planned, but I'm really worried that the price is still high.
I'm excited. I'm excited for this party.
I heard there's belly dancers.
It's a night in Marrakesh.
Yes.
Kind of sounds like a porn.
It probably was,
only
honestly.
you would say that.
It probably was.
We chose a Moroccan theme for the launch of this house because in Morocco, they have those beautiful center courtyards. We wanted the warmth, the fun, the livelihood of that Moroccan moment to really, really be established. And I think we killed it.
I like how open it is.
Me too.
And light.
Oh, this is a nice little office here.
Oh, great office.
Oh,
that's great how it looks out on the courtyard. Oh, that's interesting. Look at this tile.
By using technology, advertising, PR, we have the right buyer and seller mix.
Can we get any pieces that we like with the house?
Everything's negotiable. We'll throw it in the offer.
Okay.
Great.
Everyone absolutely loves the house. We've gotten nothing but positive feedback. So it was exactly what we wanted to see.
I think it takes the right people to do so, and I think you and Nisha have that.
Appreciate it.
I'm going to go mingle with some of the buyers.
She's going to go mingle.
Yeah, we got more people coming in. So.
We thank you guys for your time, and we will be in touch with you every step of the way.
Yeah, absolutely.
All right? Yeah. Sure.
Thank you.
Thank you.
Bye.
Always a pleasure.
Dad, look.
Are you
Okay. This is for you, Haley, and this is for Dad.
Currently, what's going on with the house next door is my dad's offer was definitely in the mix of a bunch of other ones. He really just didn't know if he wanted to be in a bidding war. So he said, you know what, we might just want to wait this one out. So I brought my dad to the open house in Calabasas.
Oh, I love this part over here. This is awesome. Yeah, good part. Hey.
So what do you think about this house? Could this be the house for you?
Yeah, we should have started here. I love this. In fact, I love this part over here because it's right off the office.
So when I suggested that Tay use her last name to build her clients and network, I really didn't think that she would bring her dad to our event.
So it's on the market for 4.25. Is that a little bit out of your range?
4.25. No, 4.25 isn't really out of my range. However, I wouldn't pay 4.25 for it. I would start at 3.7, and then I would probably settle at 3.85. I think in life you have to be able to walk away.
My dad thinks it's a little bit overpriced. Also, there's zero driveway.
Okay.
We know that the market is a little tough, but we want you guys to know that as long as we make the right moves and educate people in the right way, we're going to win every time and help our sellers to win every time.
Congratulations. You did a great job.
I think my team did an exceptional job marketing and advertising the home. And we had a great event. Congratulations.
Thank you. Let's sell this house, man.
Let's do it. At the end of the day, though, the market will speak and let us know if our 4.25 price is correct or not.
Coming up.
Hey, Mike. sit down, and I know you're not going to love this, but we got an offer.
I'm not going to even entertain this offer.
Nobody is selling homes. They're all just sitting there.
This is not just a monument.
Showing the house in Calabasas for about a month now. And with Mike still insisting on a $4.25 million price tag, the market's reaction has pretty much been what they feared.
We finally got an offer on Mike's house. You know, it's not a bad offer. It came in at 3.5. I have a gut feeling Mike is going to be very difficult on this.
I'll bet our next lunch that he's going to say, I don't want to respond.
I'm not going to bet against that because that's...
Because you know you're going to lose.
Should we call him?
Okay, yep.
Bet lunch. You're trying to get a free lunch on me here.
Yeah, well, girls got to eat.
I would bet more than lunch. Listing it over 4 million, and in his case, 4.25 million, was way, way too high. We told him that at the beginning, but it's an initial offering. And buyers are going to always start somewhere and see where the seller brings it. Hey, Mike, how are you?
Yeah, how's it going, guys?
Well, we have some news for you.
Okay.
We got an offer. They wrote at sit down, and I know you're not going to love this, but they wrote at 3.5, really clean. They have money. By merely getting an offer, we think it's a positive thing.
I see. I'm not going to even entertain this offer.
I kind of called it.
By not countering them, it just kind of shuts them down, and it like slams the door on somebody before you even had a conversation.
I'm not going to even engage with them because they're being disrespectful. That's the bottom line. That's how I see it.
That is a huge mistake. It's like slamming the door on a buyer before we even start. You can get away with the counter like that when you have multiple people that want your house in a better market.
Well, my asking price was 4.25. So
yep. Mike, the market didn't support your asking price.
I'm not selling it anywhere remotely to this price. Right now, I am priced the lowest in the Oaks. That's the bottom line.
You may be priced the lowest in the Oaks, but nobody is selling homes. They're all just sitting there waiting for a buyer. The buyer is going to walk. He's going to be back at ground zero. We're going to be back at ground zero. This is not the market to try to inch out every dollar. Nobody else has an offer right now. Nothing is traded. We don't need to decide today, but let's just take a beat. We have other buyers. Let us let them know that we have an offer on the table, and let's see where we go with this process.
I just tell you that my answer is not going to change much tomorrow, but okay.
All right, Mike, thank you.
Bye, Nisha.
He hates you.
Hates me. Sellers always need to show a little bit of negotiation, a little bit of room. Otherwise, the buyer is going to go to the house next door. Mike's not willing to show a little bit of flexibility. You basically just slam the door on this deal. And that sucks for him, and it sucks for us. That guy is like impossible.
There has to be a little give and take.
Correct.
The thing is, Mike doesn't want to give anything.
And this game is going to lose him a sale, and he will not sell his house. And that is unfortunate.
That's
A warm welcome to Capital Connection. Dan Murphy with you from Abu Dhabi. Let's get straight into your headlines at this hour. First today, the rally rolls on. Markets extending gains after a record session on Wall Street, despite hot US inflation now running at a 4-year high, a 4-decade high, I should say. All attention now turning to the Fed's final meeting of the year later this week. Also today, the UK raising its COVID threat level as Omicron cases surge. Prime Minister Boris Johnson warning things could get a lot worse.
There is a tidal wave of Omicron coming. And I'm afraid it is now clear that 2 doses of vaccine are simply not enough to give the level of protection we all need.
SenseTime confirms it will be delaying its Hong Kong IPO after the US blacklisted the Chinese artificial intelligence company. Plus, history making. Israel's Prime Minister Naftali Bennett kicking off his first official visit to the UAE, the first ever from an Israeli leader. And in a CNBC exclusive, Mubadala CEO Khaldoon Al-Mubarak says the global chip industry is on track to record exponential growth in the next decade after the successful float of its global foundries business.
It took 50 years for the semiconductor business to turn into a $500 billion business. It's going to take probably 8 to 10 years to double. And it's going to double right after that, probably in 4 to 5 years.
More of that interview for you later on in the program. Let's begin, as we always do, though, with a check on what's happening with Asia markets right now, because they are trading higher across the board. Investors indeed looking ahead to a busy week. Most major global central banks are going to be meeting in the coming days, including the Fed, the BOJ, the BOE, and the ECB. Today's gains across Asia coming after the US saw its best week since February. That's despite the hottest inflation read since 1982. And in Japan, the BOJ's Tankan survey showing business confidence among the big manufacturers stayed flat in December, while sentiment among the country's largest service sector firms improved for the first time in 3 months. But the outlook is a lot more uncertain, with both big and small manufacturers seeing conditions worsen in the March survey. Let's dig deeper into the markets. It has been a firm session for the Hong Kong markets, and Emily Tan joins us live. Emily, SenseTime also confirming news about its Hong Kong IPO during the lunch break. Hello to you.
Yeah, that's right. Hello, Dan. Good to see you. And the Hong Kong markets, one of the outperformers today. I'll get to the SenseTime IPO in just a bit as I do a recap here. We're looking at the Hang Seng Index traded firmer by 1%, 24,249 with 8 shares, better by a similar percentage. It is the tech stocks that are outperforming today. We do see shares of AT&M really powering ahead, with Meituan shares up 4.5%. Also outperforming today is shares of Hong Kong exchanges and clearing. And this is on the expectation that we would see more listings in the Hong Kong market following all the geopolitics of what's happening between U.S. and China on that front. And that brings me to SenseTime. This one, they were not able to price their shares last Friday as scheduled, and now they have pulled and postponed their IPO. The company says they're going to be publishing a supplemental prospectus, postponing their listing, and then refunding all application monies. They, though, remain committed to completing this listing soon. This comes after the Treasury Department last Friday put them on an investment blacklist. This is the Chinese military industrial complex companies list over alleged human rights abuses in Xinjiang. The company has rejected the accusations, and you can see from that statement just now. I'll just read it briefly here. We strongly oppose the designation and accusations that have been made in connection with it. The accusations are unfounded and reflect a fundamental misperception of our company. We regret to have been caught in the middle of the geopolitical tension. The company says, of course, now that it's going to be continuing to pursue this listing, and we're going to be watching that. Hong Kong exchanges and clearing, one thing the market is going to be watching out for, whether or not they will go ahead and host a listing of a blacklisted company, because this would be a market first here. So we are going to watch out for that as well. Dan, it's back to you.
Emily, thanks for the update. Meanwhile, over in the mainland, there is more talk of fiscal support after China's leadership wrapped up its annual economic conference. Let's go to Sam Vardas joining us with more details on this. Sam, what are you watching?
Hi there, Dan. Yeah, certainly a more accommodative tone coming from Chinese authorities over the last week or so, and that does look encouraging for mainland Chinese shares. We are seeing the Shanghai Composite also one of the outperformers in the region today. The CSI 300 index sitting up around 1.3%. There was a big focus, this keyword stability appearing 25 times as authorities are certainly on high alert about this economic slowdown that we have seen. And so some of the big takeaways from this meeting was certainly to introduce more tax cuts and front load, bring forward some of these fiscal policies like infrastructure spending and investment there, emphasising that this would be done certainly in an appropriate way. They also said they'll pay close attention to certainly the job situation, preventing financial risk, but also calling for a coordinated fiscal and monetary approach now, certainly with a big focus now on the SMEs. And so that all looks really supportive for the material stocks today and also those consumer staples stocks, both sitting up over 2% out of the lunch break, which certainly seems to be lifting the broader major indices today. But we are seeing some weakness in the markets, and that has something to do with the COVID situation over on the mainland. Authorities reporting 101 new cases yesterday, 80 of which were locally transmitted. That is the number we look at, and 74 of those have actually been found in Zhejiang province. That marks actually the first local outbreak in this province that we have seen, and actually 17 companies in this province have actually been now told to shut down production. These are some of them that you are seeing on your screens there. And so we are seeing some weakness when it comes to the likes of HomeLink, down almost 3.5% off the back of this. They have been told to suspend production because of these restrictions to curb the spread. So we are keeping an eye on that situation as well. Dan, back to you.
Wow, Sam, COVID risk still very present. Appreciate the update. Okay, focusing in on the markets again here, and we have US equity market futures in the green. That's building on Friday's strong gains that we saw on Wall Street. The three major industry indices closing out their best week since February, with the S&P racking up a record high. Treasuries have also been steady. A pulse check on what's happening with the 10-year Treasury yield. And this, of course, comes despite US inflation rising to its highest level since 1982. Will Caloris joining us live now to break it all down and what it could mean for the Fed this week, Will.
Good morning, Dan. Yeah, that's before both of our times in terms of that inflation print and the length of time that we've seen since it's been this hot. And it is going to be incredibly interesting how the Fed does react to these hot inflation numbers. Basically speaking, they did know that all of these numbers were going to be incredibly hot. And there is this expectation that if you're just looking at that headline rate, the one that came in at 6.8% year on year, that it could hit 7 or 7.25% on the next print in terms of, or at least by January. That's at least according to UBS. But the Fed is going to be interesting because obviously there is already this expectation that they are going to accelerate the tapering of their program when it does come to the monetary stimulus. So they're now expected to bring that up to around about 30 billion a month as opposed to the 15 billion a month. And that would see the tapering end by around about mid-March. And what comes next following on from that is where it gets really interesting and whether or not we'll get any kind of signals from Chair Powell regarding that. So if you're just looking at, for example, what Morgan Stanley believe potentially could be happening at this Fed meeting, they, again, like I said, accelerating the taper, that's basically a standard kind of expectation across the board. But they also expect a significant change in the dot plots at the December meeting. And basically what they're suggesting is they're going to show at least 2 hikes in 2022, 3.5 hikes in 2023, and 3 hikes in 2024. But it is worth mentioning at the same time that this necessarily isn't a standard kind of expectation, because you've also got to factor in the other camp of this Fed debate when it does come to expectations, because you've got the likes of RBC, you've got the likes of UBS even that think maybe the Fed isn't going to go as hard on the hiking. And even if the dot plots to demonstrate that this is some sort of consensus, because there also is the notion or their ability to engage in runoff when it comes to the balance sheet. Basically put that means allowing, Dan, a lot of these maturing securities that they are holding to expire, which will also have the same kind of an impact as hiking rates, but not necessarily spook the markets all too much. So we're going to be looking for Powell to provide any kind of commentary about that as well.
That's right, Will. Let's see what the narrative is from the Fed this week and the implications for markets. We'll leave it there. That's Will Caloris. Thanks, Will. Meanwhile, the CEO of Mubadala, Khaldoon Al-Mubarak, is not too worried about inflation. That's despite those latest figures. Speaking to CNBC's Hadley Gamble in Dubai, he says that his view on the US is more about taking a long-term perspective. Listen in.
Listen, when you're a long-term investor like us, I think these challenges, interest rates, inflation, cycles, energy cycles, semiconductor cycles, they come with the territory. You know, we're designed to anticipate.
It's transitory.
It's transitory. It's absolutely transitory. I take a long-term view on the United States, and I continue to have a positive, bullish view on the U.S. market.
And as we mentioned, we're going to have more from Hadley's exclusive interview with the CEO of Mubadala throughout the show, so do stick around for that. And of course, as we were flagging before, it is a central bank heavy week. Not just the Fed, but of course the ECB, the BOE and the BOJ all meet this week as well. And besides inflation, the COVID threat is also far from over. The COVID death toll in the United States now crossing 800,000, while the UK is also raising its COVID threat level to 4 as Omicron cases continue to spread. British Prime Minister Boris Johnson warning of a tidal wave of infections and that 2 vaccine doses will not be enough to contain that surge. Let's get you some insights on the market. Stephen Glass is Managing Director and Analyst at Pella Funds Management, joining us live from Sydney now. And Stephen, thank you so much for your analysis today. Let's get straight into this central bank focused week that we are coming into as we speak. No doubt investor attention shifting to the type of narrative that we're going to see coming out of the Fed. With regards to the November CPI print, though, do you think we have hit peak inflation?
Well, that's a very, very difficult question to answer. And part of the reason we at Pella have some difficulties answering that is that inflation figure includes something called owner's equivalent rent, which is the biggest part of the CPI figure. And it's currently coming in at in the low single digits. But when we look at the real housing data, it's that owner's equivalent rent's coming in at 14%, 15%. So housing prices are going up in the mid-teens, rents are going up in the mid-teens, and yet that component of CPI is very low. And so when that adjusts, that could actually put a lot of upward pressure on inflation. On the other hand, we are seeing energy prices come down, so that obviously will have a delayed impact. If we're at the peak of inflation, I don't really know, and I think very few people do. But what we do know is inflation is running very hot, and the real question, I think, is how long will it How long will it run hot for? So whether it drops a bit or rises a bit really doesn't bother us that much. It's how long it remains within the current bracket that it's in, and I think that's really the key concern.
Indeed, and debate is still raging over just how transitory inflation is. You have people like Khaldoon Al-Mubarak, who you just heard from, who says it is transitory. People like Mohammed Al-Arian say the Fed has been getting it wrong on that transitory narrative. So it really does remain to be seen what that looks like moving forward. But with regards to how the Fed responds to this, are we going to see them accelerating the pullback on asset purchases as a result this week?
Well, I think the whole market and the consensus is they definitely will, and we're going to see that 15 billion runoff go to 30 billion. So I think that's priced in. Obviously, if they don't do that, you can expect markets to get a real a sugar rush. But I think that's pretty much priced in. I think it's warranted, and you can actually see it in a lot of Powell's language. For instance, he explained that he thinks it's time to retire the word transitory. So it does look like the Fed is actually gearing up to accelerate their tapering program. And as Will, the prior speaker, actually pointed to, the dot plot is really something that is probably of most interest to the market now. It is certainly something that we'll be watching very carefully. And our expectation, as it has been through the whole year, is the dot plot's going to show a more aggressive Fed with an accelerated interest rate hike program next year. The big question is how long can they actually do it? And with the US very highly indebted, the market's really hinging on low interest rates, we just see a ceiling to future interest rate increases. So certainly a more aggressive Fed next year, but they will not be able to push as high as they might want to because of the indebted US consumer and also markets so dependent on low interest rates.
Okay, so what's your current read on what this might mean for asset markets? And if we do indeed see this tightening cycle coming a little sooner than expected, what's the best strategy to put in place?
Well, as always, at Pella, we believe one needs to have a balanced strategy because forecasting these things can be very, very difficult. We've seen it not so long ago. Things were very sanguine and you wanted to, inflation wasn't round the corner and now we're seeing huge inflation. So we always want to be very balanced. So we think on the inflation side, things like derivative exchanges, which I've spoken about many, many times to your viewers, are a very smart play. They will do well if interest rates are hiked. Because not only will there be an increase in volatility, but it also means more of the debt that's issued goes out into the market where it's hedged rather than sits with the Fed where it's unhedged. So derivative exchanges are a great play for an inflationary environment. Having said that, high growth stocks are very good if interest rates aren't hiked too aggressively. And so we do have a number of positions in faster growing companies like Teladoc and SunPower. So Sunrun, excuse me. So we do think one needs to be balanced, and as always, be in companies that will make money no matter what the interest rate environment is.
Indeed. All right, Stephen, we'll leave it there. Thanks for your analysis today. That's Stephen Glass of Pella Funds Management. Okay, moving on now. And up next on the program, the head of Abu Dhabi's Sovereign Wealth Fund telling CNBC about his bullish outlook for the chip industry. We're going to bring you more from our exclusive interview with the CEO of Mubadala up next. Plus, perhaps some sore heads in Abu Dhabi today after one of the most thrilling ends to a Formula One season ever. Red Bull's Max Verstappen overtaking Mercedes driver Lewis Hamilton at Sunday's Abu Dhabi Grand Prix in a high-drama 58th lap to seal his maiden F1 World Championship and denying Hamilton a record 8th win. We'll bring you all the highlights up next.
Men over 40.
Welcome back. The CEO of Abu Dhabi's investment vehicle, Khaldun Al Mubarak, has a bullish view on the future of the semiconductor industry. Speaking to CNBC's Hadley Gamble in Dubai, the Mubadala head says he expects the sector to record exponential growth over the next decade. Mubadala is a major shareholder in the US chipmaker Global Foundries, which just raised $2.6 billion in one of the largest listings on a US exchange this year. Listen in.
I think we made a very good, now in retrospect, thematic view in terms of where we saw this industry going back in 2007. And of course, I think over the last 12, 13 years, it's been an incredible journey with reaching a very important milestone, which is taking that company public in 2 months ago.
So
You're planning to spend as much as $1 billion to increase capacity. How soon do you think we'll see an end to this global chip shortage? When will supply meet demand?
Well, we've lived through that journey. When we entered that business back in 2007, it was AMD. It was investing in a company which we thought was going to be a company that will be very successful, that had a differentiated technology, but that was, at that point, doing two different things, doing the design side of it and the manufacturing side of it. I think the view we took back then was, of course, with AMD, that the manufacturing side needs to be spun off because achieving scale and being able to compete on a global platform required it to essentially service many customers. So turning from a aspect of a business within AMD that was serving one customer in AMD to then being an independent manufacturer, an independent foundry, that led to the establishment of global foundries and eventually what we'll talk about a bit more, which is the journey of global foundries. I think that was the first very important decision point back in 2007. AMD back then was small. I think had very interesting prospect. We had a very, I would say, strong view about the semiconductor business, technology, where it was going. And I think we made a big bet on AMD. And over the years, AMD, the story, has been an incredible success. Its CEO, Lisa, has been one of the most incredible CEOs, I think, in the sector. Well, to be honest, in business overall, really phenomenal CEO. And with that, we've seen AMD become now the player we were always hoping for back in 2007.
In terms of that growth and the need, supply meeting demand, what's your outlook? Because you have a bird's eye view on this at this point. So
it took 50 years for the semiconductor business to turn into a $500 billion business. It's going to take probably 8 to 10 years to double. And it's going to double right after that, probably in 4 to 5 years.
Yeah.
So you take that as one very important data point. You combine that with another very relevant data point. There's only 5 players. There's 5 foundry businesses, global foundry businesses, 4 of which are in Asia.
Yeah.
One of which, Global Foundries, has, I think, the unique differentiated platform of being in the United States, in Europe, and in Asia.
Hadley also asked Khaldun for Mubadala's view on crypto and the blockchain ecosystem. And unlike some others, he's not as skeptical about this space.
This is a business that had, $200 billion worth of crypto value 2 years ago, and it's $2.5 trillion today and growing. So I think, while many people are skeptics, I do not fall in that category. I think we look at the ecosystem around crypto, and I think we are investing in that ecosystem. That's in the blockchain technology, energy usage, etc.
Up next on the program, Israeli Prime Minister Naftali Bennett touching down in the UAE for an historic visit as he looks to shore up relations with the Gulf amid rising regional tensions. We'll bring you details on the other side of this. We're back in 2 minutes.
Why are so many
Welcome back to the program. Okay, over to the black stuff now, and we see oil prices moving higher. Of course, we are going to be watching out for OPEC's monthly oil market report, which is due out later today. Oil has been rallying. It turned in its best week since August, just last week. And Goldman's global commodities head, Jeff Curry, says prices are heading towards $90 a barrel from next year.
One thing that's apparent going into year end, just given the volatility, is that risk is going to be slow to come back into this space. We don't think until after the first of the year that you start to get a lot of risk ready to put positions on. You know, they get a clean slate after January 1st. At that point is when we think you get the real upside back towards $90 a barrel.
Meanwhile, the latest round of Iran nuclear talks resumed again over the weekend. The UK says there's still time to save the deal, but it was Iran's last chance. While Tehran says good progress is being made at the negotiations in Vienna, it remains critical of where European powers stand on the deal. Iran accused those European members of not bringing constructive proposals to the table to help revive the deal. And those talks will be at the center of discussions during Israeli Prime Minister Naftali Bennett's visit to the UAE today. His arrival marks the first official visit by an Israeli leader to the Emirates. Bennett will meet the Abu Dhabi Crown Prince as he looks to strengthen ties with the Gulf amid the ongoing tensions in the region. Israel has previously mentioned the prospect of joint defences with Gulf Arab states who are also concerned about Iran's activities. And the Iranian President Ibrahim Raisi presented the state budget on Sunday, aiming for 8% economic growth and increased crude oil sales of 1.2 million barrels per day despite US sanctions. The new budget is about 10% bigger than the current budget in local currency terms, but its value in real terms is lower due to annual inflation running at more than 40%. Up next on the program, Saudi Arabia's budget expecting its first surplus after years of deficit. We'll bring you the details up next. And as we head into a break, take a look at how Middle East markets kicked off the trading week on Sunday. Capital Connection, back in 2 minutes. Thanks for being with us today. Welcome back to Capital Connection. Here are some of the top stories that we're following. First, the UK raising its COVID threat level as Omicron cases surge. Prime Minister Boris Johnson warning things could get a lot worse. Meanwhile, the G7 putting on a united front and warning Russia it faces massive consequences if it attacks Ukraine, as German Chancellor Olaf Scholz says his country remains committed to safeguarding Ukraine as a transit route for gas. And Saudi Arabia looking to its first budget surplus after nearly a decade of deficits. The CEO of Mubadala speaking exclusively to CNBC's Hadley Gamble, Khaldoon Al-Mubarak weighing in on the UAE's position, which is not just geographically between China and the United States, but geopolitically too. He said, it's best to be in the middle. Listen in.
It is in the interest of everyone to have a global integrated economy. That's served us well in the past, and I think will help in the future, not just the United States, but I would say every country around the world. So I think I am personally of a view that the issues we're seeing today are quite substantial, particularly between some countries, the United States and China here specifically. But I think they're not issues that are insurmountable. When I look at it in the context, and you've asked me that question as a business leader, I see it very plain vanilla from my perspective. The United States is the world's largest economy. China is the second largest economy.
For now.
For now. And in a matter of time, China will be the largest economy. You know, is it 5 years? Is it 10 years? Is it 20 years? People will take different views, but it will happen at some point. In today's lens, these are the two largest economies in the world. And for any investor, for any business leader, and for any supplier of anything, having access to these markets, to these two markets particularly, but having open access, I think is very, very important. So anything that helps maintain an environment that allows that access and allows companies and of course countries to benefit from open trade, I think this is conducive for growth. So back to me. We're as a country here in the UAE, a country built on commerce, trade, growth. That's what we're all about. We trade with East, we trade with West, North, South, we trade with everyone. That's what's been the foundation of success for the UAE over the last 50 years. And when you look at the next 50 years, if anything, we're doubling down and tripling down on that. And to do so, we have to continue to grow with the West, the United States, Europe, South America. We have to also double down on the East. These are incredible economies. China, India, Japan, Korea, very important markets. Markets that we've had, I would say, exceptional relationships over the last 50 years, and relationships that we want to grow. So we want to be in that middle. It's a good position for us to be in the middle, and it's a good position for us to continue to be an objective, commercially conducive investment location, but also investor in this growth story.
Saudi Arabia is projecting its first budget surplus in nearly 10 years. It comes as pandemic support is being winded down and oil prices continue to rise. The kingdom is forecasting a fiscal deficit of 2.7% of GDP this year, but it expects a surplus of 2.5% of GDP in 2022. It also expects a 2.9% GDP rise this year and a big 7.4% jump next year. Let's bring in Toby Isles. He is Director, Sovereigns of Fitch Ratings, joining us from Hong Kong. Toby, great to get your analysis on the region. You know, we've seen the best year in more than a decade for Gulf stocks. As I flagged before, we continue to see oil prices also rising throughout the course of the year. Just how constructive is the backdrop for the GCC heading into 2022 in your view?
Yeah, I mean, that's right. We look at three themes across the region. And when we look at the oil market, when we look at in terms of reforms, budgetary, economic reforms, and also in terms of regional politics, then there's something positive to say about all of those themes, and it's more constructive than it has been for a number of years. So in 2022, we do see that growth will be pretty strong in the GCC, and that's partly driven by the OPEC plus taper So we'll see big increases in oil output, sort of 8 to 15% growth in oil output, depending on the country, excluding Bahrain and Qatar, which will be stable. And also, vaccination rates very high in the GCC in general, which is useful for limiting economic restrictions. And then, I think it's quite important that fiscal and budgetary reform has been quite a big emphasis ever since 2014. But COVID has also helped sort of instill a sense of needing to have greater fiscal sustainability. So that's an interesting theme. And finally, this sort of regional political rapprochement, so within the GCC, slightly more sort of constructive relations between the GCC and Iran. It's not black and white, but it's better than it was. And even beyond that, so with Turkey, so there seems to be a greater sort of pragmatism in regional politics across the GCC, which definitely helps the outlook as well.
Absolutely, as the COVID recovery continues to take shape. And Toby, as you alluded to, some of the largest economies in the region stand to benefit from this shift in dynamics. Saudi Arabia in particular, higher oil prices and significant budget reforms now mean that Saudi Arabia is on track to deliver its first budget surplus, I think, since 2013. What's your outlook for Saudi, and do you see any key risks on the horizon for that economy?
Yeah, well, we also forecast a surplus for next year, largely with the oil production going up and oil prices remaining firm. And then, on the non-oil side, they've enacted reforms such as tripling VAT, which is feeding through. So the revenue side looks pretty strong. And then on the spending side, I think what's interesting about the budget is that they're emphatically sort of saying we're sticking to our spending ceilings. We're going to sort of stay very disciplined despite the higher oil price environment. And I think that's quite an important signal. Obviously, it's not a given that it will happen. It's quite ambitious, but that's something where they're trying to sort of say, well, we're delinking our spending from trends in the oil market, so that will be positive if it happens. I think the one sort of maybe interesting nuance to add is that this discipline of the budgetary spending comes alongside increased spending elsewhere in the economy. So also, in particular, sort of government-related entities. So we're seeing the Public Investment Fund spending more, Aramco spending significant amounts. And so that is allowing the sort of capital spending on budget to come down and so helping performance. So there's that sort of nuance there to bear in mind.
Indeed. And I also get the sense that coming through the COVID recovery, there's been a renewed emphasis on attempting to diversify that economy and society to future-proof it in order to continue the growth trajectory. Toby, just quickly, your thoughts on the UAE as well. We know Dubai and the UAE in particular have been a real pandemic winner. High vaccination rates here, as well as easing restrictions. How is that filtering into the growth narrative in 2022?
Yeah. I mean, the UAE is another country which I guess on the policy front has performed very strongly and is very active at trying to sort of bring in more measures to sort of be attractive as a place to do business. So yeah, we'd expect sort of growth in the non-oil economy to be helped by that. And again, as in Saudi, you get oil production pickup in the OPEC plus taper, which is really quite powerful for overall growth numbers. So the UAE growth story looks good. I mean, in terms of sort of the ratings, then the UAE is very highly rated, AA minus, and the asset sort of base of the economy is very strong. Fiscal break-even oil price is lower than market prices. So the situation looks pretty good for the UAE. I guess there are risks, of course, throughout for the UAE, the whole region, and oil. While they're trying to diversify, it remains the key thing. So if there was an oil price shock, that would definitely feed through across the economy, into the finance sector, etc.
Indeed. All right, Toby, we'll leave it there. Thanks for your analysis today. That's Toby Isles of Fitch Ratings. Up next on the program, G7 foreign ministers turning up the heat on Russia, warning Moscow of severe consequences if it invades Ukraine. We're going to discuss the ongoing tensions with our next guest on the other side of this. Stay with us.
Why are so many
Welcome back. The G7 is warning Russia against attacking Ukraine in meetings hosted by the UK Foreign Secretary Liz Truss in Liverpool. It called on the Kremlin to de-escalate tensions at the border. Russia denying plans to invade Ukraine, saying the West was gripped by false assumptions about it. Speaking to NBC's Meet the Press, the US Secretary of State Antony Blinken said G7 countries were prepared to act in a coordinated way if necessary.
There is something even bigger at stake here, and it's the basic rules of the road of the international system. Rules that say that one country can't change the borders of another by force. One country can't dictate to another country its choices, its decisions, and its foreign policy with whom it will associate. One country can't exert a sphere of influence over others. That's what Russia is purporting to assert. And if we let that go with impunity, then the entire system that provides for stability, prevents war from breaking out, is in danger.
Analysis now with Michael Baranowski. He is director of the Warsaw office at the German Marshall Fund of the United States, joining us from Warsaw today. Michael, thank you so much for your time. Let's begin on the situation between the US, Russia, and Ukraine. We've seen G7 leaders warning Russia with massive consequences if it does decide to go ahead and invade Ukraine. Of course, all of this coming after that verbal warning from Biden during his call with Putin just last week. Do we have any evidence at all to suggest that the Russians are listening and indeed are moving troops away from the Ukrainian border?
It's great to be with you, but unfortunately, no, we don't have any evidence that Russia is backing out. In fact, Russia right now is escalating further tensions and is giving the West, the United States, but really the whole West, greater demands. It's asking not only for pullout of any support from Ukraine when it comes to military, but also an economic association with the West. It's asking for very clear legal assurances from NATO that NATO will not enlarge to Ukraine. But lately, Putin also, or the Russian foreign ministry said that NATO should pull out major support from countries in NATO. So his requests now are not only about Ukraine, but about NATO itself. So it's very much an escalation.
Okay, so an escalation. What happens next, in your view? What game is Putin playing here?
Well, Putin is basically trying to negotiate with the West at the barrel of a gun. We know from intelligence reports, from Western intelligence reports that have been made public, that Putin is putting together a force of up to 175,000 troops on the border with Ukraine. Just to give the viewers perspective, this is by far larger force than what we have seen in 2014 when Russia attacked Ukraine's east. It's perhaps actually the largest force we have seen in at least 40 years. Now, the West is remaining resolute, and as you have heard Secretary Blinken outline major principles that would be violated if the West agreed to demands of Russia. It would not be something that only affects Ukraine, as bad as it would be. It would really impact very much the European security system and also the security in Asia if we actually allowed this kind of negotiations at the barrel of a gun. So I expect the United States and West to stay firm and eventually for Russia to back down from these unreasonable requests.
Okay, so talk me through some of the perhaps tools of leverage that the US and the West might be able to employ here in order to get Russia to achieve its goal. I know we have the Americans now calling on the new German government to stop Nord Stream 2. Perhaps that might be a tool of leverage that they can use in order to help get Russia moving in the right direction, or at least the direction that they want Russia to go in. What type of leverage is Nord Stream 2 in your opinion?
Well, the West actually has a lot it has put a lot on the table, and Putin and Russia understands that the West can cripple Russia economically and politically if it decides to go forward with the invasion of Ukraine. That's why we are still talking. What is on the table? Nord Stream 2 is a very important negotiation and leverage tool. And the United States is making clear to Germany and its German government that in case of further escalation, it's really impossible to see to have Nord Stream 2 operational. Right now, the pipeline is completed, but it's not yet working. It's waiting for certification. And frankly, United States is trying to avoid a situation in which it would have to sanction German companies, preventing it from being operational. So it's pushing Germany to do this. But this is not the only sanction. There are also financial sanctions, trade sanctions that would truly cripple Russian economy.
Okay, let's see what happens next. I don't think we've heard the last of this story. Mike, we'll leave it there. Thanks so much for joining us today. That's Michael Baranowski there of the German Marshall Fund of the United States. Appreciate your time. Okay, big story to get you across, in this country at least. Your CNBC Sports Update, and Max Verstappen is the Formula One world champion, winning his maiden title with a last lap pass on rival Lewis Hamilton in the Abu Dhabi Grand Prix that was marked with controversy just over the past 24 hours. Hamilton pipped Verstappen for the lead from the starting line and led for the majority of the race, seemingly headed for a record 8th world title. With 10 laps to go, Red Bull's boss said the team needed a miracle from the racing gods for Verstappen to have any chance of winning. And the racing gods must have heard, right? A safety car 5 laps from the end bunching the field. The much debated decision by race control to let through the lapped cars, separating Verstappen and Hamilton, heavily protested by Mercedes. Fresher tyres on the Red Bull car allowing Verstappen to pass Hamilton and claim championship glory. Capital Connection will be back in just 2 minutes. Stay with us. Welcome back. Let's get you a check on some European opening calls. And it looks like it is going to be a positive start to the trading week, with all of the indices pointing to the upside. Meanwhile, keep an eye on the euro and the pound ahead of the ECB and BOE meetings that are out on Thursday. Meanwhile, Credit Suisse conducting a reorganisation where it will be organised into 4 business divisions starting in January: a wealth management division, an investment bank, a Swiss bank and asset management division. Francesco De Ferrari will head up the wealth management division and will also be interim CEO of Europe and the MENA region. Meanwhile, the UK is raising its official COVID-19 threat level to 4 over the weekend, saying that the rapid spread of the Omicron variant had pushed the country into more risky territory, according to the chief medical officers of England, Scotland, Wales and Northern Ireland. The healthcare system is at risk of becoming overwhelmed, given the more transmissible nature of Omicron. Prime Minister Boris Johnson also issuing a warning about vaccinations, saying it's unclear if 2 doses will be enough to combat the new strain.
No one should be in any doubt. There is a tidal wave of Omicron coming, and I'm afraid it is now clear that 2 doses of vaccine are simply not enough to give the level of protection we all need. But the good news is that our scientists are confident that with a 3rd dose, a booster dose, we can all bring our level of protection back up. I know there will be some people watching who will be asking whether Omicron is less severe than previous variants and whether we really need to go out and get that booster. And the answer is yes, we do.
Meanwhile, over in Germany, the government has been closely watching the developments over Russia and Ukraine as the Nord Stream 2 pipeline hangs in the balance. This was, of course, a very big topic during Chancellor Olaf Scholz's visit to Poland over the weekend. Let's go live to Annette Weisbach joining us from Frankfurt. And Annette, no doubt this is somewhat of a headache for the new German Chancellor, something he'll have to deal with pretty quickly, I guess you could say, as he begins his term.
Yes, it's not just a headache, it's a severe test to the new government and also where it stands when it comes to foreign relations. They still need to find their common approach to what the response could actually be if Putin was to invade the Ukraine. So far, it's like a standstill situation, but of course, that could change every single moment in time. Take a listen of what Olaf Scholz, the new Chancellor of Germany, had to say about the situation.
Europa ist eine Werte- und Rechtsgemeinschaft und
we are watching the troop movements along the Ukrainian border with great concern, and we are making it very, very clear that the borders in Europe cannot be violated and that the integrity of its borders and countries is crucial. It should be clear that no one should think they can violate them without having harsh consequences.
So essentially what he was saying was more or less echoing what Angela Merkel was saying before, that they want to ensure that Ukraine is staying a energy transit country for Europe. And of course, one of the conditions to open Nord Stream 2 at some point in time is to put a lot of money into the Ukraine to build it up as a renewable energy country. But so far, it doesn't really look that we're moving anywhere as to open Nord Stream 2. Annalena Baerbock, the foreign minister, yesterday was very outspoken that we should just not open it altogether. Olaf Scholz is more hesitant about the fact. I think he just does not want to lose that token in the irritations and also in the confrontation with Russia. So far, nothing, as I said, nothing has been decided. But Poland, it's an interesting relationship anyways. Poland is a country which is insisting on its independence when it comes to its juridical system, and they are in a controversy with the European Union about that, for example, as well. So it was a visit to Poland, the first state visit of Olaf Scholz, which had a lot of topics, among others, the litmus test, what happens at the Ukraine border. With that, over to you.
Annette, thanks for the update. Okay, that wraps up this edition of Capital Connection. Thanks so much for your company today. I'm Dan Murphy in Abu Dhabi. Stay with us. Squawk Europe is up next.
Be first on top of
In any doubt, there is a tidal wave of Omicron coming. And I'm afraid it is now clear that 2 doses of vaccine are simply not enough to give the level of protection we all need.
That's the UK Prime Minister Boris Johnson issuing a stark warning over the Omicron variant and offering booster jabs to all adults in England from this week. Elsewhere, US inflation spikes to its highest level since 1982, back when a gallon of gas cost just 91 cents. But the CEO of Abu Dhabi's Sovereign Wealth Fund tells CNBC he's still backing America.
I take a long-term view on the United States, and I continue to have a positive bullish view on the US market.
A Madrid court orders Santander to pay the UniCredit boss Andrea Orcel 68 million euros over its withdrawn offer to be CEO in 2018. And scores of people are thought to have been killed as a cluster of tornadoes rampages through at least 6 US states. Right, a lot of stocks, as you know, and good morning to you all, by the way, have had a fantastic 2021. One of those stocks isn't Credit Suisse, which year to date is down circa 23%, underperforming a whole host of its peers and trading on a price to book level around about half the industry median, down at 0.47. price to book. But they are announcing now some updated membership of the executive committee, announcing appointments to the executive board in line with a new strategy, new board of directors leadership appointments to enhance the governance of subsidiary boards. They are appointing Francesco De Ferrari as the CEO of the Wealth Management Division. He will join the executive board of Credit Suisse effective the 1st of January, reporting to Thomas Gottstein, the chief executive officer. De Ferrari has also been appointed as interim CEO of Europe, Middle East and Africa. They're also saying that Christian Meissner, the CEO of the Investment Banking Division, has been appointed as CEO of the Americas region as well. And those look like the key points there. Of course, internal audit. This was an area that came into big focus over at Credit Suisse over Archegos. Well, Mark Hannam has been named as the head of internal audit. Credit Suisse shares, as I mentioned, a huge underperformer versus their peers in 2021. Right, so back to the top story. The UK has moved to COVID-19 alert level 4. Apparently that's the second highest after medical chiefs warned that the Omicron variant is spreading much faster than Delta, whilst vaccines offer a reduced level of protection against it. Social distancing measures have been resumed and health services are bracing for a potential jump in hospitalizations. Well, the Prime Minister, Boris Johnson, warned of a, quote, tidal wave of infections and urged people to book booster jabs, which will be offered to all adults by the end of the month.
Our scientists are confident that with a third dose, a booster dose, we can all bring our level of protection back up. I know there will be some people watching who will be asking whether Omicron is less severe than previous variants, and whether we really need to go out and get that booster. And the answer is yes, we do. Do not make the mistake of thinking Omicron can't hurt you, can't make you and your loved ones seriously ill. We've already seen hospitalizations doubling in a week in South Africa, and we have patients with Omicron in hospital here in the UK right now.
And meanwhile, a group of Israeli scientists have concluded that 3 shots of the Pfizer-BioNTech COVID vaccine help protect against Omicron. The director of infectious diseases at Sheba Medical Center said its real-world study concluded that boosters increase protection against Omicron, quote, 100-fold. Meanwhile, a South African study found a 2-shot course of the Pfizer vaccine has just a 23% efficacy versus Omicron. The findings follow a report by the UK's Health Security Agency saying boosters were up to 75% effective. Meanwhile, White House medical advisor Dr. Anthony Fauci says booster jabs offer, quote, optimal care amid the current COVID wave. The push for a third jab comes as the Omicron variant has now been identified in over 25 US states, with some beginning to reintroduce restrictions. New York will implement a statewide mask mandate in public places from today, unless a vaccine pass is shown. US inflation, meanwhile, in November surged to its highest annual rate in almost 40 years, hitting 6.8%, ramping up pressure on the Fed to tighten its monetary policy sooner rather than later. Rising energy prices have fueled much of the rise in consumer prices, with the energy index up 33% year on year. Gasoline prices up almost 60%. Elsewhere, autos, food and shelter costs contributed to the highest yearly figure since 1982. Well, speaking to our colleagues stateside, the White House's director for the National Economics Council said the government is not too concerned with the year-on-year surge in CPI following last year's lockdown, but did add it still can be looking at how it can ease the inflationary burden.
Prices are high, and we are very focused on that issue. We are focused principally on the month-to-month movements, because if you compare to a year ago, we're comparing to an economy that was in shutdown. And in November, we saw some modest easing from the prior month. And if you look under the headline, about half of that was driven by energy and cars. Those are both areas where we've seen some easing in the weeks since. Notably on energy, we're seeing gas prices down a bit nationally. Natural gas prices down 25% from November. So that is something to take note of. But we here are very focused on what more we can do to try to address the price issues that Americans are facing.
Right, but let's take a look at the US markets, and there is an enormous divergence between small and mid caps and indeed what we're seeing at the largest companies, so much so that the SP 500 has now registered its 66th at a record high of 2021. That record high occurred in Friday's session. It was a huge week for US equities and other products as well, with the Dow rallying 4%, up 216 points, as you can see on Friday, but 4% higher for the week. The S&P was up 3.8%. For once, the Nasdaq, the laggard, perhaps has a slight bit of interest rate concerns there, and what a faster taper and potential rate hikes next year will mean for technology stocks. That was up 3.6% for the week. Incidentally, still 3.6% off its record high. Every single sector was up last week. Technology put on 6% to the upside. And yet the treasuries and the yield curve did not pick up aggressively. Remember, ladies and gentlemen, before we had talk of taper, before we had talk of up to 2 or 3 hikes in 2022. We saw a yield earlier in the year, around about March, of 1.76% for your 10-year paper, even after the sell-off in bonds last week. And it was a minor sell-off from a 1.38 handle, I think, on the 10-year to 1.49%. Even after that, we still see dramatically lower yields on your fixed income. And that may be a part of the growth concerns rather than inflation fears of 2022. Let's have a look at the dollar crosses. The dollar actually didn't do too much in terms of the dollar index last week. Friday, it was down 0.2%. For the week to date, it was flat. But as you can see, trading at elevated levels versus sterling, 132.50 is where that is trading. Euro is trading 112.94. Again, growth concerns and about when we're going to get liftoff in Europe as well. But one thing we haven't mentioned a lot today, and that is that we're going to get an awful lot of central bank action this week from the Fed, of course, the last meeting of the year on Wednesday. We'll get the results of that. Plus, we'll get the SEP, which is the economic projections dot plot, so to speak, as well. That's the summary of economic projection there. Bank of England, and indeed, what's the ECB going to do about tapering? People talking about a dovish transition on the tapering there. That doesn't sound too aggressive, does it, from Madame Lagarde's group there? So we are seeing the dollar yen in the meantime. Dollar yen 113.48, dollar yuan 6.36. Asian indices look like this. The Nikkei up 200 points. Mixed data out of, it was a bank survey, central bank survey on services and manufacturing outlook, and services much higher, much improved to a 2-year high, but manufacturing concerns, raw material costs, keeping the manufacturing component there under a degree of pressure. Let's have a look at the opening calls for the European markets. The FTSE called up 17 points. The Xetra DAX 61, 32 higher for the CAC 40, and the FTSE MIB seen up 122 points. So, G7 finance ministers holding a virtual meeting today where the recent price spikes are expected to be a key focus. Inflation in the euro area and the UK has surged in recent months, with the latest readings coming in at 4.9% and 4.2% respectively. Well, Ben Emmons is Managing Director of Global Macro Strategy at Medley Global Advisors and is up nice and early for us, or nice and late, depending on where you are, Ben. Nice to see you today. Thank you very much indeed for joining us. Well, look, I've spoken a lot in the last 5 minutes about inflation, temporary or otherwise. What do we expect the central banks to do this week?
Good morning. Thank you for having us. Well, we can expect some communication related to inflation, because it does sound that not only the Federal Reserve, but also the ECB and Bank of England are serious about tackling inflation in the coming year. I think in the case of the Federal Reserve, we can expect much more about their projections shifting, particularly as it relates to interest rates. Whereas in your case, the Bank of England, the communication has been somewhat challenged, and again challenged by your developments on Omicron and how it may impact the UK economy. But apart from all of that, inflation is an issue. So I do think that central banks will be quite stern on inflation in the coming week.
Ben, I knew you're of a vintage probably quite similar to me. So you were around in 1982. In 1982, according to my team who've put together some stats here, the interest rates at the end of the year at the Federal Reserve were 11.5%. Does the Federal Reserve need to be more aggressive on hiking rates in 2022?
So far the market has said that lift-off should happen, but the Fed funds rate can only go up to about something like 1.5%, which is like a percentage point below what the Fed actually forecasts as their long-term Fed funds rate, which is about 2.5%. So that is somewhat of a benign outlook, if you will, whereas in the Federal Reserve, although as indicated, they want to perhaps taper those purchases down faster, and there's been voices on the Federal Reserve that say like we should start thinking of liftoff sometime next year. It doesn't indicate there's going to be any faster path than that at this point. Now, to your question, should they do this faster? That I think really depends upon the acceleration of inflation into the first quarter, because so far this has all been driven by the reopening of the economy, which turned out to be much more resilient and stronger than anyone anticipated, which at some point also should see inflation somewhat abate. So I think this is where the Federal Reserve currently is and where the markets are. You must start with liftoff, but to be too aggressive may not be the right thing to do at this point.
But the US especially, Ben, is going to get such an enormous amount of stimulus from various programs coming out of the federal government. And if Mr. Biden has his way, there'll be trillions more on the way as well in terms of money being flooded into the US economy. Surely this is going to create more inflationary pressure. So this all becomes very political at some stage.
It already has, I think. If you follow the comments by Senator Manchin, who has been working quite diligently the entire year to dwindle down the total package that was released, as you indicate, something closer to 4 to 5 trillion of total stimulus, that the initial package that is probably coming at some point in the foreseeable future of less than 2 trillion or maybe even down to 1.5 trillion was all based upon that too much stimulus is too good of a thing. It would be pushing up inflation too much from where we are already. And that, I think, is a political point, as you mentioned, as opposed to the economic side of it, that, well, we do have an ailing infrastructure here in the United States. We do need more investment, and we do need to have a better allocation of productivity across the economy. So the trade-offs here, I think, against the picture of inflation. So I think the political aspects are, yes, this is the narrative, and that's what people are looking at. Ultimately, I think the fiscal stimulus that we're going to get will be very infrastructure driven with an aim on investment. That probably is not going to be as inflationary as people think.
What should our viewers do in the markets this week? We've got this wealth of data. We've got retail sales as well, Ben. What is the smartest thing that our viewers can be doing at the moment?
So one thing is to stay invested in the market. I don't think you should be paring back in any way, because as much as that we have another variant and it will somewhat slow down the economy or economies, it's, I don't think, leading to a major shutdown of anything. So the recovery is continuing. So I think you should continue to stay invested. Secondly, yes, inflation is an issue and you should position accordingly. So in inflation-linked securities, or looking maybe in some areas like emerging markets where interest rates are much higher and they're combating inflation faster, maybe interesting opportunities to look at this point.
Are the emerging markets dealing with this threat with the higher rates as well? I mean, obviously, it's a very sketchy performance. Certainly, I know the Turkish central bank is, very interestingly, enterprisingly, moving in the opposite direction. But do you actually think that, as a rule, emerging markets have got a grip on this?
I think the case, for example, of you're looking at Brazil or Mexico, those central banks have moved much more substantially ahead of the Federal Reserve in a far more aggressive tightening campaign that starts to slowly bear fruit as we speak. You know, in Brazil, for example, inflation is coming slowly off. It's really high. So it does show that eventually you get that inflation rate under control. Also, what's important, I think, is that the currencies in these countries have not substantially weakened any further, in part because of this aggressive tightening campaign. That too, I think, helps at some point moderate inflation in these countries. So I think those are examples of where, yes, central banks are credible and ahead of the curve, perhaps, whereas in our case, in the developed markets, we're dealing maybe still with a behind the curve situation. So that's why I think emerging markets at this point look attractive.
And Ben, just a final question, really. Omicron, it's dominating headlines, and it dominated the market fall we saw a week and a half ago as well. What are you reading that and how we put this into portfolios now? Because, of course, interest rates, the most dominant factor in traditional thinking. But now Omicron, yes, it appears to be highly transmissible, real concerns about the efficacy of the vaccines. But at the moment, again, there is a bit of evidence saying that hospitalizations haven't picked up aggressively. How do our viewers even think about putting this scenario and this story into their thinking?
As you mentioned, hospitalizations is where markets connect to shutdown and disruption of the economy, right? Because if you get an overloaded healthcare system, we have to slow down economic activity to get that issue under control. And that's no longer the case, because as much as vaccine efficacy is lower and tested in this particular case, it's not zero, and the vaccines do work. So I think markets should continue to trade on as limited disruption of the economy as it is. And I think that's what you should reflect in your portfolio, meaning more cyclical positions, more positions about the reopening. On the other hand, we do have to keep in mind that Omicron is serious and that it could affect confidence and could cause some uncertainty, and could also, again, put more pressure on the supply chain globally, which do, as we know now, perk up inflation. So I think for that reason, particularly developed markets, they may indeed deal with the stickier inflation. So you should reflect that in your portfolio as well by having more inflation protection.
All right, Ben, that's great. What were you doing in 1982? Can you remember?
I was like about 10, 12 years old or so. I remember inflation, but I was, just becoming a teenager. So I had a lot of fun.
Yeah, I was a similar vintage. I remember as well, 1982. Goodness me. Thanks very much indeed for that, Ben. Ben Emmons, who is the Managing Director, Global Macro Strategy at Medley Global Advisor. Yeah, the producers who are so lackluster on many things got very excited about this, and so give me a whole wealth of data about 1982. Bank of England rates by the end of the year? 10%. Yearly inflation was 8.6. Apparently, Michael Jackson's Thriller came out. It was also known for the 14-minute long horror-themed music video. We've all seen that too many times, haven't we? AT&T was ordered to break up. The monopoly was ordered to break up in January 1982. Whatever, well, less exciting, I guess, for many. The Argentinians invaded the Malvinas or the Falklands. What else was happening? Late Night Show, first episode with David Letterman, February 1982. I mentioned this, of course, because if you missed the start of the segment, we haven't seen inflation as high as it is in the US since 1982. Thanks, John, for all those stats. Let us move on. I mentioned, actually, the interview with Ben there. It's a big week for central banks across the globe as they hold monetary policy meetings and review pandemic support measures, all as the Omicron variant hangs over their heads. At its two-day meeting starting on Tuesday, the Fed will discuss its taper plans. And I think the key point here with the Fed, isn't it, is the summary of economic projections as well, and how. And we know that policymakers are going to be moving forward when they think their first rate hikes are going to be potentially. But later in the week, the ECB will review its asset purchase plans. The Bank of England, the Bank of Japan, the Norge Bank, and the Swiss and Turkish. Well, I mean, the biggest fund's got to be the Turkish central bank. What on earth will they be doing? I had a quick look at the lira versus the dollar, still trading pretty much at its lows of the year, 13.8. Turkish central bank also debating rates and monetary policy in the days ahead. And of course, the Turks, the central bank or the president think that we should lower rates in order to tame inflation. It's a strange one, but there you go. The CEO of the UAE's Mubadala investment company, Khaldun Al Mubarak, is not too worried about inflation in the long term. Speaking to CNBC's Hadley Gamble, Al Mubarak, I should say, said current price pressures are not affecting his investment strategy.
Listen, when you're a long-term investor like us, I think these challenges, interest rates, inflation, cycles, energy cycles, semiconductor cycles, they come with the territory. You know, we were designed to
you think it's transitory, the inflation?
It's transitory. It's absolutely transitory. I take a long-term view on the United States, and I continue to have a positive, bullish view on the U.S. market.
The Mubadala CEO took no sides when it came to tensions between the US and China, but says the issues are not insignificant.
It is in the interest of everyone to have a global integrated economy. That served us well in the past, and I think will help in the future, not just the United States, but I would say every country around the world. So I think I am personally of a view that the issues we're seeing today are quite substantial, particularly between some countries, the United States and China here specifically. But I think they're not issues that are insurmountable. When I look at it in the context, and you've asked me that question as a business leader, I see it very plain vanilla from my perspective. The United States is the world's largest economy. China is the second largest economy.
For now.
For now. And in a matter of time, China will be the largest economy. Now, is it 5 years? Is it 10 years? Is it 20 years? People will take different views, but it will happen at some point. In today's lens, these are the two largest economies in the world. And for any investor, for any business leader, and for any supplier of anything, having access to these markets, to these two markets particularly, but having open access, I think is very, very important. So anything that helps maintain an environment that allows that access and allows companies and of course countries to benefit from open trade, I think this is conducive for growth. So back to me. We're as a country here in the UAE, a country built on commerce, trade, growth. That's what we're all about. We trade with East, we trade with West, North, South, we trade with everyone. That's what's been the foundation of success for the UAE over the last 50 years. And when you look at the next 50 years, if anything, we're doubling down and tripling down on that. And to do so, we have to continue to grow with the West, the United States, Europe, South America. We have to also double down on the East. These are incredible economies. China, India, Japan, Korea, very important markets. Markets that we've had, I would say, exceptional relationships over the last 50 years, and relationships that we want to grow. So we want to be in that middle. It's a good position for us to be in the middle, and it's a good position for us to continue to be an objective, commercially conducive investment location, but also investor in this growth story.
So coming up on the show, US-Russia relations turn increasingly icy as the G7 issues a stark warning. And for more on the US's inflation throwback to the year of Michael Jackson's Thriller, check out the Squawk Box podcast. President Biden is set to hold more talks with his Russian counterpart as tensions rise over a buildup of Russian troops on the Ukrainian border. Mr. Biden has warned President Putin that Russia will pay a, quote, terrible price if it invades Ukraine. In response, Putin has demanded guarantees that NATO will not expand further to the east. The crisis-dominated conversation at the G7 meeting in Liverpool this weekend, where UK Foreign Secretary Liz Truss accused Russia and China of seeking to, quote, undermine liberty. The Israeli Prime Minister Naftali Bennett is in the UAE on what is the first official visit by the Israeli leader to the country. It comes at a time of high tensions in the region amid talks to resuscitate the Iranian nuclear deal. Well, Dan joins us from Abu Dhabi, where he has plenty more detail. Good morning to you, Dan.
Hi there, Steve. Well, Naftali Bennett is indeed making history today. As you say, this is the first official visit for him as Prime Minister to the UAE, but also the first time we have ever seen an Israeli leader on official business in the country after the signing of the Abraham Accords last year. You'll recall that the former Israeli leader Benjamin Netanyahu wanted to come out to do a victory lap after the signing of the Abraham Accords and, of course, in the midst of the Israeli election, but those stars did not align. So instead, Naftali Bennett gets a turn to make history. As you can see there, he met with the UAE's de facto leader, Sheikh Mohammed bin Zayed Al Nahyan, getting off the aircraft there. And there really is three core focuses of this visit. The first is going to be, of course, improving optics in the Gulf, strengthening ties with those countries that are signatories to the Abraham Accords after a very turbulent period in Israel that has seen clashes between Israelis and Palestinians over the past few months. Secondly, he's also going to be looking to enhance business opportunities here as well in areas like trade, in health, and of course, energy. Since the signing of the Abraham Accords, we have seen significant business deals being done between the UAE and Israel, dozens of memorandums of understanding being signed as well. So really opening up markets on both sides. But I would say the most important thing to be looking at here is progress on the Iran nuclear deal, because those talks are getting back underway. We know the US has been perhaps looking to heal some long-running differences that it has with Israel over how to proceed here. Those talks now entering a seventh round of negotiations in Vienna. The Iranians continuing to drag their feet on those talks and perhaps, at least according to the United States, asking for too much. Israel has long opposed the JCPOA, and the UAE is, of course, stuck in the middle, looking to attempt to try and keep the region stable as a result, and perhaps also just looking to continue to grow economically here. So exactly how these three players, the US, Israel, and the UAE, can square off on Iran is going to be a key focus of the Israeli leader's visit here. Back over to you, Steve.
Dan, thank you very much indeed for that. Okay, coming up on the show, supply chain crunches threaten to squeeze wallets over the holiday season. We'll bring you the latest on that story after the break.
A new story has
Prime Minister Boris Johnson issuing a stark warning over the Omicron variant and offering booster jabs to all adults in England from this week.
No one should be in any doubt. There is a tidal wave of Omicron coming. And I'm afraid it is now clear that 2 doses of vaccine are simply not enough to give the level of protection we all need.
US inflation spiking to its highest level since 1982, back when a gallon of gas cost just 91 cents. But the CEO of Abu Dhabi's sovereign wealth fund tells CNBC he's still backing America.
I take a long-term view on the United States, and I continue to have a positive, bullish view on the U.S. market.
Executive change. Credit Suisse overhauling its board with a swathe of new executive appointments and planning to restructure the group into 4 key divisions, with Francesco De Ferrari set to lead the wealth management business. And a Madrid court orders Santander to pay UniCredit boss Andrea Orcel 68 million euros after the Spanish lender fails to defend its decision to withdraw his CEO offer back in 2018. For not actually taking part in a job, is it? Santander has now been ordered to pay Andrea Orcel 68 million euros. Now, that's after it withdrew his CEO job offer in 2018. The Madrid court ruled the offer letter was legally binding and directed the Spanish bank to pay a sign-on bonus, buyout clause, and 2 years of salary, as well as moral damages. Wow. Orcel, who has been running the Italian lender UniCredit since April, said he hoped this decision would close the matter. So, quote, we can all turn the page. Very expensive page for Santander. Air France says it's redeemed 500 million euros worth of debts from an earlier state loan, which aimed to help the airline recover from the pandemic. The carrier says it will extend the maturity on the overall 4 billion euro loan to 2025. Air France also said it was working on strengthening its capital position, pending market conditions. The Omicron variant threatens to worsen supply shortages, according to the OECD. The sustained surge in shipping costs is now seen by the UN as likely to boost global consumer prices by an additional 1.5%. Well, CNBC.com's Sam Sheed joins us with more on this one. So, Sam, according to the headline that your editors have put in there, even Santa himself won't be able to deliver. How the global chip shortage could dampen Christmas. Is that actually happening? Are people really struggling to get hold of their goods?
That's right, Steve. Thanks for having me on this morning. There are certain electronics that are really hard to get hold of at the moment. The PlayStation 5, for example, is almost sold out everywhere. There are long delays on PCs, and basically everything has a chip in it these days. So it's taking a long time for some things to ship, and some things are just sold out completely.
In terms of, though, what kind of... I mean, to be honest, Sam, I've done a little bit of consumer, research, we call it, with the family over the last couple of days. And I see most products in stock as well. So what actually are we talking about that people can't get hold of?
So the big ones are the gaming consoles. So the PlayStation 5 and the new Xboxes are sold out almost everywhere. These products, they're normally around 350 to 450 pounds when they are selling at their normal recommended retail value. However, they're unavailable. So some people are flogging them on eBay for £500 to £600. Some of the less popular electronics are still in stock. There's a lot of smartphones that you can still buy, but the really popular ones are hard to find.
In terms of when these shortages, Sam, are going to just abate somewhat, any view on this one?
Yeah, so we're looking at kind of next year, hopefully. So in terms of the semiconductor shortage, people are saying summer 2022. Some people think it may even last on into 2023. Also, the broader supply chain issues, so forgetting about semiconductors for a second, but just thinking about everything. There are shipping containers stuck off the west coast of America. They can't get into the ports because there's too many containers and not enough trucks to take them away. So, these things are going to rumble on for a few more months, but eventually, hopefully, they will resolve themselves.
Sam, thank you very much indeed for bringing us this report. Of course, we can read that on CNBC.com. As I say, for more on the effects of the supply chain crunches, head to that page where Sam's article is regarding Santa not even being able to help deliver. Well, is that the case across the board? Well, Mark Manduka is the CIO at GXO. Mark, you're a long way from Citi now as well. So you've made the leap from investment bank to corporate. Congratulations. I hope it's all going really well for you. I know it was announced back earlier this year as well. So just tell us about the shortages as far as you're concerned and actually what might alleviate some of those.
Steve, thank you so much for the intro. And look, we're enthusiastic, exactly as you said. When was there a Christmas where there weren't consoles that were short in supply? Look at the broader piece. We're seeing e-commerce growing very, very strongly. Our business saw e-commerce up 22% in the third quarter. There's clearly been very good signs across the industry of both Black Friday and what we've seen across Cyber Monday. And we're very, very excited about the long-term growth, not just on the high street, but also within the broader e-commerce landmass that we're seeing within our business. Be very clear, Steve. This period has been very strong in terms of consumer behavior, and we're very, very bullish cyclically, seasonally, and structurally.
So in terms of e-commerce versus bricks and mortar, Mark, I mean, this is your speciality. How has this helped alleviate some of those concerns that Sam was just talking about?
Well, I think Sam was talking about things getting better next year. To put some color on that, the air freight market is already showing signs of alleviating. If you look at what's happening in the passenger market, which clearly drives belly capacity, you're beginning to start seeing passengers come back, and that therefore brings some alleviation to that air freight market. That cascades through to the container shipping market, and we're going to start seeing that the worst is now over. We're past the worst of these pains. And then as you work through the system, I think the one thing that will be persistent over the next 12 months is going to be inflation, and particularly labor inflation. So what we're seeing on the ground in terms of this idea, as you say, of Santa being able to deliver this Christmas, very clearly I'm seeing that there's demand for robots right now, demand for technology within warehouses to alleviate some of those labor inflation concerns. This is very much robots working alongside our teammates and creating a safer, more efficient environment. The demand for technology is skyrocketing right now.
Because throughout our lifetimes, Mark, technology has been a great deflator. Now, whether that technology is coming from China or elsewhere as well. But in the very short term, then, I guess that what we're saying is technology hasn't been able to alleviate those concerns, but will do as it replaces labor over the medium to long term. We're saying that technology will once again be a great deflator?
I think there will be some deflation from technology, but fundamentally what we're seeing is that companies are coming to us because they aren't able to implement the technology themselves. If you think about the supply chain, the industry is only about 5% automated, Steve, versus, say, a company like us that's more like 30% automated. So what you're seeing is a differential take place versus the days of old where everything was being pushed around a warehouse by hand. Now, all of a sudden, you're seeing a difference between third-party logistics providers that can provide that critical technology solution versus, say, the more dark ages type warehouses where you're still pushing it around by hand. A differential here between the big, scalable, technology-advanced supply chain manufacturers versus the ones that are still doing it by hand. Big difference coming here.
Mark, and we've all looked with a lot of interest about the efforts of some unions to unionize staff in warehouses in some of the key big companies in the States. Of course, Amazon comes to mind there. Are we basically saying that the days of warehouse men and women are numbered, and technology, from what you're saying, from the very low single-digit levels that they are today, will actually take over in the medium term, or actually will there always be a place for labor in the warehouse?
There's always going to be a place for labor in the warehouse. In fact, we're seeing very strong growth within our labor force. This is very much the case in our business of looking after that holy trinity of customers, teammates, and shareholders. That's really what we focus on as a business. If you think about your question in regards to working with our industrial partners, we've got clearly very strong relationships with all our industrial partners. And what I would say is, from an element of thinking about it of people versus robots, don't think about it like that at all. This is people and robots working together in the warehouse. We're removing menial tasks from the warehouse, and what we're really doing is making the warehouse a safer, more efficient environment to drive that throughput through. And we're seeing very strong throughput for our customers as a result, Steve.
How do we avoid situations that we saw at one of the key, I think it was Ocado warehouses, where the technology was left to its own device? Well, I say that. I don't know the ins and outs of why it went wrong, but it did go wrong. There was a huge problem at Ocado as well. And there were less bodies on site to try and sort this out as well. And that led to huge shortages in the medium term over at Ocado.
It's very interesting. So we have over 1,000 engineers that day by day look at our robotic arms, work with our automated gantries, and make sure that our warehouse is putting technology in, not for technology's sake, but putting it in exactly where it needs to be to drive that efficiency. What you're really trying to do in a warehouse, such as the example that you gave, is really raise the amount of pick rates per hour. And anything that is superfluous to that doesn't get implemented within our warehouse. We're very much focused on driving that efficiency through. And as a result, what technology is doing is it's changing the discussion with customers from being a cost discussion into a revenue discussion. You're moving the warehouse from a commodity into a value-added service. And in so doing, that whole relationship with the customer goes from one of master-servant to actually shoulder to shoulder, trying to help each other be the best version of ourselves. What we're doing at GXO is we're making our customers turn good into great, and that's what technology is all about for us.
So, Mark, that's the end of the interview, but are you missing the city at all now you're now in the corporate world?
We're super excited about what's going on here at GXO. I left, as you mentioned, my city life. I'd been doing it for 15 years, loved everything about it, but there was something so entrancing about a business that has 20, 30, and 40 years of secular growth across automation, e-commerce, and outsourcing. I've never seen anything like this company, so it didn't take much of a decision on my part. I'm super excited to be at this company.
Sound it, Mark. You sound super excited, GXO. Lucky to have you, I'm sure. Nice to see you, and have a great holiday season. We'll see you in the new year, Mark. Thank you very much. Mark Manduka, CIO at GXO. Right, let's move on. Developing story, a desperate search for survivors after a string of deadly tornadoes ripped their way through the southeast of the United States, leaving thousands facing housing, food, water, and power shortages. President Biden declared the disaster a federal emergency and has unleashed millions in aid. Coming up on the show, Irish-American software group Intercom eyes up an IPO sooner rather than later. We're going to speak to the co-founder, Des Traynor, coming up next, first on CNBC.
We put
Mubadala CEO Khaldun Al-Mubarak has said he's bullish on prospects for the chip industry despite current supply shortages. Speaking exclusively to CNBC, Al-Mubarak doubled down on the investment company's position in global semiconductor manufacturers, the one Global Foundries itself.
We've lived through that journey. When we entered that business back in 2007, it was AMD. It was investing in a company which we thought was going to be a company that will be very successful, that had a differentiated technology, but that was, at that point, doing two different things, doing the design side of it and the manufacturing side of it. I think the view we took back then was, of course, with AMD, that the manufacturing side needs to be spun off because achieving scale and being able to compete on a global platform required it to essentially service many customers. So turning from a aspect of a business within AMD that was serving one customer in AMD to then being an independent manufacturer, an independent foundry, that led to the establishment of Global Foundries and eventually what we'll talk about then more, which is the journey of Global Foundries. I think that was the first very important decision point back in 2007. AMD back then was small, I think had very interesting prospect. We had a very, I would say, strong view about the semiconductor business, technology, where it was going. And I think we made a big bet on AMD. And over the years, AMD, you know the story, has been an incredible success. Its CEO, Lisa, has been one of the most incredible CEOs, I think, in the sector. Well, to be honest, in business overall, really phenomenal CEO. And with that, we've seen AMD become now the player we were always hoping for back in 2007.
In terms of that growth and the need, supply meeting demand, what's your outlook? Because you have a bird's eye view on this at this point.
So it took 50 years for the semiconductor business to turn into a $500 billion business. It's going to take probably 8 to 10 years to double. And it's going to double right after that, probably in 4 to 5 years.
Yeah.
So you take that as one very important data point. You combine that with another very relevant data point. There's only 5 players. There's 5 foundry businesses, global foundry businesses, 4 of which are in Asia.
Yeah.
One of which, Global Foundries, has, I think, the unique differentiated platform of being in the United States, in Europe, and in Asia.
Chinese artificial intelligence group SenseTime has shelved its Hong Kong listing after the US Treasury Department placed it on an investment blacklist over alleged human rights abuses in Xinjiang. The group said it strongly rejected what it said were unfounded accusations. Intercom CEO Karen Peacock says the Irish-American software group is planning an IPO sooner rather than later off the back of accelerating growth. Well, let's get some more details now with Des Traynor, co-founder and chief strategy officer over at Intercom. Des, thank you very much indeed for joining us. So, I suppose my obvious question is why the IPO and why now?
Thank you for joining me, Steve. Thank you. Our official statement is that we're past well over 200 million in annual recurring revenue from 25,000 customers. We don't have an IPO announcement or anything like that. What we're really focused on for this year coming is building a lot of breakthrough software for our customers to help them talk to their customers.
But Des, I guess my question is when there's so much money available in the private sector, why do you want all those constraints that an IPO at some stage in 2022 would offer you as well? There are many companies who just said, no, we're not going to bother. In fact, we're going to take ourselves off the equity market because it's just too much hassle.
My thinking on that is, sorry, just as you were answering there, something came in about Omicron. I wasn't sure if I heard it properly, but as it relates to going public or anything like that, for any tech company, obviously the market is pretty volatile at the moment in terms of people not knowing, people reactions to the variant or whatever. However, for us, I think our focus for the next year is bringing on great people, bringing on great customers, and shipping great software.
All right. Okay. And what is your USP at the moment, Des? There's a lot of companies out there who are bringing on some great software in the SaaS and the cloud arena.
We basically 10 years ago, we had the realization that internet businesses had no easy way to talk to their customers. It was all email. Email is dying. Meanwhile, the consumers in the world were switching to messaging. They were switching to like iMessage, Facebook Messenger. We saw what was happening in that, how people were communicating was just fundamentally changing. And we wanted to bring that change to the internet to let businesses and like their customers have conversations with each other, much more like a WhatsApp style conversation. We've been working on that for the last 10 years, where I would approximate we're like 1% done in a sense. But that is how we differentiate. That's how we help our customers grow. They use this type of technology that we deliver to grow relationships with their customers.
Excuse my ignorance. Why can't they just use WhatsApp, Des?
Well, WhatsApp's not designed for internet businesses to support hundreds of thousands of customers, to have like a sort of a customer sort of help desk behind the scenes, to discuss, to have conversations with their customers inside their software. WhatsApp's obviously an external body. With Intercom, you can actually have the conversation with your customer while they're inside your product or on your website.
Okay, fair enough. Fair enough answer. So in terms of the profitability, your company, I think, said we are profitable now. I think that's what Karen's been saying as well. How much money are you making at the moment?
We don't have any revenue figures to disclose, or sorry, any profit figures to disclose at the moment. We have certainly said we've been profitable in the past. It's our focus is growth. Our focus is hiring. Our focus is new software. But we feel confident about our posture for all of the metrics that a typical SaaS business would be reported on.
Sorry, I'm confused. So you are profitable or you're not?
We don't have a statement of that today. We have said in the past we have been.
Okay, because the last I've got from talking to the Irish Independent is that we are profitable now, according to Karen, but you're refusing to give me figures, Des.
Correct.
All right, okay, well, we'll leave it there. Nice to see you today, Des. Thank you very much indeed for joining us. Des Traynor, co-founder and chief strategy officer at Intercom. Well, as I say, big focus for the week is looking at various central banks. We have got a huge summary of economic projections, which is otherwise known as the SEP, otherwise known as the dot plot, coming out from the Federal Reserve on Wednesday. What else is the ECB going to be doing on their inflation watch as well? Are they going to be lessening the pace of purchases of assets? And of course, the Bank of England, which is caught in a bit of a quandary really regarding economic growth and Omicron as we go to stage 4 in the UK. So lots going on. We'll be talking you through this throughout the rest of the week, but also coming up on the show, the US heads back to the good old days, apparently, when the gallon of gas, I think that's gasoline, cost less than $1. A stamp was just 20 cents and you could pick up a house for 70 grand. We'll be back after a short break.
In any doubt, there is a tidal wave of Omicron coming. And I'm afraid it is now clear that 2 doses of vaccine are simply not enough to give the level of protection we all need.
UK Prime Minister Boris Johnson issuing a stark warning over the Omicron variant and offering booster jabs to all adults in England from this week. US inflation spikes to its highest level since 1982, back when a gallon of gasoline cost just 91 cents. But the CEO of Abu Dhabi's wealth fund tells CNBC he's still backing America.
I take a long-term view on the United States, and I continue to have a positive, bullish view on the U.S. market.
Executive change, Credit Suisse overhauling its board with a swathe of new executive appointments and planning to restructure the group into 4 key divisions, with Francesco De Ferrari set to lead the wealth management business. And a Madrid court orders Santander to pay Unicredit's boss, Andrea Ocel, 68 million euros after the Spanish lender fails to defend its decision to withdraw his CEO offer back in 2018. All right, thank you very much indeed for joining the second hour of Squawk Box. The UK has moved to COVID-19 alert level 4, which is the second highest after medical chiefs warned that the Omicron variant is spreading much faster than Delta, whilst vaccines offer a reduced level of protection against it. Social distancing measures have been resumed, and health services are bracing for a potential jump in hospitalizations. The UK Prime Minister Boris Johnson warned of a, quote, tidal wave of infections and urged people to book booster jabs, which will be offered to all adults by the end of the month.
Our scientists are confident that with a third dose, a booster dose, we can all bring our level of protection back up. I know there will be some people watching who will be asking whether Omicron is less severe than previous variants, and whether we really need to go out and get that booster. And the answer is yes, we do. Do not make the mistake of thinking Omicron can't hurt you, can't make you and your loved ones seriously ill. We've already seen hospitalizations doubling in a week in South Africa, and we have patients with Omicron in hospital here in the UK right now.
A group of Israeli scientists have concluded that 3 shots of the Pfizer-BioNTech COVID vaccine do help protect against Omicron. The director of infectious diseases at Sheba Medical Center said its real-world study concluded that boosters increase protection against Omicron, quote, 100-fold. Meanwhile, a South African study found a 2-shot course of the Pfizer vaccine has just a 23% efficacy against Omicron. The findings follow a report by the UK's Health Security Agency saying boosters were up to 75% effective. Meanwhile, US inflation in November surged to its highest annual rate in almost 40 years, hitting 6.8% and ramping up pressure on the Fed to tighten its monetary policy sooner rather than later. Rising energy prices have fueled much of the rise in consumer prices, with the energy index up 33% year on year and gasoline prices up almost 60%. Autos, food and shelter costs also contributed to the highest yearly inflation rise since 1982. Now, Steve Leeson has more.
The problem with the current inflation report is not just that it's high and rising or that it's sticking around longer than most economists forecast. It's that it's widespread. The answer to the question of what's going up is just about everything. The gas in your tank, the heat in your home, the clothing on your back, and the food on your plate, whether you eat at home or go out. It's all going up faster than we've seen in years. But those big gains are not actually the biggest concern for economists. The larger worry is a much smaller number that for Americans really hits home, literally. The cost of housing is up 3.8% year over year, including buying a home and renting, and it's one of the biggest expenses for most Americans. Forecasters think more is to come as the price increases from red-hot housing markets around the country work their way into the inflation index. It could get even worse because employers are hiking wages to attract workers, and they're going to try to pass those costs along, boosting inflation more potentially in the months ahead. Many forecasters still believe inflation could ease by the summer. They used to think the winter, but they ended up having that wrong. If it doesn't happen, look for the Federal Reserve to possibly raise interest rates more than expected, throwing cold water on those hot inflation readings. Steve Leisman, CNBC Business News.
Right, so let's take a look at the US markets. Were they plummeting on concerns about higher rates? No, not exactly. In fact, quite the opposite. In fact, the S&P 500, up 0.951%, hit its 66th record high of 2021. Now, we know there's a massive divergence. We've looked at this a lot, haven't we, between small and medium-sized stocks and the biggest drivers of the S&P 500. A lot of stocks in the S&P, a vast number of them, are still in correction territory. Some are actually in full bear market territory as well. So the S&P 500 is very much skewed, as I know you're aware by now, by the biggest names, which have done rather well. For instance, technology last week was up 6%. Week to date, consumer discretionary, which includes the likes of Amazon, was up 2.5%. So despite all of those concerns we're seeing, US markets hitting record levels on the broader S&P. The Dow was up 4% last week. The NASDAQ was up 3.6% and is interestingly actually another 3.6% away from its all-time high. The Treasury as well, where were we? In March, we were 1.76. Now we're still only 1.49, and that is very interesting, despite all that we've said about what we think is going to happen in the summary of economic projections when the Fed announces its rate decision in the middle of the week as well, about what we think it means that a lot of Fed members are going to be upping their estimate of the first, second, possibly the third rate hike to potentially 2022. There are a lot of people out there who think we're going to get a rate hike in May now, and certainly think we're going to get one in July. A lot of people are thinking that, but despite that, we've still got 1.49 on the US 10-year paper. Let's move on to the dollar crosses. The dollar yen trading up 0.2%. In fact, last week, the dollar index did very little. Week to date, it was actually flat, down 0.2% on Friday, as we saw again. Fascinating CPI data. There is a place, though, where the dollar is excelling, and it's less to do with the dollar, perhaps, and more to do with the country itself. I mentioned earlier on the extraordinary policy announcements we get out of the less than independent central bank of Turkey as well. Well, it's now trading with a 14 handle, and I was looking at this, funnily enough, I was looking at this before the show, just 13.8 it was trading, which was pretty much near the high. Well, it's just burst through there. Year to date, have a look at that number there. The Turkish dollar versus the lira, Turkish dollar, the US dollar versus the Turkish lira has put on 91% so far year to date. An extraordinary record-breaking rally for the dollar. The CEO of the UAE's Mubadala investment company, Khaldun Al Mubarak, is not too worried, though, about inflation in the long run. Speaking to CNBC's Hadley Gamble, Al Mubarak said current price pressures are not affecting his investment strategy.
Listen, when you're a long-term investor like us, I think these challenges, interest rates, inflation, cycles, energy cycles, semiconductor cycles, they come with the territory. You know, we're designed to
you think it's transitory, the inflation?
It's transitory. It's absolutely transitory. I take a long-term view on the United States, and I continue to have a positive, bullish view on the U.S. market.
May have mentioned it. It's a big week for central banks across the globe as they hold monetary policy meetings and review pandemic support measures, all as the Omicron variant hangs over their heads. At its two-day meeting starting Tuesday, the Fed will discuss its taper plans. Later in the week, the ECB will review its asset purchase plans, and the Bank of England, the Bank of Japan, Norges Bank, and the Swiss and, interestingly, the Turkish central banks will all be debating rates and monetary policy in the days ahead. Well, let's get to Julian Howard, Investment Director of Multi-Asset Solutions at GAM. Now, Julian, they're not all going to be quite as crazy as the Turkish central bank and be cutting rates, but are they behind the curve on this inflation story? Nice to see you today, by the way.
Morning, Steve. I don't think inflation, actually, you're probably going to laugh, but I don't think inflation is going to be a major problem. I think there's a lot of sort of preemptive and premature noise about raising rates, particularly from the Fed, I guess, because they've talked about speeding up tapering. Then the next move after that is raising rates. But I still see inflation transitory, even as the Fed has dropped the wording from its statements. I think inflation is coming from two places. One is sort of supply disruption in Asia. I don't see any evidence that that's going to change. But the other place is the labor market, and that will change. America lost 22 million jobs initially when the pandemic broke out, but those jobs are coming back. And we're seeing that steadily over time. And I think wage pressures will ease off in the coming months. And I think that will mean perhaps not a sort of a fall in inflation back to the old numbers of sort of 1.5%. But I think certainly we're going to get lower numbers than 6.8% in the coming months. So the risk of policy error is relatively elevated. And I think that speaks to why we're getting the flattening of the yield curve, which you commented on just a little bit earlier. But actually what's happening is that the short end is going up because people are expecting a response from the Fed. But actually the long end is falling because people are worried about what the growth impact of that is going to be if we start raising rates into an economy that is still disrupted by COVID-19 and the Omicron variant. That could be a major policy error, that the world is still not ready for a higher rate environment.
But Julian, I hear what you're saying about these six-handle inflation rates. And again, we all hope, those of us who saw the 70s, albeit as a very, very young person, that we don't have a return to that in any way, shape or form. But the fact of the matter is there is a huge wealth of difference between 2%, which is the target for these central banks, and the current levels, which are coming up with 5, 6, 7 handles in some areas as well. They are still massively behind the curve, even if a vast amount of what you say is correct, and actually these energy and shortages and the food prices, even if that abates, we're still nowhere near the 2% level, which is the benchmark, i.e. we're still way above that, even if it comes off by dramatic levels.
But ask yourself this, how is raising rates going to fix, for example, healthcare policy, public healthcare policy in China? It's not going to stop China from pursuing COVID zero with all the supply disruption that goes with it. So raising rates is not going to touch that. Raising rates is not going to bring people back into the labor market any faster. They're going to come back as they see the economy start to improve and they get more confident about the virus and worrying less about it. That's what's going to bring them back. Raising rates, I don't think is going to help on either of those two fronts. It's the only tool that the central banks have got. But it's just simply not effective for dealing with these particular price pressures.
Julian.
So that's what worries me, is that they're going to use the only tool they have because they're under some kind of pressure about it.
I hear you, Julian. That's compelling. But it's, as you say, it's the only tool they've got. So are we looking at the wrong public body for policy reaction to what should it be actually more fiscal stimulus rather than worrying what the central banks are doing? Because the central banks have got a very strict mandate, haven't they? And they're doing their best to negotiate it. But actually, when we've got fiscal stimulus coming in left, right and centre as well, is that compounding the problem though?
Well, I think fiscal stimulus helps, but we're running out. We can't keep the taps open. I mean, one of the other issues with the Omicron is that there's already talk of extending furlough here in the UK for certain sectors. The US seems less keen on doing that, but we are surely close to the limits of what we can do with fiscal policy. Yes, interest rates are very low, 1.4%. On the 10-year yield, but the sheer absolute number on the debt is just becoming staggering. I think we're running out there. But I think what may work is more, supply side reform and perhaps changing attitudes towards the virus. I know this is controversial, especially amid a new variant. But certainly, if you look at China and their public health policy, they are so committed to COVID zero. There was an official talked about how he was astonished at the very idea, that was the word he used, astonished at the very idea of easing restrictions. But that is actually going to have to be the key to how we start normalizing things. I read another piece this morning about how in the UK, the sort of testing and tracing and travel arrangements, that they're putting in measures that could last another 5 years. I mean, that's absolutely extraordinary. Can you imagine this disruption for 5 more years? So I think there needs to be some kind of more profound accommodation with the virus. And I think that the key to kind of rebalancing supply and demand lies there.
Yeah, I saw a similar article talking about 2025 as well, Julian as well. But I mean, look, some of our more cynical viewers might turn around, and I know this isn't your angles, Julian, but they might turn around and say, oh, there's a chap who's investing in markets which are trading at exacerbated levels and obviously wants to keep finance cheap. So the markets of which he is long as an investment director of multi-asset solutions at GAM, will keep them propelled higher and higher. I mean, let's face it, if there is a bubble anywhere and there is inflation, it's probably in equity markets that are trading at a huge premium to their historic levels.
Low rates are helpful for the way we're investing, or rather we have invested, because we can see low rates. But I would like to think that if that regime changes, then we can certainly adapt to it. But I think our view on long-term low rates forever is founded on our analysis of how we see the world. Even when we get past Omicron, we're still facing climate change, inequality. There was a damning report from Piketty Lab last week. I don't know if you saw that, on how billionaires are controlling an even bigger swathe of global wealth now, helped by lockdown measures. So inequality is a challenge, demographics are a challenge. So even when we get past this particular headwind, and maybe it'll last till 2025, but even past that, we've got a very low growth environment for decades henceforth. So it's very hard to see how we can have a tighter monetary policy amidst such low growth. And really that points to that inevitable kind of technology, growthy, consumer discretionary type sector, which tends to do well because its net present values are boosted by a low discount rate.
No, I hear you, Julian. Look, I don't know if they've booked you in again, you poor thing, before the end of the year, but if they haven't, I better ask you what you think the markets are going to do in 2022. Outliers to the upside and downside?
Well, I think the biggest risk is some kind of policy error. As I've said, a big rise in interest rates will cause a reassessment, and I think a rotation from technology to growth. But I simply don't see it. So I see more of the same. I'm afraid I see technology continue to do well. I think rates will continue to be low because we will continue to not accommodate psychologically to this virus, and it will continue to haunt policymakers, and the resulting response will be growth negative. So I would continue to bet on those industries that can fare well, whatever is happening with the virus and whatever is happening with the economy.
We've got to leave it there, Julian. Nice to shoot the breeze with you, as ever. Thank you very much indeed for your time.
Thanks,
Julian
Steve.
Howard. Yeah, nice to see you. And if I don't speak to you again, have a great holiday period, Julian. Julian Howard, Investment Director of Multi-Asset Solutions over at GAM. I'm taking a quick look at the pound, actually, because we saw those comments from the UK Prime Minister. We've also had comments out from the Health Secretary, Sajid Javid, today as well. The pound losing 0.3% versus the greenback on the cable pair. The UK Health Secretary today saying now Omicron is around 40% of infections in London, cannot confirm any deaths from Omicron. 10 people in hospital in England with Omicron, 3 doses of vaccine, the 2 initial doses plus a booster provide protection. And just adding, Omicron variant is spreading at, and in his words, a phenomenal rate. And as you can see, the pound under a significant amount of pressure. Coming up on the show, US-Russia relations turn increasingly icy as the G7 issues a stark warning.
Tune in for Tech Check.
Welcome back. President Biden is set to hold more talks with his Russian counterpart as tensions rise over a buildup of Russian troops on the Ukrainian border. Mr. Biden has warned President Putin that Russia will pay a, quote, terrible price if it invades Ukraine. In response, Mr. Putin has demanded guarantees that NATO will not expand further to the east. The crisis-dominated conversation at the G7 meeting in Liverpool this weekend, where UK Foreign Secretary Liz Truss accused Russia and China of seeking to, quote, undermine liberty. Truss hailed the meeting as a successful show of solidarity from the West.
What we've seen this weekend is a united front from the G7 that there would be massive consequences if there were to be a Russian incursion into Ukraine, which would carry severe costs. And we are very aligned with all of our partners on that. The most important thing is that we defend and advance freedom and democracy, and that is the main topic of the discussion at the G7 this weekend. We cannot have short-term economic gain at the expense of our long-term freedom and democracy.
Speaking to NBC's Meet the Press, the US Secretary of State Antony Blinken pointed out the importance of the Nord Stream 2 pipeline to further dialogue with Russia.
Well, that pipeline, Chuck, as you know, doesn't have any gas flowing through it right now. And in fact, it's a source of leverage on Russia because to the extent President Putin wants to see gas flowing through that pipeline, if and when it becomes operational, it's very unlikely or hard to see that happening if Russia has renewed its aggression on Ukraine, if it takes renewed action. So I think President Putin has to factor that in too, as he's thinking about what he's going to do next.
Well, the new German Chancellor Olaf Scholz made his inaugural visit to Warsaw on Sunday to meet with the Polish Prime Minister and develop ties between the nations, despite differences over Nord Stream 2 and the EU. Well, Annetta has more. And Annetta, I think that's really fascinating that Warsaw was the first visit. Is it to do with historical significance and trying to have a rapprochement, or am I just reading too much into it?
Well, actually, it was the second visit. First, he went to France and then to Poland. But yes, Poland is a traditionally very important neighbor in the East. And I think the Polish-German relations, of course, also because of what happened in the Second World War, are crucial for a German chancellor. And that's why he went to Poland as like the first Eastern European country. But more interesting is what he actually was saying there on the ground as well regarding the tensions at the Ukraine-Russian border, because clearly that is a litmus test to the new government. And it also is very interesting to see that they haven't found a common approach yet. The Greens are much tougher. They want to have a much tougher foreign policy, but it seems that the SPD, and with Olaf Scholz as the chancellor, is clearly saying that the foreign policy, when it comes to these kind of extreme situations, will be governed and will be steered from the chancellery and not from the foreign office. And that is already a first test for that very fresh new coalition. But having said that, so let's listen in of what he is saying about the current situation at the border and what his approach is.
Die Truppenbewegung entlang der Ukraine.
We're watching the troop movements along the Ukrainian border with great concern, and we are making it very, very clear that the borders in Europe cannot be violated, and that we consider the integrity of the borders of countries to be inviolable, and that no one should think that they could simply be violated without serious consequences.
So for now, he is rejecting the demands from the US to bring in Nord Stream 2 as a threat to Russia. He doesn't want to do that, Olaf Scholz. And that is also something which differs from Annalena Baerbock's approach, who was very openly saying it should never be open, that pipeline. So Olaf Scholz is more hesitant when it comes to using that as a threat, and he's not doing so, as I was saying. So his approach to Russia might actually be a bit like the one Willy Brandt some 50 years ago, a very influential figure in the Social Democrats, did as well. He had a two-pronged approach, like dialogue, but of course also sanctions. So he want to reinforce the dialogue, I guess, first of all with Vladimir Putin before getting like in that threatening pose. And he, as I was saying, that's the approach as of now from Olaf Scholz. There's no threat to stop Nord Stream 2 altogether as of now.
Yeah, it's fascinating. Both foreign policy and energy policy intertwined there. Thank you, Annette. Always nice to get your update. Thank you very much for that. Okay, European equity markets called to open higher at the start of trading. The London market looking flat despite all those concerns coming out from both the Health Secretary and indeed the Prime Minister. Plenty more. Morning, welcome to Squawkbox. These are your headlines. The UK Prime Minister Boris Johnson issuing a stark warning over the Omicron variant and offering booster jabs to all adults in England from this week.
No one should be in any doubt. There is a tidal wave of Omicron coming. And I'm afraid it is now clear that 2 doses of vaccine are simply not enough to give the level of protection we all need.
European stocks set to kick off the week mildly in the green as monetary policy decisions take centre stage around the world, whilst US inflation spikes to its highest level since 1982. The Turkish lira hitting a new all-time low, falling below 14 to the greenback, whilst watchers expect the central bank to, yes, wait for it, cut rates even further at this week's meeting. And elsewhere, executive change. Credit Suisse overhauling its board with a swathe of new appointments and planning to organise the group into 4 key divisions, with Francesco De Ferrari set to lead the wealth management business. I mean, there's a lot of big stories around, and we'll come to the markets in a few moments' time. But how about this one? For a flash that just hit the wires. Turkish central bank does not open Forex depot auction. We're just not going to bother today. Well, I do like the price, so we're not going to bother. I mean, quite extraordinary what is going on in Turkey. I mean, whilst I take on board Julian Howard of GAM's view that actually inflation at the moment that we're seeing would not be solved by central bank action, and there's a huge debate about that one, certainly not central banks raising rates. What the Turkish central bank doing really just flies in the face of what you and I learned about economics when we were all at school, and cutting rates with the current huge inflation levels in the state, in Turkey. Wow, it's creating certainly issues for a currency which has fallen about 93% this year. 93%. Asian markets, mixed data out of Japan. The service sector moderately strong at two-year highs, actually, whereas the manufacturing sector held back by those raw material increases. We still have got a 200-point rally on the Nikkei 225, though. Flat market in Hang Seng. Elsewhere, the ASX 200 and the Shanghai Composite both up circa 0.4%. So those warnings that I mentioned in the headlines about the phenomenal exponential growth, their words, not mine, from UK government, growth of Omicron as well. It is affecting sterling. We're down year to date, down 4.5%, but it's on cable that we can see the biggest reaction today, with the pound giving up 0.3% to 1.3226 versus the greenback. Very different strategy from the zero tolerance strategy we see in certain southern hemisphere parts of the world, with the British looking for high vaccination rates to combat their concerns over Omicron as well. But again, trying to get up to 1 million doses a day, I think I saw a headline saying, into the arms of people to get that third level of protection, the booster, in addition to the two original vaccinations. Should we have a look at the Turkish lira? 14.17. It gets worse and worse as well. So 14.17, down 2% on the session versus the US greenback. Gas wholesale prices they put in for me. So let's have a look at these. Currently 10% higher. So a big surge in gas prices today. There's a year-to-date price for you, up 509%. But not inflationary, ladies and gentlemen, apparently. Who am I to say now? I mean, we've had this debate for so long, haven't we? Is it just about energy or is it elsewhere? Feels like it's elsewhere. To me, has done for a long time. But, I mean, a lot of the experts keep coming on and telling us this is A, transitory, and B, is isolated to food and energy costs, and C, has peaked. Now, it may well have peaked, actually. I think a lot of people are hoping that a lot of the issues that have created that 6.8% level on the broader CPI in the States may start being alleviated somewhat going forward. US futures, we'll have a look at the European futures first. We'll do that. And then we'll move on to the US futures. We're called higher across the board, actually rather calm. Did you see what VIX did last week? I think it was down about 39%. So all that volatility we've had, people are just saying it's behind us. It's not going to be going forward. So a sub 20 level on the US VIX now. I thought that was very interesting, given the huge moves we're seeing on a daily basis. US futures, I did promise these. So let's have a quick look at those. We are currently trading 11 points higher on the S&P, which hit a record level, 66th record level of the year on Friday. The Dow up 95 points, and the Nasdaq, little bit of a laggard, the Nasdaq, but still seen up 33 points. Credit Suisse has announced an overhaul of its executive board. The lender has appointed Francesco De Ferrari, the CEO of its wealth management division, and the interim CEO of Europe, Middle East and Africa. Meanwhile, the head of the lender's investment bank division, Christian Meissner, will now lead the Americas region. This as the bank continues its restructuring program amid heavy losses and other scandals in the past year. Just last week, it also emerged that the Swiss financial regulator FINMA is investigating a possible breach of coronavirus quarantine rules by the bank's chairman, Antonio Horta Osorio. Santander has been ordered to pay Andrea Orcel 68 million euros after withdrawing his CEO job offer in 2018. A Madrid court ruled the offer letter was legally binding and directed the Spanish bank to pay a sign-on bonus, buyout clause, and 2 years of salary, as well as moral damages. I'd love to know how you value moral damages. Orcel, who has been running the Italian lender Unicredit since April, said he hoped This decision would close the matter. So, quote, we can all turn the page. Expectations of higher borrowing costs are buoying global banking stocks, on track to record their best year since the wake of the financial crisis. Delighted to welcome back to the show Kian Abu-Hussein, who is the head of European Banks Equity Research at JP Morgan. Hello, sir. Nice to see you today. Well, look, I'll tell you what we'll do, just very briefly. I don't know if you want to comment on these other stories going around about Mr. Orsell or about Credit Suisse. They'll get that over and done with. But Kian, I know they're isolated stories and not about the big thematic, but have you got anything to add about either of those stories?
I think wealth management and Credit Suisse is a core business. It's still undergoing restructuring. I think the announcement today are in line with expectation, what was already rumored in the market in respect to Credit Suisse. So I don't think there's a change. The key issue remains in Credit Suisse, the investment bank. And we are rating Credit Suisse as an underweight as a result, because we think they have not done enough on restructuring an investment bank that makes below 10% return on equity and is very credit heavy. And when credit dislocates, it hasn't done for a long time, but then it dislocates, they make losses. And we don't want to be in a pure IB, which is reliant on credit. So great news on wealth management, but really the issue remains credit on CS.
Yeah, that's really interesting, Kian, and perhaps we can use this as a stepping stone to the broader story, because I was looking at Credit Suisse and the price to book going forward on this company is still sub 0.5. I mean, it's a huge discount to the broader sector, but it does have some peers in common with it at those levels as well. So even at a price to book of sub 0.5, this bank and other European banks, they look more like value traps, do they?
I think Credit Suisse needs to go through restructuring because the risk is, and I think that's why investors don't re-rate it, they're concerned that this is not the end of the restructuring. I have one more downturn to come in credit at one point, and that means I'm going to lose some value in the stock again, and then I need to have restructuring charges to resolve that issue. So as a result, it will be valued below book value. Also, it's the second largest private bank in the world, which is amazing at this valuation. However, not all value stocks are value traps. For example, we like Societe Generale at 0.5 times tangible book value. They're delivering on cost cutting, they're delivering on capital, they have restructured their CIB, or Barclays at 0.6 times tangible book value, we like as well, because actually the IB restructuring has worked and they're delivering. And lastly, Deutsche. We actually just recently upgraded Deutsche Bank to an overweight. It's been a long time, but really the IB is delivering and the management is delivering on the cost-cutting side, and the market is too negative on cost-cutting. So we cannot put all the value stocks into the same bucket. Some of them have the wrong strategy, and when they have the wrong strategy, the market will penalize you and does not want to touch you.
Yeah, and in terms of one of the other central pins of your positive outlook for the broader sector as well, bond yields higher, potentially you're thinking about a central bank response. But I've just had Julian Howard from GAM saying actually raising rates will not be the suitable response to what we're seeing in terms of inflationary pressures, which you say will not abate. In fact, it'll make things worse if we raise rates. Are we correct in the premise that actually rates in Europe over the medium term are going to be rising anytime soon?
Our house view remains and is that they will be starting to rise in the third quarter of 2023. And then we have further 2 rate hikes in 2024. To me, that seems very plausible. It's also what the Euribor curve is reflecting. And we are ahead of consensus, I would say, against economists. And I would say that these numbers are realistic to me. Clearly that is very good for banks. I mean, we're very heavily geared to short rates. To give you an idea, every 25 basis point hike in European banks generates around 7% earnings accretion. So very heavily geared to short rates. And we are in stock price terms very heavily correlated to long-term rates. We're actually the highest correlated sector to long-term rates. So European banks are well positioned, And we do believe in rate hikes to come, not until 2023 year end, but they will be coming. And all of that, the market will discount very quickly.
But will rate hikes and the anticipation of those rate hikes, what will it do to credit and the credit side of the business and the quality of the credit side of the business? Well, I've got a guest on in around about 50 minutes time, Kian, who's looking at the potential credit default rate being behind the curve of what the actual reality is if money gets tighter.
We don't see that as an issue because two things. First of all, credit is heavily geared towards unemployment, which is supposed to stay low, and GDP growth. So both of those factors are actually still looking very positive, especially with a very tight labor market. Secondly, interest rates are going really on the short end and even on the long end, mainly from negative to zero, towards zero. So all of that should not have a material impact on credit. We're expecting credit provisions to stay around 32, 33 basis points, so flattish, but the normalized levels is around 36. So we're actually forecasting until 2024 to have credit provisions below normalized levels. One more point I want to make, high yield spreads. They're still tightening on our expectations in the US, which is a good indicator for smaller company bankruptcies. And bankruptcies will be staying at low levels at 1 to 1.5%. So if you take the total US European picture on credit, I still think we're in very good shape.
Do you really think, though, when we've got a one handle on our defaults as well, that's an accurate projection of what's really... What I worry about, Kian, is that we're going to go back to the bad old days where we have a lot of zombie companies being kept alive by the largesse, ultimately, of central banks.
You could argue that's the case, but the good thing is from a bank perspective is these days you need to provide non-performing loans much faster. You cannot do these, customized restructured loans and say the loan is still performing. The regulations have come a long way. And remember, we have this thing called IFRS 9, which is a pro-cyclicality of provisions. So as soon as the economic environment shifts, you need to take provisions even if you don't see any specific company issues. So I think things are improving. We're not saying we're not going into a cycle at one point and we will have material loan losses. That will happen at one point. But with the economic predictions, with the environment that we're seeing for banks, when we look at the balance sheet, when we look at UniCredit, which you mentioned early, buying 50% of the market cap by 2024, I think all of those things over the next 2 to 3 years at least are a very good environment for banking.
Well, fair enough. But the good environment for banking has been rewarded in the United States with some pretty solid valuations. It's hard to argue that when you've got 1 to 1.8 times price to book in the US compared to, as we've been mentioning, 0.4 to 0.8 on average, that they aren't not overvalued, but significantly valued compared with European peers. And yet, Kian, you believe that's still going to be the case and US banks will still accelerate compared with their European counterparts?
Yes, I think you're absolutely right. European banks are still very cheap. Actually, the average valuation 0.9 times tangible book, 8 times earnings for an ROE of 10. Cheap, but we're not saying they should be trading at US multiples. US banks, some of them trade at 2 times tangible book and 12 times earnings, so around a 30% premium if you look on average. We think that will continue, and the reason why is we're still overbanked in Europe. We're still having 4,700 banks in Europe. That's more than in China. We have more banks per inhabitants than in China. And we still don't see a big consolidation drive. And we really need to see some cost adjustments really over the long term. So structurally, European banks are not as in good shape as the Americans, and they generate lower ROEs. And then second thing is we don't have a securitization market. In the US, we have a very buoyant mortgage securitization, high yield market. The high yield market in Europe is 1/10 of the US. And I think regulators have missed the opportunity to really create velocity in the balance sheet of European banks, which allows them to trade and sell assets and create new loans, and that didn't happen. So overall, we have some structural issues, and that means European banks will be at a discount to US, but it doesn't mean European banks are not good investments. They are.
Yeah, it was interesting. I was talking to the European Commissioner for Financial Stability, Marie McGuinness, quite recently about progress on CMU, because you talked about the opportunities of US capital raising compared with Europe as well. And she was quite excited that we are making progress. But I mean, it just seems so slow, Kian, as well. We just seem light years behind the US still. I think that's what you're saying as well.
Yes, I'm afraid when it comes to helping the banks on the regulatory front in respect to velocity of assets, some banks in the US, they securitize 80% of their mortgages. And when they do so, they can give new mortgages. And it's a very buoyant market, or the high yield market. When the SMEs in Europe have defaults, you cannot sell any of your loans. There is no liquid market in Europe. And we need that. And I think since the global financial crisis, nothing has really changed. There has been some drive to change that, but ultimately the rules are still very sticky, very difficult to really see a change in the securitization market. And that's a big negative.
That's a big shame as well for Europe as well. Kian, really lovely to see you, sir. Thank you very much indeed for giving us the benefit of your wisdom. Kian Abu Hussein, who is the head of European Equity Bank Research at JP Morgan. Right, we're going to take a very short break. Up after the break on the show, Daimler is the latest to feel the pinch of the global chip crunch. Find out more after the break. Right, let's get back to the developing story in the southeastern states of the US, where a desperate search for survivors is underway after a string of deadly tornadoes killed dozens of people. President Biden declared the situation a federal emergency, unleashing millions of dollars in aid as thousands of people face housing, food, water, and power shortages. NBC's Jay Gray has the latest.
Overnight, power and fiber crews, search and recovery teams continue to pour into Mayfield. The darkness can't mask the wreckage. There's just too much to hide.
But you stand in the midst of this and everything you see, everything, right, left, forward, backwards, is gone.
The initial shock of the storm now beginning to give way to the painful reality of all that's been lost.
It's never going to be the same. A neighborhood isn't going to be the same, and the town isn't going to be the same.
What's left behind, a haunting reminder of the tragedy.
It's immediate, upfront, and it's devastating.
But C.E. Miles knows the twisted metal, splintered wood, and shattered glass doesn't come close to representing the real loss here. His wife is an emergency room physician.
She said she were pronouncing people dead, one after the other, after the other. And the one thing hurts us the most, she said that she pronounced 2 kids dead.
Responders warning, the number of lives lost, currently more than 36 across the strike zone, will climb as they continue their difficult work. Jay Gray, NBC News, Mayfield, Kentucky.
So, in the Middle East, the UAE's Ali Mubarak has said he's bullish on prospects for the chip industry despite current supply shortages. He doubled down on the fund's position in global semiconductor manufacturer Global Foundries.
We've lived through that journey. When we entered that business back in 2007, it was AMD. It was investing in a company which we thought was going to be a company that will be very successful, that had a differentiated technology, but that was, at that point, doing 2 different things, doing the design side of it and the manufacturing side of it. I think the view we took back then was, of course, with AMD, that the manufacturing side needs to be spun off because achieving scale and being able to compete on a global platform required it to essentially service many customers. So turning from a aspect of a business within AMD that was serving one customer in AMD to then being an independent manufacturer, an independent foundry, that led to the establishment of Global Foundries and eventually what we'll talk about a bit more, which is the journey of Global Foundries. I think that was the first very important decision point back in 2007. AMD back then was small, I think had very interesting prospect. We had a very, I would say, strong view about the semiconductor business, technology, where it was going. And I think we made a big bet on AMD. And over the years, AMD, you know the story, has been an incredible success. Its CEO, Lisa, has been one of the most incredible CEOs, I think, in the sector. Well, to be honest, in business overall, really phenomenal CEO. And with that, we've seen AMD become now the player we were always hoping for back in 2007.
In terms of that growth and the need, supply meeting demand, what's your outlook? Because you have a bird's eye view on this at this point.
So it took 50 years for the semiconductor business to turn into a $500 billion business. It's going to take probably 8 to 10 years to double. And it's going to double right after that, probably in 4 to 5 years.
Yeah.
So you take that as one very important data point. You combine that with another very relevant data point. There's only 5 players. There's 5 foundry businesses, global foundry businesses, 4 of which are in Asia.
Yeah.
One of which, Global Foundries, has, I think, the unique differentiated platform of being in the United States, in Europe, and in Asia.
Right, let's take a look at the foreign exchange markets. Quite a bit going on, actually, and cable was showing the pound under a significant amount of pressure earlier on, down 0.3%, trading at 132. Of course, not so long ago, we were trading near the middle of 145 on the pair. But concerns about Omicron, concerns about the Prime Minister and Sajid Javid saying, and I'll quote, phenomenal exponential growth of Omicron and a big drive to get as many vaccinated with their third jab as quickly as possible. We'll also move on to the Turkish lira, which is trading down 3% now, really accelerating those losses. People are anticipating the central bank decision later in the week, but not a huge amount of hope for a reversal of the cutting of rates in response to high inflation pressures, but under a lot of pressure there versus the US dollar. Right, we're going to take a very short break. First trading session of the week. We are called to open higher on the European bourses, albeit by a small margin. As you can see there, 0.161% higher for the DAX futures. I'll return after a very short break.
We put
going on here, ladies and gentlemen? Have we got the central bank action versus concerns about Omicron? Is it that simple? Well, nothing's ever that simple, but these are the two big factors, aren't they, for the markets this week and perhaps every week at the moment, i.e. if COVID-19 is still going to wreak havoc on the global economy, then the markets will ultimately react. But when people think that COVID-19 isn't such a dominant factor and that central banks can carry on with their tightening from extraordinarily low historic levels of interest rates and high levels of asset purchases, then the market has to react accordingly. But at the moment, it seems that the markets are looking well, very much on the bright side, aren't they, of the fact that the central banks may have to abate some of the action which they want to do to take away some of the Kool-Aid for the markets. Or they're thinking, do you know what, Omicron's serious, but it's not actually a market event. And I find that very, very interesting, given the fact that only 2 weeks ago, Omicron was very much seen as a market event and was leading to some very large oscillations and some great declines in these markets. I mean, the VIX, for instance, last week, it's almost as if it never happened, the Omicron, because the VIX fell 39% last week. Isn't that extraordinary that everyone keeps telling me, oh, it's a forward-looking indicator. It's one that measures the volatility of the markets. Well, if you're coming off 39% to a sub-19 handle on your VIX, it doesn't say to me that the market expects much more volatility to come, which perhaps is an arrogant stance. Perhaps it's the right thing to do if you look at the seasonals. Perhaps after this week, when we've had all these central bank announcements, then the markets will calm down and you're going to get a whole bulk of period where not a lot's going to happen. That's a big assumption, given everything that's happening. We're 0.2% higher, so the spread better's got it spot on, as indeed did the US European futures. Let's take a look at the individual sectors. I mean, last week, my goodness me, technology came roaring back. Tech in the States, for instance, was up 6% last week, the best performing sector. Nothing really meaningfully down in negative territory. We've got the usual kind of rotation going on this morning with utilities, telcos and healthcare down around 0.2%. The sectors that are leading us higher, I mean, oil and gas had an amazing week last week. Did you see Brent and WTI? Oh, of course you did. It was up around about 8%, one of its best weeks of the year. Oil and gas now up 0.6%. Technology also moving higher. Logitech, one of the biggest gainers in that subsector. Basic resources and autos. Autos continue to rally 0.8% higher. And the banking sector, which we spent quite a decent amount of time talking about already today with our guest from JP Morgan, 0.3% higher. Individual bourses. Okay, let's find one or two movers for you here. And again, it's modest stuff at the start of trading. The FTSE 100 was a bit of a laggard last week. Last week, we saw the FTSE up 2.4%, so still solid gains. But the DAX and the CAC 40 had a 3 handle on their gains last week. And, well, we're out of the traps in solid but unspectacular fashion for a lot of these markets today. So we were talking about the UK. Well, let's have a look at some of the UK stocks. This is actually the FTSE 100 behind me here, broken down individual names, because the UK has moved the COVID-19 alert level from 3 to 4. 4 is the second highest, apparently, after medical chiefs warned that the Omicron variant is spreading much faster than Delta, whilst vaccines offered only a reduced level of protection against it. Social distancing measures have been resumed, and health services are bracing for a potential jump in hospitalizations. Well, speaking to our sister channel, Sky News, this morning, UK Health Secretary Sajid Javid emphasised the virulence of the Omicron variant.
That it's spreading at a phenomenal rate, something that we've never seen before. It's doubling every 2 to 3 days in infections, and that means we're facing a tidal wave of infection. We're once again in a race between the vaccine and the virus. The second thing that we now know for sure is that the vaccines, 2 doses are not enough, but 3 doses still provide excellent protection against symptomatic infection. And that's why the booster program has become more important than ever.
And the pound is reacting accordingly, albeit having declined. It is staying where it was, down at 1.32 on the cable pairing. Over the last 3 months, it has lost 4.3%. You've got to remember, we're kind of at the levels we were throughout much of the last 5 years when we weren't sure what was going on with Brexit. If you remember, Karen and I talking about this a lot, actually, about the 130 peg for the pound, i.e. when it was worried, the market was worried about Brexit, it was trading just below 130. When people thought things were going to be okay, we were trading just above it. So we're back down to the mean level, give or take, of the last 5 years, which I think is rather interesting, given the fact that once Brexit was supposed to be sorted out, we were supposed to be going to the heady uplands of 145, 150. Well, that didn't last very long, did it? Maybe it's a good thing for British exporters, who knows? But it's certainly one of those additional factors regarding inflation, isn't it? Let's move on away from the UK story to Credit Suisse. Shares really not getting much of a boost today. In fact, we had a very interesting comment from an analyst a few moments ago. I'll talk to you about that in a moment. But Credit Suisse has announced an overhaul of its executive board. The lender has appointed Francesco De Ferrari, the CEO of its wealth management division and interim CEO of Europe, Middle East and Africa. Meanwhile, the head of the lender's investment bank, Christian Meissner, will now lead the Americas region. Now, the comment from an analyst just now, and this was Kian Abu Hussein from JP Morgan, was saying, well, look, it's a bit of a value trap. It may be trading below 0.5 price to book, which is a significant discount to some of its peers. But we just don't think in some key areas that this bank is the one which is making the key progress, unlike some of its other peers, such as Deutsche Bank and Societe Generale, which he was pretty optimistic about the prospects of. And the market really not celebrating those moves in terms of the change of its governance or the board structure. Shares still down 8.3% over the last 3 months. Let's stay in the banking sector. Santander, I mean, this is an extraordinary story, really. I mean, how much would you like to get paid for not working? Yeah, 68 million euros okay? I think it's okay, isn't it? Well, Santander has been ordered to pay Andrea Arcel 68 million euros after withdrawing his job offer in 2018. A Madrid court ruled the offer letter was legally binding and directed the Spanish bank to pay a sign-on bonus, buyout clauses, 2 years of salaries, plus this one. You've got to pay for moral damages. How do you value moral damages? Well, apparently it's 68 million euros, obviously. Arcel, who's been running, because he got another job, it's not as if he's been out of work, he's been running the Italian lender Unicredit since April. Well, he said he hoped the decision would close the matter, so, quote, we can all turn the page. I bet he does. I bet he hopes that's the last word. I don't know if Santander are appealing. We should find out, really, shouldn't we? Air France, meanwhile, says it's redeemed 500 million euros worth of debts from an earlier state loan, which aimed to help the airline recover from the pandemic. The carrier says it will extend the maturity on the overall 4 billion euro loan to 2025. Air France also said it was working on strengthening its capital position pending market conditions. Let's move to the auto sector. Daimler is shutting production at its Hungary-based Mercedes-Benz plant for a month. The car manufacturer says it's compelled to extend its routine annual maintenance due to the global chip crunch. Just on Daimler, did you watch the game, the race yesterday? Did you watch Verstappen versus the Mercedes of Lewis Hamilton? I know that it splits a lot of you out there, but was that a fair result in the end? I don't know, maybe we shall ask Stephen Bell, chief economist at BMO. I don't know if he's got a bit. Hey, you're a sportsman, Stephen. Do you like a bit of sport?
I do. And Formula One became very boring until the last two races.
Yeah, but did you think Lewis was hard done by yesterday? Maybe I'm being a bit too Anglo-Saxon thinking he was.
Well, yeah. I mean, it's made it more exciting, though, has to be said. Yeah, it's a worry when races are decided in courts, though. That's probably where it's going.
It's a tad more exciting than our world, let's be honest about it. It's a little bit more visual as well. But look, I mean, I typified what we're seeing in the markets at the moment a little bit too simplistically. Of course I did. And I was saying, well, on one hand, we've got our central bank concerns. And on the other hand, we've got our Omicron concerns. And actually, they seem to be rotating, which being the most important at the moment. But in terms of your world and where you think the biggest drivers are, why don't you tell us what you think is driving these markets?
Well, the Federal Reserve dominate everything. We've got 20 central banks meeting this week, but I reckon that none of them add up to as much as the importance as the Federal Reserve. And they've been behind the curve. It's extraordinary that the chairman of the Board of Governors waited until he got reappointed before they flipped to accelerating tapering. But that's what they're going to announce. There's loads of other information coming out. But of course, they also, like everybody else, suffering from this wave of Omicron. The good news is that going into this new variant, the economic data were improving. There's a lot of signs that the supply shortages for everything from semiconductors to truck drivers was beginning to ease. So the economic background gives it a bit of strength to withstand what is inevitably a setback from this new variant.
What do you think the market should be doing? And I know you don't talk about individual stocks because you're an economist as well, but what do you think the markets should be doing when looking at this scenario you just painted with broadly supportive data, concerns about Omicron, but you've got a central bank which finally is thinking about, come on, we need to start just taking away some of the huge largesse we've added to markets over the last year or so. Do you think actually that markets should take a step back or actually carry on at their very elevated levels?
Well, I am worried about a wobble in the markets. The market is buffeted left, right and centre. But I think the basic point is economic growth is still strong. Omicron is hitting the service sector, the manufacturing sector is strengthening, and actually for the stock market, it's the reverse of the economy overall. Stock market is more dependent on manufacturing. So I actually think the earnings will come through in 2022 as pent-up supply meets pent-up demand and some of these things ease. And we are basically learning to live with COVID. These are tough restrictions in some European countries, but nothing like as swinging as they were in the early waves. So particularly if the vaccine tweaks work, if the third booster works, if the antiviral pills work, we have lots more ammunition against this virus. Let's hope it does turn out to be less deadly than the previous variants, and then we really can look through this dreadful uncertainty associated with this very much more transmissible variant.
And what about the Phillips curve, Stephen? It's been pretty dormant for a long while, and people are saying, oh, well, it's just about energy still. It's just about food price inflation. But are we really going to start seeing anything meaningfully happen on wages, which could actually be a threat to that corporate profitability we were just alluding to?
So we've already seen a substantial acceleration in wage inflation in the United States, which has lots of good ways to measure wages that adjust for the huge distortions caused when you fire 20 million people and rehire 15. That can change the averages. Also in the UK, we have some pretty clear evidence of rising wage inflation. Europe, it's a bit different. And the ECB can be more comfortable at sitting on their hands. I mean, the big change for central banks is they're going to be buying fewer bonds. I think that's bad news for bond markets. But as long as economic growth continues, as long as corporate earnings continue to rise, and I think they will, the market can withstand the headwinds from the somewhat tighter monetary policy outlook that we're seeing.
How bad for bond markets? You just said that it's going to be bad for those markets. I mean, we're still talking on the screen at the moment. You've barely got any yield on 10-year OATs. The Bund is negative 0.34. Even the Italian 10-year, which, let's face it, there's a plenty of debt in that system, trading just under 1% as well. Are we really going to see a significant sell-off and hence a picking up of the yields on European treasuries?
Well, I have to be a bit humble here. I've been watching bond markets for decades, and I never, ever expected to see these level of bond yields. And if you told me the inflation rates, I'd have got the bond yields completely wrong. And it's central banks that have been pushing down on these bond yields by buying them up in large quantities and keeping the front end very, very weak. Of course, negative rates, negative official rates in the Eurozone. So I think bond yields will go up, but I don't think it's going to be absolutely dramatic. And for some economies, it matters more than others. So the US directly feeds into the mortgage market. In the UK, where there's no tapering, we're just going to stop. And we're going to stop reinvesting, and then we're going to sell them quite quickly. But actually, long-term interest rates do not have anything like the same impact on the UK as they do because of the nature of the mortgage market in the United States. So I think it's more beneficial for financial stocks than damaging for the economy in the UK. And in the US, it's a mixed blessing. Good for financials, bad for the housing sector, if, as I expect, bond yields rise.
I appreciate your comments about being humble about this and getting it wrong, but you only got it wrong because central banks decided it was okay to manipulate for a long period of time the entire curve and indeed manipulate the corporate bond market as well. That's why you got it wrong, Stephen, not because of something naturally happening in the markets as well. My point being, and my concern being, is because of the enormous amount of debt being built up by sovereigns at these stunningly low levels, they're going to carry on with some form of manipulation ad infinitum.
Well, that is the issue, of course. The Bank of England was once accused of being a one-club golfer because all they had was their official base rate. Now they've got a whole bag of clubs, quantitative easing, forward guidance, different forms of bond buying, and they'll tweak these different techniques because if the official interest rate is very close to zero, they need a bit more diversity. But basically, I think central banks would like to get back to a situation where they're not the biggest buyer in the bond market, where interest rates aren't on the floor or negative. And maybe we get a bit closer to that during the course of 2022. And as I say, I'm humble because I knew they were distorting the market by buying up so much. I didn't expect them to have such power, such amazing power.
And finally, you mentioned about your concern about the fixed income markets. Perhaps equity markets are going to have a bit of a wobble. Any thoughts about the timing of this as well? I mean, is it going to happen in the early part of 2022 when people actually say, oh, do you know what, Omicron was bad, but it wasn't actually as bad as we thought, and hence we do need to accelerate our end of the bond buying. We need to accelerate the start of our interest rate hikes?
So the Fed have a pretty straightforward game plan. For some reason, they say they can't raise official rates until they've finished tapering. Don't know why, but that's what they've said. And they're going to tell us probably on Wednesday that pace of tapering will mean they end that in March. So the guessing game is then how quickly after that will they raise rates? The point is, they are well behind the curve. Interest rates should already be higher. Inflation has gone way beyond their expectations. And it's not just temporary factors like auto prices and car rentals. It's broadened out into wage inflation and rental inflation, which is very powerful influence on US inflation, including their targeted measure. So I think they're behind the curve. And once we get this tapering announcement, we'll start getting a discussion of whether they should do 50 basis points, not just 0.25%, but 0.5%. So I think interest rates in the United States need to hit 1% quite quickly. But what the Federal Reserve will actually do, I think, will try and be as calming as possible when they announce on Wednesday all their different targets and dot plots and forecasts, and probably that they're going to accelerate tapering. They certainly seem to be looking through the Omicron variant.
Nice to see you as ever, Stephen. Thank you very much indeed for for being humble, admitting you're wrong. But we don't get much of that on this channel as well. Stephen Bell, Chief Economist at BMO. We're going to take a very short break. Up on the show, though, US-Russia relations turning increasingly icy as the G7 issues a stark warning.
Right now on CNBC.
As we've been mentioning, it's a very big week for central banks across the globe, not just the Fed, but they're holding monetary policy meetings around the globe and reviewing pandemic support measures, all as the Omicron variant hangs over their heads. at its two-day meeting starting Tuesday. The Fed's going to discuss its taper plans. I mean, huge announcement with the dot plot, the summary of economic projections. Then later in the week, you're just seeing Andrew Bailey just disappearing on the left-hand side. We've already lost Madame Lagarde to the left of the wall. What about PEP guidance? What's going on there? They're going to switch from PEP to APP, Asset Purchase Programme. Later in the week, of course, the ECB reviewing those plans. I mentioned the Bank of England. Elsewhere, what have we got? We've got the Bank of Japan, we've got the Norge Bank and the Swiss, plus the Turks. Now, interesting. I mean, of all the others, it's a question of whether you tighten or remain where you are. But with the Turkish central bank, well, that one gets very, very interesting. And as such, we'll have a look at this. This is the Turkish lira versus the US dollar. And you will notice in the top right-hand corner of your screen, this year, the Turkish lira has lost 94%. 94% versus the greenback. In fact, one of our enterprising producers was in Turkey to take advantage of it. I think it was a bit of a coincidence rather than young Katie deciding that she was going to shoot off to Ankara to take advantage. But anyway, 14.3 is where the dollar is currently trading versus the lira. And I'm just looking at the last 12 months, as indeed you are. And you can see pretty much the mean up until September. We were trading around between 8.5 and 8.8. Now we have gone up to 14.3, 14.4 as well. Sovereign dollar bonds drop as lira tumbles ahead of the Thursday central bank meeting. Is the flash. Turkish lira implied volatility gauge has jumped amid the currency's drop. That according to the newswires. So let's take a look at gas prices. There we go. That's inflation abating somewhat, isn't it? What was the line we had from a lot of the analysts on Friday? That we've had peak prices on gas prices, on energy prices. To be fair, this is a Dutch reading rather than in the United States, and as such, significantly higher level. But Dutch wholesale gas prices are up just another 9.2% in the session. Again, those of you who have good eyesight, don't put your glass on. Those of you like me, put your glass on. Take a look at the top right-hand side of your screen there. Here you go. The director's doing it for us. For those of us who haven't quite got the right specs on, up 502% year to date. 502% year to date, which of course in the United Kingdom and elsewhere has put enormous pressure on the utilities. In fact, we've seen so many smaller utilities basically going bust in the United Kingdom. And as such, their customers have been migrated to larger companies such as EDF. One of the largest energy suppliers in the United Kingdom, currently trading down 0.5%. RWE in Germany up 0.2%. E.ON, Enel, Iberdrola, Engie, actually really not moving that much today, considering the huge moves we're seeing in the underlying commodity prices. President Biden is set to hold more talks with his Russian counterpart, that's President Putin, by the way, as tensions rise over a buildup of Russian troops on the Ukrainian border. Mr. Biden has warned Mr. Putin that Russia will pay a, quote, terrible price if it invades Ukraine. In response, Putin has demanded guarantees that NATO will not expand further to the east. The crisis dominated conversation at the G7 meeting in Liverpool this weekend, where the UK Foreign Secretary Liz Truss accused Russia and China of seeking to, quote, undermine liberty. The German Chancellor, meanwhile, Olaf Scholz, has made his inaugural visit to Warsaw on Sunday to meet with the Polish Prime Minister and develop ties between the two nations despite differences over Nord Stream 2 and the EU. Well, Annetta, you've already corrected me, saying this wasn't Herr Scholz's first international visit as Chancellor. That was, as you pointed out to me, quite sternly, I thought, was to France to meet President Macron. But now an equally important meeting to meet the leaders over in Warsaw.
Yeah, exactly. I mean, it's the first visit of an Eastern ally. In that respect, you're completely right. And Poland is historically really important for Germany. As we all know, the Second World War, which saw the invasion of Poland by Germany. And ever since, Poland is sort of the anchor neighbor in Germany. So it's a very traditional thing for a German chancellor when he's new in his job, to go to Poland at first as a European or Eastern European ally. But of course, they have a lot of controversial issues, be it their relationship with the EU, the rule of law issues, and now most prominently, of course, Poland is eagerly watching out what Germany is doing and what especially Olaf Scholz is saying in respect to the escalating situation at the Ukrainian border between Russia and Ukraine. So take a listen of what Olaf Scholz was saying yesterday when he was visiting Poland.
Die Truppenbewegung entlang der Ukraine.
We're watching the troop movements along the Ukrainian border with great concern, and we are making it very, very clear that the borders in Europe cannot be violated, and that we consider the integrity of the borders of countries to be inviolable, and that no one should think that they could simply be violated without serious consequences.
While the United States are openly suggesting that Germany should threaten Russia with the Nord Stream 2 gas pipeline, Olaf Scholz is actually refusing to do so. He is insisting on that. I would say perhaps it's an approach which we've last seen under Willy Brandt, who was a very influential SPD politician and also Chancellor of Germany. He started, or he initiated a dialogue with the East, and also Olaf Scholz wants to first of all start a dialogue before threatening Russia with perhaps the never opening of the pipeline Nord Stream 2. But there's another interesting aspect about the new coalition here in Germany. It seems that they are quite divided on that issue. Annalena Baerbock from the Greens, she just stepped out yesterday saying that Nord Stream 2 should never get a license. So I guess the new German government still is sort of finding or trying to find a common approach when it comes to foreign policy. But one thing is also quite clear, that Olaf Scholz, as Angela Merkel did all the years along, he wants to have the last say over foreign policy, and he wants to have that in the Chancellery and not sitting with the Foreign Office.
Yeah, just a quick question. I find this fascinating. I mean, maybe it's the nature of coalition politics, Annetta, but I would have thought that Nord Stream 2 would have come up when the Greens and the SPD were having their chats about whether they could live with each other in a coalition as well. I would have thought it had been perhaps one of the first pieces of discussion when it came to foreign policy between the two. Have they only now just discovered that Nord Stream 2 is a point of differentiation between the Greens and the SPD?
It's very interesting with Nord Stream 2. I think the international audience puts a lot more focus on the gas pipeline than here inside Germany. It does not really make headlines, that project, and also now in the context of what we are doing with Russia. So I guess they did agree somewhat on putting it to the court to actually grant a license or not. And what Annalena Baerbock is saying is, like it is currently, sort of organized, it can't be getting a license in Germany because it's not according to European energy law. So she's putting it in the court of the legal system. It's not about a political decision, it's about a legal decision. And I guess this is what Olaf Scholz is agreeing to as well. So they will not use it as of now as a political token in the fight with the Russian president. What they probably are going to do is to not granting a permit and letting it sit with the courts as long as possible.
And that is the other fascinating thing you've said to me today, and that is that it's not even a massive issue domestically compared with the exterior international market. Fascinating, Annetta. Thank you. Always learn something when I listen to you. Thank you. Coming up on the show, European companies coming under pressure at levels not seen since the global financial crisis, or are they? And is it all to come in terms of credit default? Well, we'll discuss on Squawk Box after a break.
A news story has
European equity markets seemingly brushing aside inflation fears to open on the front foot as we kick off a key week of central bank policy meetings. But the FTSE 100 just underperforming a tad in early trade, with sterling taking a decline as the UK Prime Minister Boris Johnson issues a stark warning over the Omicron variant.
No one should be in any doubt. There is a tidal wave of Omicron coming. And I'm afraid it is now clear that 2 doses of vaccine are simply not enough to give the level of protection we all need.
Credit Suisse, meantime, overhauling its board with a swathe of new appointments and plans to organise the group into 4 key divisions, with Francesco De Ferrari set to lead the wealth management business. And the Turkish lira hitting a new all-time low versus the greenback, falling below 14 to the dollar, with the central bank expected to cut rates even further at this week's meeting. Right, as we said in the headlines, European equity markets opening on the front foot. There is an enormous amount of central bank action this week around the globe, from the Norges Bank to the ECB to the Bank of England, and of course the Federal Reserve, with all eyes on the summary of economic projections, the so-called dot plot. Let's have a look at individual sectors. Last week was a strong week for most sectors, actually, but we're being led higher in the early part of this week's trading by basic resources, 1.6% higher. Autos, about 1% higher. Travel and leisure, that's interesting, isn't it? Maybe just rallying from its lows on concerns of Omicron. But I don't know many people who aren't questioning their travel plans, even if they are still saying they are going to travel. The cost of travel has gone through the roof for many people, with PCR tests beforehand, once you've arrived and before you get on a plane again. So a lot of people who are looking at the winter season as well, really questioning their travel plans, even if they're still going and they're still allowed to. The cost has gone up, but travel and leisure mounting a bit of a recovery there. Technology was the best performing sector in the United States last week. It was up 6%, 0.8% higher for the European technology names, and really nothing much in negative territory. Healthcare, 0.3% easier. 1 or 2 names to pull out for you in terms of individuals. Telecom Italia moving 14.5% higher. Vifor Pharma on the Zurich market, 14.6% up. Elsewhere, Norsk Hydro, 3.3% in the black. Dr. Martens losing a couple of percent amid what is a key shopping part of the year for the UK brand. And Umicore is the biggest decliner so far today, down 3.8%. Chinese artificial intelligence company SenseTime has shelved its Hong Kong listing after the US Treasury Department placed it on an investment blacklist over alleged human rights abuses in Xinjiang. The group said it strongly rejected what it said were unfounded accusations. Emily filed this report.
China's largest AI company, SenseTime, has postponed its IPO. The company made the announcement in a statement to the Hong Kong Stock Exchange and said that it will publish a supplemental prospectus, which will also update the listing timetable, going on to say that SenseTime remains committed to completing the global offering and listing soon. All subscription monies will be refunded to investors in full without interest to all applicants. SenseTime failed to price its shares last week and had been scheduled to debut in Hong Kong on Friday. The latest developments come after the U.S. Treasury Department last Friday placed SenseTime on an investment blacklist, the Chinese military-industrial complex companies list, over alleged human rights abuses in Xinjiang. This prohibits the purchase or sale of any securities traded by a U.S. investor on any exchange, including in Hong Kong. So it would directly affect U.S. shareholders Silver Lake and Fidelity. SenseTime issued a statement on Saturday saying, "We strongly oppose the designation and accusations that have been made in connection with it. The accusations are unfounded and reflect a fundamental misperception of our company. We regret to have been caught in the middle of geopolitical tensions and will take appropriate actions to protect the interests of our company and our stakeholders." The market will also watch to see if Hong Kong Exchanges and Clearing will set a precedent to host a listing of a blacklisted company in the city. I'm Emily Tan in Hong Kong. Back to you.
Very, very interesting survey next, because corporate distress across European corporates rose to its highest level this year since the global financial crisis in 2008, according to a new report by Weil and Gotschall. This as European governments and central banks begin potentially to unwind pandemic support programs, creating tighter conditions for many corporates across the continent. Let's get to Andrew Wilkinson, senior partner at Weil Gotschall. Very good to see you, Andrew. And I want to go through this quite carefully, because at the moment, I'm seeing very little sign in terms of defaults, in terms of higher yields for distress. So where have you got your evidence from for the increased level of distress amongst corporates? Good morning to you, sir.
Yeah, morning. Look, I think there are a couple of points. First of all, to emphasise what this is and what it is. It's a kind of, it's a look in the rearview mirror. We've got data going back 15 years across nearly 4,000 corporates in Europe, and analysed, a number of inputs. And what you see is that obviously big spike in distress levels in 2008, 2009 during the financial crisis. A big spike early last year as the pandemic kicked in, and then very dramatic falling off in levels of distress. And as you say, default rates are very low, and that's a sort of tremendous credit to governments. What we found, and I think this is an interesting thing for people to look at, is that although in the last quarter distress levels have fallen, considerably below average, and it's very important to emphasise that they are still below average. We've seen evidence that in the last 2 to 3 months they are picking up, particularly in some sectors. So the look in the rearview mirror, and I think this is not surprising as government unwinds various supports for corporates, that we see general distress levels across Europe picking up, with particular emphasis in some sectors, travel, hospitality and retail. And going back to our sort of 15-year analysis, what we have seen is that from peaks in the distress index, which is what Weil has put out last week, sometime later there is a correlation with an increased level of defaults. Default rates are very low at the moment. If distress levels pick up, we'd expect at some future date, if distress levels stay at an elevated level, default rates will rise as well. So I guess the sort of, the read across from the rise in distress levels is that a warning sign that corporate default rates may pick up from their very low levels?
Well, we've got plenty of time, Andrew, so I'm going to go through this a bit more methodically as well. But you say it was a tremendous credit to governments that we have kept default levels low and that support packages have been in place. I hear what you're saying, and then that's great during what has been a terrible, terrible period for many companies and individuals as well. But actually, many of us out there believe that governments should have let more companies go to the wall, that central banks should have offering such largesse and creating so many zombie companies at a period when stresses have abated somewhat. Is there a danger that we're going to see something in Europe that we saw after the great financial crisis, of companies that should never have existed or never have survived at least, are going to be around for far too long and eating up far too much capital unprofitably?
Yeah, look, I think, you make a general, good point. It's not good for the economy to have companies that are over-indebted and significantly over-indebted to the extent that they can't raise new money and they can't invest and can't develop their businesses long-term. That's a bad thing. I think the start of the crisis, governments, like the rest of us, had really no idea what was going to happen. And their number one job was to protect the economy. And I think across the Western world, developed world, they concluded that the way to protect jobs in the economy was extraordinary measures of support for companies. I think it's very difficult to be critical of that. It seems to have worked and reflects in our distress index with very low levels of distress and corporate failure. Going forward, as government support unwinds, there will be some businesses that probably need to look at debt restructuring to deal with potentially very high levels of debt post-pandemic and potentially lower earnings. And it is those companies that will have to undertake a full-scale restructuring at some future date. But I think where the sort of markets are at the moment and where corporates in Europe generally are is survival mode, get through the pandemic, keep the lights on, and as the pandemic really does ease and we move to a sort of post-pandemic world, address balance sheets. And governments have done a lot, I think, to position corporates to do that if necessary. Because alongside the extraordinary measures of government support, one small thing that's happened, that is noticed by restructuring professionals and less by the outside world, the governments across Europe particularly work very hard to streamline their restructuring laws. So for companies that as you say, fall into we really do need to reduce debt significantly to grow our business and invest. Those companies have now got a better, fitter for purpose restructuring law across Europe that didn't have pre-pandemic. And I think, to your point about, well, look, is it really government's business to support companies? I remember, sometimes letting something fail can have, unexpected results. And the best example is Lehman in 2008. I mean, looking back, that sort of collapse in the in the large investment bank, frightened investors across the world, might have been handled slightly differently.
I remember Lehman very well. I spent a lot of time standing outside in Canary Wharf. But then there are headlines that really terrify me that other people are very glib about these days, Andrew. People who have perhaps not been around as long as you and I. When I see, for instance, the headline in September that real yields on European junk have gone negative, and perhaps even way more in negative territory now, given the spike we've seen in inflation since September as well. That kind of gets me a little bit worried that the markets are not doing their job of pricing risk correctly. Negative real yields on junk. That just seems to me typifying a much bigger problem about pricing risk, Andrew.
Look, I mean, the good side of that is that corporates have been able to access cheap liquidity. As debt has been cheap. They've been able to fund themselves comparatively cheaply. I think it's another reason why we've seen very, very low default rates. I mean, companies have the markets have been extraordinarily supportive, both on the equity side and the debt side, of corporates needing funding. That's a good thing. The question is, how does it get unwound? I mean, if you think the strength of the markets is partly attributable to investors' appetite to risk is based on very low interest rates and extraordinary central bank support. And I think the challenge for banks, central banks, and governments is how you unwind that support gradually without causing, the other reaction, which is that suddenly, investors are off risk and corporates can't access cheap equity and cheap debt funding. So the kind of question for everybody now, and you've touched on this in your headlines, the question is, how is this extraordinary support, both government and central bank support, unwound without spooking investors and causing a problem that corporates can't access liquidity? The default rates are closely linked to access to funding for distressed borrowers. It's very important that the markets remain open and supportive. But that's been the reason that default rates have been so low since that peak in April 2020 when the pandemic kicked in.
You're one of the, here you go, you're senior European partner on restructuring. Are you expecting a wealth of business in 2022? I mean, let's be blunt about this as well. If there is a lot of restructuring to be done, you're going to be doing a lot of it.
Well, look, I've been in the business long enough to know that you never put an exact date on when restructuring picks up, but there always is some. It will come around again, whether it's Q1, Q2 next year or later next year. I think we will see it in those sectors where distress levels are rising. Now quite significantly: retail, hospitality, travel, those kind of consumer and business travel dependent businesses. We will see it sooner or later. Whether it's beginning of next year, end of next year, is going to depend upon the impact of the virus and what government does to support these businesses in the interim.
Andrew, very nice to speak to you. We'll have a chat in 2022, I'm sure. But thank you very much indeed for bringing us your latest distress report. Andrew Wilkinson, Senior Partner at Weil Gotshal. Let's get to a developing story in the southeastern states of the United States now, where a desperate search for survivors is underway after a string of deadly tornadoes killed dozens of people. President Biden declared the situation a federal emergency unleashing millions of dollars in aid as thousands of people face housing, food, water, and power shortages. NBC's Jay Gray has the latest.
Overnight, power and fiber crews, search and recovery teams continue to pour into Mayfield. The darkness can't mask the wreckage. There's just too much to hide.
But you stand in the midst of this and everything you see, everything, right, left, forward, backwards, is gone.
The initial shock of the storm now beginning to give way to the painful reality of all that's been lost.
It's never going to be the same. A neighborhood isn't going to be the same, and the town isn't going to be the same.
What's left behind, a haunting reminder of the tragedy.
It's immediate, upfront, and it's devastating.
But C.E. Miles knows the twisted metal, splintered wood, and shattered glass doesn't come close to representing the real loss here. His wife is an emergency room physician.
She said she were pronouncing people dead, one after the other after the other. And the one thing hurts us the most, she said that she pronounced 2 kids dead.
Responders warning, the number of lives lost, currently more than 36 across the strike zone, will climb as they continue their difficult work. Jay Gray, NBC News, Mayfield, Kentucky.
Right, coming up on the show, it's been a long while since supply met demand, but if the OECD is right, it could be about to get even worse. With Christmas just around the corner, we'll discuss after a short break.
Tune in for Tech Check.
Just when we thought that things were getting better on supply chain shortages, the Omicron variant apparently threatening to worsen supply shortages. According to the OECD, the sustained surge in shipping costs is now seen by the UN as likely to boost global consumer prices by an additional 1.5%. Well, CNBC.com's Sam Shee joins us with more. So, Sam, things are getting worse rather than better. Is that right?
That's right. I think before things start to improve, unfortunately, things are going to get worse. The situation is already quite bleak. If you look at the west coast of North America, you've got ships sat out at sea. They can't come into the port because there's too many containers. Not enough trucks are there to take them away. And as a result, we're going to see a lack of stock in some shops for certain products this Christmas. So the gaming consoles, the PlayStation 5 and the Xbox Series S, for example, the Google Pixel 6 Pro phone, the Apple's new MacBook Pros, they're all taking a long time to ship, or they're just not available at all. So things are looking increasingly bleak with the new Omicron variant, and it's going to be interesting to see what happens next.
I guess I'm being, it's not right for me to say, but I'm sure everyone who's got a Pixel 6 or an Xbox or a MacBook Pro or a PlayStation, they've already got one already. They're just upgrading, aren't they, Sam?
Well, you say everyone's got one already. I think a lot of people have got them on their Christmas list and they're hoping for one. If parents haven't rushed out to the shops and bought this already, then they may be in for a nasty surprise if they log on and try and order one, with just 12 days to go until Christmas. It's unlikely that they'll be able to get one. What they may have to do is go onto eBay and pay over the odds. So, yeah, it's a tricky situation.
Sam, thank you very much indeed. God, more traditional pleasures maybe at home in some of these households then. Thank you very much indeed for that. Sam Shee, CNBC.com reporter. Well, look, we've got about a minute left, I think, haven't we? I've got tease the web first of all. Okay, so Sam's story, more on the continued effects of the supply chain crunches. Head to CNBC.com and check out Sam's story. My dear friend is over there. How are you?
Hi.
They're keeping us apart.
They are. We've got about, 4.5, 5 meters between us?
I'd say a little bit more than 5 meters. I think it's at least 10 meters between us. Have you done all your shopping?
I've been trying to. You know how organised I like to be. So the initial deals start in September, October, and there.
Well, I went to a well-known mall that may or may not rhyme with Rue Water. And I've got to be honest with you, I'm disgusted by the amount of young people not wearing masks there. It was absolutely terrible, Karen, as well. But yeah, it was quite an experience on the shopping front, I have to say.
I've got to say, in London on the weekend, everybody was out who could possibly be out. It was unbelievable as we talk about this emergency setting. Some did, but I mean, it was just very festive. It was Christmas parties, it was bars, it was restaurants. I mean, I went ice skating, which was clearly outdoors, but it was busy.
Well, we're going to hear more about what's going on in your world over the next hour. But my world, I'm done for the day, but I'll see everyone tomorrow. Karen, thank you very much indeed. US futures, should we have a quick look at those as we go to street signs? They are trading mildly in positive territory.
Hello and welcome to Street Signs. I'm Karen Cho and these are your headlines. Sterling comes under pressure as the UK ups its COVID alert level, with Prime Minister Boris Johnson issuing a stark warning over the Omicron variant.
No one should be in any doubt. There is a tidal wave of Omicron coming. And I'm afraid it is now clear that 2 doses of vaccine are simply not enough to give the level of protection we all need.
Wall Street looks set for further gains after inflation spikes to its highest level since 1982. But the CEO of Abu Dhabi's sovereign wealth fund tells CNBC he's still backing America.
I take a long-term view on the United States, and I continue to have a positive, bullish view on the U.S. market.
Turkey's lira hits a new all-time low, falling below 14 to the dollar, with the central bank expected to cut rates even further at this week's meeting. And Credit Suisse overhauls its board with a string of new appointments and plans to organise the group into 4 key divisions, with Francesco Di Ferrari set to lead the wealth management business. We start out the day taking a look at the UK market, in particular sterling, as the UK has moved to COVID-19 alert level 4, the second highest after medical chiefs warned that the Omicron variant is spreading much faster than Delta, while vaccines offer a reduced level of protection against it. Social distancing measures have been resumed and health services are bracing for a potential jump in hospitalizations. You can see how we have moved on sterling as a result, 132.22 roughly. We're trading down 1/3%. And keep in mind, right back around May, June, we're trading around 142. So we've very much fallen over the following months and more lately as we've taken stock of the impact of the variant on the economy. Prime Minister Boris Johnson warned of a, quote, tidal wave of infections and urged people to book booster jabs, which will be offered to all adults by the end of the month.
Our scientists are confident that with a third dose, a booster dose, we can all bring our level of protection back up. I know there will be some people watching who will be asking whether Omicron is less severe than previous variants and whether we really need to go out and get that booster. And the answer is yes, we do. Do not make the mistake of thinking Omicron can't hurt you, can't make you and your loved ones seriously ill. We've already seen hospitalizations doubling in a week in South Africa, and we have patients with Omicron in hospital here in the UK right now.
Speaking to our sister channel Sky News this morning, UK Health Secretary Sajid Javid emphasised the virulence of the Omicron variant.
That it's spreading at a phenomenal rate, something that we've never seen before. It's doubling every 2 to 3 days in infections, and that means we're facing a tidal wave of infection. We're once again in a race between the vaccine and the virus. The second thing that we now know for sure is that the vaccines, 2 doses are not enough, but 3 doses still provide excellent protection against symptomatic infection. And that's why the booster program has become more important than ever.
Well, markets have been trying to piece together the impact of the variant as well as some of the inflation numbers we've been getting globally. And what we had last week, very interesting session unfolded really across the course of the trading week. First up, the market managed to pile on some gains, particularly in Europe. Before a little bit of wobble later in the week, we did see, in fact, very strong gains thanks to how quickly the markets climbed at the start of the week. For instance, the likes of the DAX up about 3% despite falling for 3 straight sessions into Friday, and the French market up about 3.3% also despite a very similar pattern, those 3 negative sessions from midweek last week. So as we are now opening up for the trade across the morning session, you can see we're holding on to some green. We're moving throughout the day in a positive fashion, so snapping that red ink that we've witnessed and just adding to some of those recent gains we witnessed over the course of last week. Now, the handover, don't forget, from Wall Street was stronger. We had that inflation number that was red hot as anticipated. It crossed at 6.8% as the market anticipated, but we did see fresh records then unlocked on the S&P. So that's been a positive catalyst for these markets as they've opened up this morning. Let's take a quick look elsewhere across the various sectors, and you can see what's supported across the markets first. The FTSE 100, it's a modest move into the green. You can see just how uneven these markets are. We're at 7,300 here. That 2/10 matched by 1/3, so much higher on the French market, and even stronger if you look at the DAX, almost 0.9%. So that is a very strong indication out of the German stock market this morning. Italy not too far behind, almost 7/10, got a fairly modest 4/10 on the Spanish market. And you can see the SMI a little bit left behind here, only a slight 0.1%. But the colour of the day is green, as you can see, these markets moving stronger. Let's move into those sectors, and you can see where some of the strength is coming from. Right at the top, we have gains of more than 1% in autos, technology and basic resources, 1.9% pop in basic resources, but some patches of weakness around healthcare and real estate stocks this morning. And a quick look at something news on foreign exchange markets. We've been closely watching the lira for a number of weeks now, and what we've seen the market take fright over the extraordinary economic policies by President Erdogan in Turkey, and just how any independence has very much fallen by the wayside, the central bank there. The market is now setting itself up for a 100 basis point move this week, a cut to policy, despite the fact that you've still got very, very high inflation levels, plus 20-odd%. The market is looking at these unorthodox measures and saying that is worth driving the lira lower. We've now, as you can see, moved beyond the 14 level to the dollar. In fact, we're at 14.99 at one stage. So it's picked up a little bit of that territory, but it's still a weaker trade. You can see elsewhere, dollar is supported across the board versus the Japanese yen. It's getting some traction too against some of the other currencies, the euro and sterling. So the index is showing us that strength, and that should be no surprise given what we saw on those inflation numbers Friday. The CEO of the UAE's Mubadala investment company, Khalid Al Mubarak, is not too worried about inflation in the long run. Speaking to CNBC's Hadley Gamble, Al Mubarak said current price pressures are not affecting his investment strategy.
Listen, when you're a long-term investor like us, I think these challenges, interest rates, inflation, cycles, energy cycles, semiconductor cycles, they come with the territory. You know, we're designed to
you think it's transitory, the inflation?
It's transitory. It's absolutely transitory. I take a long-term view on the United States, and I continue to have a positive, bullish view on the U.S. market.
We do have some news crossing now, and this is around the variant. Oxford University has just released some comments saying vaccines shown to induce lower levels of neutralizing antibodies against Omicron coronavirus variant. Now, this is big information. Don't forget, we've been waiting for an update from Oxford University. They are saying increasing vaccine uptake among unvaccinated, encouraging third doses, priority to reduce transmission levels, potential for severe disease. So some strong warnings here as researchers have used samples from study participants who got 2 doses of standard COVID-19 shots for neutralization assays using Omicron virus isolate. They're saying blood samples from individuals who had previously received 2 doses of the Oxford, AstraZeneca or Pfizer-BioNTech vaccines were used. They say the preprint results indicate Omicron has potential to drive further wave of infections, including among those already vaccinated. So this is fascinating. We'd already heard from Pfizer, but we'd not heard that much from AstraZeneca. So this early information that's crossing is giving us a similar line to what we heard from Pfizer the other week, that a third dose is necessary, that it is going to have an impact here because 2 doses may not be enough to lower the chance of catching this variant. So I think that's quite instrumental as we've seen fresh measures again announced here over the weekend to deal with the variant. I'm going to take you to the big number that the street was focused on Friday. That was US inflation in November, surging at its highest level, highest annual rate in almost 40 years, hitting 6.8%, and ramping up pressure on the Fed to tighten its monetary policy sooner rather than later. Rising energy prices have fueled much of the rise in consumer prices, with the energy index up 33% year on year and gasoline prices up almost 60%. Autos, food and shelter costs also contributed to the highest yearly inflation rise since 1982. Speaking to our colleagues stateside, the White House's director of the National Economics Council said the government is not too concerned with the year-on-year surge in CPI following last year's lockdown, but added it is still looking at how it can ease the inflationary burden.
Prices are high, and we are very focused on that issue. We are focused principally on the month-to-month movements because if you compare to a year ago, we're comparing to an economy that was in shutdown. And in November, we saw some modest easing from the prior month. And if you look under the headline, about half of that was driven by energy and cars. Those are both areas where we've seen some easing in the weeks since, notably on energy. We're seeing gas prices down a bit nationally, natural gas prices down 25% from November. So that is something to take note of. But we here are very focused on what more we can do to try to address the price issues that Americans are facing.
Randall Krosner joins us now, former Federal Reserve Governor. Randy, nice to have you back with us. It's an incredible number that the market is trying to digest, the 6.8% level that we all thought would cross roughly in that range. It did. But is it rearview mirror? Because the market seemed to judge, well, we knew this number was coming. Perhaps we're through the worst of it, and we're going to see a falling away in price pressures from here. Oil's moved, and we've seen some supply chain impacts. Are you as concerned after that number crossed, or do you still think that we are now looking at a major threat from inflation?
Well, I think we have to take this very seriously. We haven't seen inflation numbers like this for decades in the US or in most major countries around the world. And it's not just that we have particular inflation pressures from supply chains or autos or energy, but also we have the threat to inflation expectations. Because if people start expecting inflation to be rising, they're going to be asking for higher wages. If firms feel that they can pass those costs along, we can get into a situation like we had in a few decades ago where inflation keeps going on.
Randy, are there good aspects to that conversation, though? Because there's a feeling that low-end wages have been low for just too long, and corporates have been effectively cleaning up on some of the margins, and that's just going to shareholders, not across the economy. Is it a bad thing if we do see some wage pressure at the lower end of the economy?
Well, the real issue is real wages, so inflation-adjusted wages. And so certainly wages have been starting to rise more rapidly, but inflation has been rising even faster. And so that's a problem because the real purchasing power, the amount of goods and services they can buy with the wages, even though they're increased, haven't increased enough. Also, something that's important to note is the U.S. is a bit of an outlier on this. You know, as you just heard in that clip, they're talking about global supply chains, energy. Those are global prices. But U.S. inflation has been much higher than in other countries. And I think that's because of a big fiscal push that's there, much bigger than in other countries.
Randy, we know that the central bank game has become highly politicized in recent years, despite Joe Biden trying to take some of the heat out of this with the reappointment of Jay Powell. But we're counting down to the midterms, and there's a feeling now even in Democratic circles that taking some of the extraordinary stimulus away may be useful if we're going to try and tame inflation and not hurt low-end incomes, real incomes, as you talk about. What do you think the push is as you look at the political news stateside? Do you think there is now enough motivation for some form of retreat from this extraordinary policy?
I think there should be. I hope Senator Manchin holds the line on this. We've spent on the order of almost 50% of GDP, including some of the current plans, since last March. Now, the initial response of 15% of GDP, that happened a lot around the world. I think that was perfectly reasonable because of the great uncertainty. But the U.S. keeps spending and spending and spending. And so I think that it's just putting too much pressure on the economy. And we should just take a step back for a little bit to assess where the inflation pressure is coming from. Is it something that is global? Is it something that's outside of the U.S.? Although I think a lot of it is inside the U.S.
Randy, the Guardian over here is running an interesting piece on what happened under Volcker as he moved to successfully tackle inflation. They're saying, look, there were costs to that. We saw a lot of manufacturing sent offshore. It effectively changed the nature of the U.S. economy. It became more dependent on banks. We also saw effectively a crisis in Latin America. Those who'd borrowed heavily in debts could not repay them because of the escalating pressure we saw in the U.S. dollar. Could there be similar consequences today if we saw a central bank move too quickly?
For sure, because one of the things that you worry about is that the central bank says it's transitory, it's fine, and then suddenly it's not fine, and the markets lose confidence. These things happen quickly; they're very hard to predict, and then interest rates start to move up very rapidly. Given the amount of debt that's outstanding now in response to the crisis, both government debt as well as private sector debt, that could be really, really tough and lead to a very strong contraction. So central banks should be wary of that. And I think the Fed this week is likely to start to taper more rapidly. And I think that's really important that they do.
Randy, are you seeing signs of stress out there, or do you have concerns that are different this time around? I mean, we're talking about the lira before. We've got this unorthodox policy coming out of Turkey, and often you can see the canary in the coal mine out of some emerging markets. We've got some economies, for instance, globally, where there's not been a rollout of vaccines. They may have been left behind as we talk about the ability to recover on the back of the pandemic. How would you sum up some of the key risks that you are seeing out there?
So I think certainly major economies being too slow to deal with the inflation threat and leading to what we're just talking about, a very rapid rise of rates to try to deal with it, but too much too late, or maybe too little too late. That's problematic. We also have a lot of uncertainty around the new variant and potentially new variants coming out, both in terms of the health consequences and in terms of the policy consequences. It's conceivable that we'll start to see more lockdowns again. That obviously would be extremely problematic for the economy and something that central banks can't really do anything about. If people can't go to work, if people can't buy things, no matter how much stimulus there is, it's not going to make any difference.
So, Randy, if we put this together then in terms of the timeline for the Fed at this point, the market is saying, well, we were likely to get the taper sped up, reaching zero by March, and at least one interest rate hike in 2022. What do you expect? Is that the course that you anticipate for the Fed? And, what should they be doing?
So I think they are likely to speed the taper and hopefully end the additional asset purchases by the end of the first quarter of next year. And then that sets them up for interest rate increases. And I think it's likely that they'll be doing more than one. And I think that probably makes a lot of sense for them to be gradually moving rates up sooner rather than later, rather than be forced by the markets to have a very strong movement up that could be devastating for people who have a lot of debt outstanding.
Randy, you're also here in London, and we've had these emergency measures announced over the weekend. We've lifted the COVID alert level. You mentioned the variant and the impact that can have on businesses. We know the service economy has been hard hit in many places, particularly here in London too. Do you think the Bank of England is going to raise rates soon?
Well, it's very interesting because they seem to be on a path towards raising rates, and they seem to lose their nerve a little bit. And now I think they're concerned about these policy measures in response to the variant slowing the economy down, and so they're probably going to defer a little bit. But that's challenging because inflation is rising. The supply bottlenecks are here also, whether it's on the labor side or on the broader global side. There's also been a fair amount of fiscal stimulus, and so they have to be careful to make sure that inflation expectations don't get out of control here, just as in the U.S.
Randy, thank you very much for joining us today. I appreciate the time. Randall Krosner with us, former Federal Reserve Governor. G7 finance ministers will hold a virtual meeting today where recent price spikes are expected to be a key focus. Inflation in the euro area and UK has surged in recent months. The latest reading is coming in at 4.9% and 4.2% respectively. And it's a big week for central banks across the globe as they hold monetary policy meetings and review pandemic support measures, all as the Omicron variant hangs over their heads. At its two-day meeting starting Tuesday, the Fed will discuss its taper plans. Later in the week, the ECB will review its asset purchase plans, and the BOE, Bank of Japan, Norges Bank, and the Swiss and Turkish central banks will also be debating rates and monetary policy in the days ahead. So a little bit of a festive cheer from the central banks is what we're talking about. Now, the Turkish lira has hit a series of fresh record lows this morning ahead of that crucial decision on Thursday. The central bank is expected to cut rates by as much as 100 basis points to 14% as President Erdogan doubles down on his unconventional economic policy. In other news, Credit Suisse has announced an overhaul of its executive board. The lender has appointed Francesco Di Ferrari, the CEO of its wealth management division, and the interim CEO of Europe, the Middle East, and Africa. Meanwhile, the head of the lender's investment bank division, Christian Meisner, will now lead the Americas division. This as the bank continues its restructuring program amid heavy losses and other scandals in the past year. Just last week, it also emerged that the Swiss financial regulator, FINMA, is investigating a possible breach of coronavirus quarantine rules by the bank's chairman, Antonio Horta Osorio. Santander has been ordered to pay Andrea Orcel 68 million euros after withdrawing his CEO job offer in 2018. A Madrid court ruled the offer letter was legally binding and directed the Spanish bank to pay a sign-on bonus, buyout clause, and 2 years of salary, as well as moral damages. Orcel has been running Italian lender UniCredit since April, said he hoped this decision would close the matter so, quote, we can all turn the page. Speaking of turning the page, we're going to squeeze in a quick break, but coming up on the show, the new German Chancellor Olaf Scholz meets with the Polish Prime Minister for the first time against a backdrop of differences. We'll have the latest right after the break.
Right now on CNN.
President Biden is set to hold more talks with his Russian counterpart as tensions rise over a build-up of Russian troops on the Ukrainian border. Biden has warned Putin that Russia will pay a, quote, terrible price if it invades Ukraine. In response, Putin has demanded guarantees that NATO will not expand further to the east. The crisis-dominated conversation at the G7 meeting in Liverpool this weekend, where UK Foreign Minister Liz Truss accused Russia and China of seeking to, quote, undermine liberty. Truss hailed the meeting as a successful show of solidarity from the West.
What we've seen this weekend is a united front from the G7 that there would be massive consequences if there were to be a Russian incursion into Ukraine, which would carry severe costs. And we are very aligned with all of our partners on that. The most important thing is that we defend and advance freedom and democracy, and that is the main topic of the discussion at the G7 this weekend. We cannot have short-term economic gain at the expense of our long-term freedom and democracy.
Speaking to NBC's Meet the Press, US Secretary of State Antony Blinken pointed out the importance of the Nord Stream 2 pipeline to further dialogue with Russia.
Well, that pipeline, Chuck, as you know, doesn't have any gas flowing through it right now. And in fact, it's a source of leverage on Russia, because to the extent President Putin wants to see gas flowing through that pipeline, if and when it becomes operational, it's very unlikely or hard to see that happening if Russia has renewed its aggression on Ukraine, if it takes renewed action. So I think President Putin has to factor that in too, as he's thinking about what he's going to do next.
And German Chancellor Olaf Scholz made his inaugural visit to Warsaw Sunday to meet with the Polish Prime Minister and develop ties between the nations, despite differences over Nord Stream 2 and the EU. Let's get out to Annetta for more. Annetta, we know that Poland has been in the crosshairs with Europe over rule of law, and already we'd had concerns from the Polish about the escalating tensions here, calling it blackmail over the rule of law. Do you think we can see a breakthrough in coming weeks before Christmas?
Do you mean a breakthrough regarding the rule of law? I don't really think so. I think they will take that into the next year. When it comes to Nord Stream 2 and a decision on the controversial pipeline, I guess the same holds true here as well. Even though the US is calling on Germany to stop or use the project as a leverage or a token in the confrontation with Russia, Olaf Scholz, the new Chancellor of Germany, has refrained to do so. Perhaps we listen in on what he has to say about the situation and where we stand when it comes to the escalation at the border between Ukraine and Russia.
We're watching the troop movements along the Ukrainian border with great concern, and we are making it very, very clear that the borders in Europe cannot be violated, and that we consider the integrity of the borders of countries to be inviolable, and that no one should think that they could simply be violated without serious consequences.
So as I was saying, Olaf Scholz is still refraining from using Nord Stream 2 as a political leverage in the discussion with Russia. He most likely will follow a very old policy approach by the SPD towards Russia and towards Eastern Europe, which is based on dialogue. And if dialogue doesn't really work, then we could go down the road of sanctions. But first of all, I think he wants to start a dialogue and have a proper relationship building exercise with Vladimir Putin. If that's going to work remains to be seen, but he is insisting on an international response, European response to that crisis, and not a Germany go it alone sort of thing. I think the coming weeks will show how much interest is there also from the side of the Russians to test how integer Europe is nowadays, with the absence of Angela Merkel, who was very influential in brokering relations with the Russians. So it remains to be seen. But as I was saying, as of now, it seems Nord Stream 2 is not off the table, and it could still start operations perhaps by summer, but a decision on that really firmly sits with the court, because that's what Annalena Baerbock, our new foreign minister, just yesterday was saying, that as it stands now, as the organization is set up, Nord Stream 2 can't go operational because it's not modeled according to European energy law. Karen?
Annetta, appreciate the detail there. Thank you very much. Coming up on the show, supply chain crunches threaten to squeeze wallets over the holiday season. We'll bring you the latest on that story right after the break.
We put
Hello and welcome to Street Signs. If you are just joining us, I'm Karen Shaw and these are your headlines. Sterling comes under pressure as the UK ups its COVID alert level, with Prime Minister Boris Johnson issuing a stark warning over the Omicron variant.
No one should be in any doubt. There is a tidal wave of Omicron coming. And I'm afraid it is now clear that 2 doses of vaccine are simply not enough to give the level of protection we all need.
Oxford University warns a double jab from either the AstraZeneca or Pfizer vaccine induces lower antibody levels against Omicron as the case for boosters grows. Wall Street looks set for further gains after inflation spikes to its highest level since 1982. But the CEO of Abu Dhabi's sovereign wealth fund tells CNBC he's still backing America.
I take a long-term view on the United States, and I continue to have a positive, bullish view on the U.S. market.
And Turkey's lira hits a new all-time low, falling below 14 to the dollar, with the central bank expected to cut rates even further at this week's meeting. We're watching a stronger session play out here in Europe this morning, snapping what has been reading into the end of last week. That said, it was such a strong trading environment at the start of the trading week last week that we did bank some gains for the week before that wobble set in. We are now trying to recapture some of the green, as you can see. One of the stronger markets, really Germany, that is a standout versus just slight gains on the UK stock market, where the last 24, 48 hours have very much been dominated by the handling of COVID at this stage, as the variant starts to have a dominant impact on infections here in the UK. So it's a bit more cautious versus the rest. Germany solid 1+% to the upside, 0.5% on the French market, and about 0.8 on Italian stocks. But keep in mind, these were very strong markets last week. We saw a gain of about 3.3% on the French market, which was one of the strongest indications that we had for the core markets. I want to take you to foreign exchange rates. It should be no surprise that dollar is king again after what we had on that inflation number, the 6.8% that crossed Friday's session. And that has put a move back, of course, into the short end yields, given some support to the dollar on the crosses. One of the ones we're watching very closely has been the lira, as the market gets set for even more interest rate cuts in the face of escalating inflation, the unorthodox policy of weakening the currency further. And a quick look at what's in store for later on today is stateside. You can see we are watching positive numbers at this stage. Right across the board. One of the positive catalysts for our market actually has been the record level that we finished at the SP500 on Friday. The inflation numbers very much judged by some market participants has been a rearview mirror, and that set the scene for this market to unlock further gains. Mubadala CEO Khaldoon Al-Mubarak has said he is bullish on prospects for the chip industry, despite current supply shortages. Now, speaking exclusively to CNBC, Al-Mubarak doubled down on the investment company's position in global semiconductor manufacturer Global Foundries.
We've lived through that journey. When we entered that business back in 2007, it was AMD. It was investing in a company which we thought was going to be a company that will be very successful, that had a differentiated technology, but that was, at that point, doing 2 different things, doing the design side of it and the manufacturing side of it. I think the view we took back then was, of course, with AMD, that the manufacturing side needs to be spun off, because achieving scale and being able to compete on a global platform required it to essentially service many customers. So turning from a aspect of a business within AMD that was serving one customer in AMD to then being an independent manufacturer, an independent foundry, that led to the establishment of Global Foundries, and eventually what we'll talk about a bit more, which is the journey of Global Foundries. I think that was the first very important decision point back in 2007. AMD back then was small. I think had very interesting prospect. We had a very, I would say, strong view about the semiconductor business, technology, where it was going. And I think we made a big bet on AMD. And over the years, AMD, you know the story, has been an incredible success. Its CEO, Lisa, has been one of the most incredible CEOs, I think, in the sector. Well, to be honest, in business overall, really phenomenal CEO. And with that, we've seen AMD become now the player we were always hoping for back in 2007.
In terms of that growth and the need, supply meeting demand, what's your outlook? Because you have a bird's eye view on this at this point.
So it took 50 years for the semiconductor business to turn into a $500 billion business. It's going to take probably 8 to 10 years to double. And it's going to double right after that, probably in 4 to 5 years.
Yeah.
So you take that as one very important data point. You combine that with another very relevant data point. There's only 5 players. There's 5 foundry businesses, global foundry businesses, 4 of which are in Asia.
Yeah.
One of which, Global Foundries, has, I think, the unique differentiated platform of being in the United States, in Europe, and in Asia.
Local authorities in China's eastern province of Zhejiang are clamping down on a new virus outbreak. Official numbers on Monday showed 173 confirmed cases in the province between the 6th of December and the 12th, compared to just 1 case reported back in October. More than a dozen local companies have now suspended their operations as health authorities work to stamp out the new cluster. The Omicron variant threatens to worsen supply shortages, according to the OECD. The sustained surge in shipping costs is now seen by the UN as likely to boost global consumer prices by an additional 1.5%. Well, CNBC.com technology correspondent Sam Shi joins us with more now. Sam, nice to see you today. We are hoping, as we've seen that inflation number cross stateside on Friday, that things are getting better, not worse. Just give us a sense of what's crossing from the OECD.
So the supply chain issue at the moment is quite bad still in a lot of areas, especially when it comes to semiconductors and chips. There simply aren't enough chips to go round, and that means that a lot of products are unavailable this Christmas. I've just done a piece for the website all about how Santa isn't even going to be able to deliver the PS5, the Xbox Series S, and the kind of supply chain will hopefully resolve itself by the middle of next year, but we'll see.
Sam, you and I both were at a Web Summit recently in Portugal with a ton of technology insiders. And I did speak to one of them that was in the semiconductor industry, and he said to me, look, do you think this is going away? If you think about all the things you're purchasing now with chips, do you think it's going away in coming years? I had to think about it. It's like, well, I don't have an electric vehicle yet. I don't have a lot of connected devices in the home, like the toaster, the kettle, the fridge. They're not connected at this point. So potentially he's right. Perhaps we don't know the demand story. What do you make of that? There's a huge change we're seeing now in terms of the technology with 5G and more connected devices. It could potentially mean that we see this go on for much, much longer than many people anticipate, right?
You are right there. There is chips in everything now, and there's not just 1 chip or 2 chips. There's often dozens or hundreds of chips in products. So we are putting semiconductors into an increasing number of items, and the chip manufacturers just can't keep up. You know, they take orders several months in advance, and they're already operating at capacity. So if someone goes to them now and says, we need more chips, they can't do it. They have to plan ahead. So it's hard to see this semiconductor crunch just going away. I think it's going to continue for at least another year, possibly 2 years, and who knows beyond that.
And short term, as we talk about what Santa may deliver this year, Sam, we know a lot of people have had their eye on hot devices. That's very typical of this time of year, whether it's gaming consoles or a phone or some form of a tablet. Yet there was also that impact where the pandemic brought forward a lot of the demand stories. So what does this year look like in context?
Well, it's kind of hard to say. You know, some products, including cars, have been particularly badly hit. So if you're after a car for Christmas, you can expect to have less features in there, you know, no up-to-date sat-nav, and some cars are having their parking sensors removed and things like that. So all in all, it's still quite bleak and quite bad for the consumer right now. And also prices are being passed on to the consumer too. So the price of chips has gone up by around 20 to 30%. So those price increases are being passed on to shoppers, and products are ultimately getting more expensive.
Yes, Sam, great news for the investor, but not necessarily for the consumer this Christmas.
Indeed.
Thank you very much for bringing that to us. And for more on the continued effects of supply chain crunches, you can head to cnbc.com to check out Sam's article. Moody's outlook for the retail sector remains stable, even as inflation and supply chain woes mount. However, the firm warns some retailers will see their margins hit amid rising raw material and transportation costs. David Beadle joins us now, Vice President, Senior Credit Officer at Moody's. David, you just heard our conversation there between myself and Sam. Just weigh in on the conversation that we're having about the supply chain pressures as you see it.
Yeah, it's obviously a topic that's getting a lot of coverage at the moment, and understandably so, with those challenges that also cause delays in shipments from Far East. I guess, taking a bit of a bigger picture view, though, this isn't necessarily a bad thing for the retailers in those badly affected segments by delays. If I think about electronics retailers, the margins that you make on those new gaming consoles are pretty low anyway. And in fact, if you think about car retailers, yes, there'll be delays, but what that means is that the price of second-hand cars is actually boosted, which again helps the margins of those retailers. So, I mean, overall, yeah, the kind of supply chain challenges remain a threat to profitability, but ultimately in those segments. But ultimately, when it comes to looking at the sector outlook, we're looking at the far broader segments, or all of the segments of retail, from food to non-essential products as well, and trying to think about the underlying credit fundamentals for the next 12 to 18 months. Clearly, the pandemic has been a tough and volatile time with many challenges. But as I say, people like grocers, discounters, online specialists, they've all done very well in these last 18 months or so, as demand has been very robust for their products, as consumers can't go and do the things that they might ordinarily like to do. And even in other segments like clothing, homewares, electronics that have been hit by lockdown closures, those are coming back strongly as pent-up demand has been released.
David, you mentioned the discounters there, and funnily enough, last time around with the financial crisis, those discounters were very strong in the marketplace because of the trading down by hard-hit consumers. This time round, it feels like with very thin margins, as soon as they get some cost pressure, it's very detrimental for the business. Holding the line on $1 or £1 pricing is incredibly difficult when you're seeing escalation in just about every area of the business, from transportation to the actual products themselves and wages. Do you take a dim view then of some of the budget operators in the space this time round?
Well, in Europe, I guess the big companies that we have ratings for don't tend to have that constraint of, as you put it, the dollar price point. I'm thinking of companies like B&M, who are doing remarkably well in the UK in particular. There's also Action on the continent. And these companies have a very broad array. I think there's privately owned companies that are doing well as well. Companies like The Range in the UK, Gather, are doing very well. And they do well because they have this sort of treasure hunt type of offering that consumers love. They're getting a bargain. It's not necessarily a pound, but it could be very different price points indeed. But they're being flexible with their offering. That's been the key for the success of the likes of B&M and Action that we've seen have improving credit quality over these last several years.
David, we've got to talk about the new variant. I mean, if you've been around London, central London in recent weeks, it feels as though things are back to normal. The stores are incredibly busy. There's a lot of footfall. But now with the work from home guidance again, and clearly some concerns about the effectiveness of 2 doses of the vaccine across a population that has been double dosed, are you concerned that this normalising, the footfall that's been recovering, will quickly snap back to a lower range like we've seen before during the height of some of the concerns?
Footfall is such an interesting statistic to look at, but it's also very confusing. I mean, footfall levels overall are still somewhat muted, well down, in fact, on pre-pandemic levels. And it varies by location. Places like high streets are suffering in particular. And in fact, the city centres, albeit you might feel like they're have been getting back towards normal, they're still well down on what people would have been seeing pre-pandemic. The winning part in terms of bricks and mortar footfall is retail parks, where people can go, under their own steam in their own car, and go in and out of quite large units without feeling that they're constrained and getting too close to others. But I think in that medium-term prospect, underpinning our stable outlook is the point that we expect things to gradually normalize. Obviously, there's downside risk, as you mentioned, in terms of footfall. But I think the other point about that anecdote that you make about central London footfall looking quite strong, I think people have been inclined to shop early for Christmas this year, more so than ever, because of those concerns about the way things might play out in the weeks ahead. So overall, I don't necessarily feel that it's going to be a bad picture for retailers with national presence. Sure, city centres are going to find it relatively tough in the next couple of weeks, but I think they've had it quite acceptable these last few.
David, could we talk about some of the other markets across Europe too? I was in Paris recently and it had a real good feel factor about it. But of course, that was before the height of these variant concerns have come surging to the forefront of the news headlines. What do you make of how some of these markets are positioned, from France to Germany, the Netherlands, where we're seeing stronger restrictions as well?
Yeah, I mean, of course, this sort of short-term volatility is relevant, in particular to the equity markets. We're a credit rating agency, and our outlook covers, as I mentioned, a rather more medium-term approach, 12 to 18 months. So we're expecting, absent prolonged social restrictions on shopping, absent a lockdown, we're expecting the prospects overall for retailers to be pretty strong, pretty robust. Food is going to continue to benefit from the fact that systemically we're eating more at home than we were pre-pandemic. By the same token, clothing retailers are coming back from a very tough time when they've had periods when they've been forced to be closed, so prolonged periods over the course of the last year or more. So, as I say, going forward, I'm not going to say it's a full-blown tailwind. There will be bumps, there will be difficulties, but for well-run retailers that have adapted their offering to this changed environment, I think the prospects can be set reasonably fair.
David, thank you very much for joining us for such a comprehensive view of the sector. David Beadle with us, Vice President, Senior Credit Officer at Moody's. Chinese artificial intelligence company SenseTime has shelved its Hong Kong listing after the US Treasury Department placed it on an investment blacklist over alleged human rights abuses in Shenzhen. Now, the group said it is strongly rejecting what it said were unfounded accusations. Emily filed this report.
China's largest AI company, SenseTime, has postponed its IPO. The company made the announcement in a statement to the Hong Kong Stock Exchange and said that it will publish a supplemental prospectus, which will also update the listing timetable, going on to say that SenseTime remains committed to completing the global offering and listing soon. All subscription monies will be refunded to investors in full without interest to all applicants. SenseTime failed to price its shares last week and had been scheduled to debut in Hong Kong on Friday. The latest developments come after the U.S. Treasury Department last Friday placed SenseTime on an investment blacklist, the Chinese military industrial complex companies list, over alleged human rights abuses in Xinjiang. This prohibits the purchase or sale of any securities traded by a U.S. investor on any exchange, including in Hong Kong. So it would directly affect U.S. shareholders Silver Lake and Fidelity. SenseTime issued a statement on Saturday saying, "We strongly oppose the designation and accusations that have been made in connection with it. The accusations are unfounded and reflect a fundamental misperception of our company. We regret to have been caught in the middle of geopolitical tensions and will take appropriate actions to protect the interests of our company and our stakeholders." The market will also watch to see if Hong Kong Exchanges and Clearing will set a precedent to host a listing of a blacklisted company in the city. I'm Emily Tan in Hong Kong. Back to you.
Coming up on the show, rescue efforts continue in Kentucky with a desperate search for survivors after the state's deadliest tornado on record. We're live on the ground just ahead.